Hey, CZ.
Hey Laura, how are you?
I'm good. How are you? It's nice to actually have an interaction face to face.
Yes, I think last time we talked was just over the phone, or yeah, we didn't get to see each other sort of visually.
No, we didn't. So before we keep chatting, I just want to say to everyone, welcome to the kickoff talk for Ethereal, which will be this fireside chat that I'm conducting with Changpeng Zhao, aka CZ, who's the CEO of Binance. And if you don't know who I am the host of a couple of crypto podcasts, Unchained and Unconfirmed. Welcome, CZ.
Thank you for having me here.
So, in your tweet yesterday about our chat, you said that last time I interviewed you, I asked you tough, bordering misleading questions. And I wondered what questions in particular did you take issue with?
Well, you well, you asked me if I was worried about going to jail. I mean, who asked that, right?
Well, but I do think, I mean, my questions about US regulations, I think at least, were on point because, since the time of our interview, now Binance has changed its approach to the US. And I remember last time when I was asking you all about the US regulations, you said that my line of questioning was like telling somebody who didn't like hot weather that they had to live in the US or live in Florida. And you said, that was ridiculous. But apparently now you've decided that even though you don't like hot weather, you will come to Florida. So now you have Binance US, which is specific to the US market. And obviously it's unique regulations, I guess we could call them. And even within that, there's Binance USD, which is approved by the New York State Department of Financial Services, which is easily one of the toughest crypto regulators. So it seems that I was right that the way Binance was operating was not really in line with US regulation. Would you agree with that? And that's why you launched Binance US?
So again, I think I will have to disagree with that line of questioning, but I think the question is worded in a misleading way. It's just that okay, because not every company starts in the U.S. and we didn't start in the U.S. We wasn't targeting the U.S. customers specifically, and but we got to a big point where we're big enough. Getting regulated in the U.S. is really expensive. I don't like it's like I don't know 48 states you have to get licenses with. I think our partner is still going through that process. It's very time consuming. But at a certain size, we said, well, the U.S. market is an important market, and we want to be able to service that market. So we partnered with spam trading services, and they are still, as far as I understand, they are still very much going through the licensing state by state process. So they're able to service, I believe, 37 states, and there's a few big states they're not able to service just yet. So we're still waiting for them to get the license to go through that. But the narrative is not so much we were targeting the US illegally before, and now we're doing it properly. It's not quite like that, from at least from our perspective.
Okay. Well, I guess now I'm 2 for 2 in asking you bordering misleading questions. But speaking of BUSD, which I mentioned earlier, that's
Oh
part
yeah.
of Venus, which is your stablecoin initiative, and that will create kind of many different types of stablecoins for different fiat currencies. And in the Chinese version of your announcement, you referenced Libra when you talked about Venus, and your co-founder He Yi, I think is her name, said that Venus was, quote, the One Belt One Road initiative or version of Libra. And so, when you guys made this announcement at that time, it looked like Libra was just going to be this single global currency, and Venus was going to take a different strategy of being different stable coins of different central bank currencies. But now obviously Libra is actually going in the direction that Venus was supposed to go. So is that changing your strategy with Venus?
Okay, so I think there's some misinformation there as well. The Venus was never meant to be a stablecoin on its own. It's a basket project encompassing several or many stablecoins in different parts of the world. And our approach is always to work with local governments, local corporations, or other regulatory bodies to issue different stablecoins for different regions. We did not have the thought of issuing a basket-backed stablecoin as a single stablecoin. I haven't really figured out how the economics of that would work. So we took a very much simpler approach. Say, look, US is a big market, and also we found a very strong partner there, Paxos. They're actually the issuer of the Binance USD stablecoin. So even though it's called Binance USD, the issuer is actually not us. So it's issued by Paxos, which is fully regulated by NYDFS, one of the strictest regulators in the world, and their bank account is, I assume, is audited by by the auditing firms. I actually don't see the bank account, but it is transparent. It is like there's a peace of mind to it. So that's one part of it. And I think very recently I heard that the government of Bermuda is even accepting BUSD for tax payments. So among a few other stable coins that's also issued from the US. So that's quite good. We also issued BGBP. We recently, so that's a British pound one. We also issued a BKRW, which is a Korean won one. So there's more in the works. So our approach to stablecoin is that I think the simplest approach is basically, look, take some fiat, put it in escrow, make sure it's totally transparent, audited, regulated, and then issue a stablecoin on that. That's the simplest way. There are other more fancier ways, like algorithmic. I can't pronounce that word. Those different types of stable coins, which are fancier, but that's fine. So we just provide a very simple option for our users, and we want to do this in more and more regions through the Venus project, which is a kind of an encompassing project.
Right, right. But actually, so maybe you misunderstood my question because I was saying that now that Libra is essentially doing what you had planned to do, like, does that change that strategy at all?
No, not necessarily. I think Libra's kind of Libra's well based on common perception, they're very much focused in the U.S. They have a very strong presence in the U.S. It's a U.S. company, and they're dealing with U.S. regulators very heavily. And they do have a lot of reach globally in terms of user base. So that's great. But I mean, our philosophy is always one more option doesn't hurt users. So we're gonna throw wherever it makes sense, we're gonna provide our option. So we don't see ourselves as competition to Libra. We don't see ourselves as competition to other stablecoins. So we support other stablecoin initiatives. We support we support anything that users want, really. So if a coin has a lot of users, we'll likely support it, and hopefully we will be able to provide usability to a lot of users with our own stablecoin. That if a lot of people use it, then it's great. If nobody uses it, then we're gonna shut it down. So that's kind of our philosophy.
And China now is in the early stages of rolling out its central bank digital currency, DCEP. Does Binance ever see itself launching a Chinese yuan stablecoin as part of the Venus project?
So right now, to be honest, we have no plans. And there's two versions of Chinese yuan. There's the onshore RMB. There's the offshore RMB. And they're not supposed to mix because China do have very strict flight capital controls. So right now, I don't think you can get a bank to support you to issue a stablecoin in China. There has been attempts to issue a stablecoin based on the sort of overseas RMB. But very little adoption. I think basically today US dollar is still the dominant fiat currency, and we see that much of the volume is in US dollar based stable coins. So this is actually good, like the stable coins actually in this sense is very good for US dollar. It actually improves US dollar's dominance, but we'll see. Things might change, but basically, if there's a way to issue a stablecoin properly with banking support, with approvals, fully transparent auditing, if there's those things, then we are more than happy to do that. So we're talking with a few different initiatives or different projects, but nothing's it's still early stages. Nothing's very concrete right now.
And what impact do you think DCEP will have generally on the adoption of crypto?
To be honest, based on my limited understanding right now, it feels very much like a digital version of RMB, which probably plus a blockchain architecture somewhere in there. So it's still very much controlled. It's still access to it is still very much limited to a number of large banks. So how easy it is for a sort of a crypto player to integrate that into the ecosystem, I'm not sure. So far we do not have access to it. So they're testing. My understanding is they're testing it among a few big banks initially. So hopefully, if it gets really wide adoption, if everyone in China is using it, and if there's a blockchain interface that we can interface directly onto Binance and let people deposit and withdraw, that'd be great. If we can't do that, then the usage will be somewhat limited. It's still useful in the sense of educating everybody about blockchain and stablecoins, cryptocurrencies, etc. And I think today, if you learn about blockchain and cryptocurrencies, you cannot not learn about Bitcoin. So I think that exposure helps a lot, even if we can't use it. So it's still early stages. We can't use it today because it's still in very limited testing. But hopefully, very soon we will be able to use it. And if we can, then that'll be fantastic. That provides a much better on ramp for RMB. We'll have to see.
Yeah, and another thing that I find interesting that's happening right now as we're seeing this, race amongst these central bank digital currencies taking place is that obviously at the same time we have this pandemic. So I was curious to know what impact do you think the coronavirus and the economic fallout from that will have on the adoption of crypto? And also I wondered if you're like already noticing any trends in terms of the activity on Binance.
Sure, absolutely. So I think there's definitely a lot of trends that we're already noticing. The most obvious one on Binance right now is there's higher trading volumes. There are far higher trading volumes ever since like about 2 months ago. So there could be a variety of different reasons contributing to that. It could be that people are just bored at home and they just trade more because there's less other distractions or other interesting things for them to do. It's also possible that given that the governments are printing money at record speed to sort of support the economy or to try to recover the economy, and now those money is starting to flow into cryptocurrencies, and we're seeing the price recovering. So, but all of those things I think have a very fundamental impact. And also the coronavirus has a huge impact in the sense that traditional industries are very much stopped, right? So production we can print a lot of money to sort of hand out money to everybody, but the fundamental fact is production in a lot of sectors have completely stopped. There's a few essential sectors that's still going strong, and online virtual businesses are going strong, which is good for us as well. But then with the government printing so much money right now, and everyone being bored at home, so all of those factors contribute to the growth. So yeah, I mean, so far I think as many KOLs or like OGs say in the space, we're kind of witnessing a perfect storm for Bitcoin and cryptocurrencies. So I think if cryptocurrency does not shine in this environment, then I'm in the wrong industry. So but I'm very confident about it. So.
During this time, you also became the #1 crypto futures trading venue. Why do you think that shift happened?
To be honest, I think we got lucky there. So I think the futures platform actually have grown very quickly as well. Again, I thought it would take multiple years to grow to the #1 platform for futures, because when we only started in late September last year, so really only just over half a year. There were existing established players with very large volumes, and we thought it was going to take a while. We deliberately engineered the product to be a little bit different, even though it's still futures. Yes, we copied a lot of other people's features, but the fee structure is very different. Our fees are about 1/7 of the existing players for fees that they charge for the taker side. So we have very aggressive takers so we are very attractive to the sort of smaller retail guys. We don't have a high a maker rebate, so it was deliberately engineered to be slightly different from the existing platforms. And we were growing slowly. And to be honest, on March 12th, the biggest futures exchange experienced some issues, and that's the day when the Bitcoin price was moving really, really widely. The Bitcoin price was dropping, and everyone wants to trade. Luckily, our system stayed up, and so that moved a lot of liquidity to us. And actually, unbeknown to most retail people, Binance Futures has the fastest API and most stable API. So we average somewhere around 5 to 7 milliseconds, which is about like somewhere between like 1/3 to 1/10 of the latency on other platforms. So this kind of things over time they kick in. But honestly, we didn't expect it to be that quick. And we still offer a very limited product in terms of futures. We only have the perpetual futures. So we're actually looking to add settlement futures. Our futures is settled in USD or USD stablecoin. And we're looking to provide a cryptocurrency cryptocurrency settled futures contracts. So all of those things are going on. But I think we got lucky on the futures growth.
I would say that somehow your career in crypto seems to have been born under a lucky star. One other thing I wanted to ask about was just like, so what you're seeing kind of initially now in these early months after the coronavirus pandemic. Do you think that you're that you have a sense of how long term this will affect the adoption of crypto, or how you'll see crypto trading, or who gets involved in crypto, how all those things will change?
Yes, I think my feeling, I could be very wrong on this, so just my personal opinion, is the impact's going to be on the level of month. So I think we're gonna see, I think it took a couple of months for the impact to kick in. So it didn't kick in like on the second day when we felt there was a financial crisis, when the stock market crashed. Bitcoin actually crashed with it. So you actually didn't have that sort of a safe haven effect on a day-to-day basis. But I think we're seeing that there's a strong recovery right now. And so it's been a couple of months. And I think over the next few months, maybe 6 months, 12 months, 18 months-ish, we're going to see very, very significant impact. I think more and more people are going to realize, okay, well, there's just unlimited cash flowing around. And they only get the minute they get the cash, they will want to put that into something that's of limited supply. And the easiest thing to put that into is actually cryptocurrencies. So like before, that option, 10 years ago, that option wasn't available. But now this option is available. People can buy gold, but other than a few like really old timers, nobody really wants to buy gold anymore. So I think, and also there's more and more people are becoming more and more aware of the different economic impacts of different actions government take. So I think over the next 12 to 18 months, we're going to see some really significant changes in the crypto space. And right now we're in a situation where there's a halving going on, right? So it's a perfect storm. So after the halving, the supply of Bitcoin is actually going to be decreased, or the new supply of Bitcoin is going to be decreased by half again. So the supply is very, very limited, and people will just have to, I think, and more people come in. And like the data we see on our platforms right now in terms of new users, and also as well as old users whose account has been dormant, has been like, they're really coming back alive really, really quickly. So our customer support has been really busy as helping people forget with the password resets, etc. Because there's a lot of guys who like just forget their password after a while, right? So we're seeing all of those things happening. So I think in the next 12 to 18 months, we're going to see some really significant increase in adoption in the crypto space.
Yeah. We'll see what happens. It's true that historically that has been the case after a halving. So let's switch from talking about Bitcoin to Ethereum. Your proposed Binance Smart Chain, which is a smart contract platform, will be compatible with Ethereum. But what do you say to the people who think that Binance Smart Chain is attempting to compete with Ethereum?
Well, I think basically that depends on the definition of competing, because it's really a very personal, subjective view for each individual. So I mean, you can say Ethereum is competing with Bitcoin. I'm not sure if that's, or you can also say BNB is competing with Bitcoin. At a broader level, maybe you can also say we're kind of complementing each other. So we So initially, when Binance Chain first started, our goal was to just provide a platform, a very fast chain that solves a performance issue with many of the existing blockchains, and so that we can run a decentralized exchange on it. And so that goal has been achieved. But given the popularity of centralized exchanges and the ease of use for centralized exchanges, I think most people still don't know how to hold their coin themselves. To be honest, like if you grab 100 guys on the street, only 99 of them will now know, or at least are not confident holding a Bitcoin on their own. So until that changes, and we're looking, I think the decentralized exchanges will be relatively small, but it could change very quickly. We don't know. One of the most requested features for Binance Chain was a smart contract. And everyone wants a EVM, Ethereum virtual machine compatible smart contract chain. So we said, well, if users want it, let's provide it. So we view ourselves as complementary to Ethereum, not competing. I think Ethereum does a lot of things very well. Ethereum is first. Ethereum did fulfill their vision in the sense that they did build a unstoppable machine. It is the 1.0 version is still a little bit like they have performance bottlenecks, which everyone's experiencing. So hopefully 2.0 will solve that. But from our perspective, look, if something's already working and there's a very large community is already familiar with Solidity programming, then we should just go along with it instead of fight it. So we never really view ourselves as competing with Ethereum. We support Ethereum. We listed on Binance.com. We have a very large number of pairing for it. So I think we support the initiatives that they're pushing forward. And I think some of the technical problems they're trying to solve are very meaningful. If Ethereum 2.0 solves the performance scalability problems using sharding, that's super useful. So we hope that they do well. Yeah.
And so if I'm a developer or a user, why would I either create or choose to use an Ethereum dApp on the Binance Smart Chain as opposed to on Ethereum?
Well, number one, on the Binance chain, if you issue a token on the Binance chain and use the smart contract there, you can just port over your Ethereum contract. You will work on both chains. And then when you have it on your Binance chain, there's a Binance decentralized exchange, the Binance DEX that works out of the gate. It is I think the DEX on Binance chain is very well done. It has a very, to the extent possible, a very user-friendly interface and a very fast matching engine, and it just works. And then you're also in the Binance ecosystem. To be honest, most developers, you can be in both ecosystems. There are a lot of coins which are dual chain or multi-chain right now. So that's just another option. And then if you're on Binance DEX and if your trading volume is high enough, you get a slightly higher chance of listing on Binance.com. So you're kind of more visible to the Binance ecosystem. The Ethereum ecosystem has a very high number of users. The Binance ecosystem also has a large number of users. So they're two slightly different user groups, to be honest. The Binance ecosystem has more heavier traders and centralized exchange users, whereas the Ethereum ecosystem has more developers and more sort of the tech-heavy, pure decentralization type of guys. So it's slightly two different, even though we're kind of within the same industry, there's some differentiations between the different players. So it's just another choice that we provide for developers and users.
So it sounds like if there's more traders on in the Binance ecosystem, then maybe it would make sense for some of the DeFi projects to want, to move over there or to create. Okay. So I wonder if there will be Ethereum people who will say you're stealing our DeFi users and developers. What would you say to them?
So to be honest, I think there's always two sides we can view anybody else on this planet. We can always view them as a collaborator, or we can view them as a competitor for any person on this planet, because they're breathing my air. So I think basically we are the fundamental situation we're in this industry is that the market is nowhere near saturated, right? So only 1 in 1,000 people have some kind of crypto right now. So only 0.1% of the population have crypto. There's 99.9% of the expansion that can be possible. In a saturated market, if you introduce a new player, yes, you're going to take market share from other players. In a nascent market, one more player come in will make the ecosystem bigger. That's much better for the ecosystem. So we would want to invite Libra to come in. We would want to invite IBM, Microsoft, other guys, Google to come in. So I think having more players in a small and not saturated market, but nowhere near saturated market, makes this industry bigger. So now we should be all collaborating to make this industry bigger. Once you achieve like say, look, if you want to do another, I don't know, search engine, you're probably competing with somebody else. If you do another browser, you're probably competing with somebody else. But if you do another blockchain or another blockchain application or even another exchange, chances are you're not competing directly with us. There are so many users who are not using Binance right now. So only 0.1% of the population in crypto, only a small portion of that are using Binance. So if you launch an exchange in somewhere else, you can get more users into this industry, and that helps all of us. So there's two ways to view it. I think that's really depending on how a person likes to view. That depends on their worldview. We don't view anybody as competition right now. So we just want to grow the space bigger.
Yeah, that reminds me, I asked a similar question to Wences Casares years ago. And he mentioned, he was talking about a different industry that he had launched a startup in, but he basically said what you were saying, that competition just grows the pie. All right. Well, one other thing I wanted to ask you about was some of your big news this year, which was that Binance recently acquired CoinMarketCap. And because Binance is an exchange and is also at least one of the largest holders of BNB, if not the largest, some people say that Binance could have an incentive to sway the rankings and the reported volume on CoinMarketCap. So what do you say to people who are concerned about that?
Well, I think if we do that, then if we do that in a negative way, just for the benefit of Binance, then CoinMarketCap loses a lot of the value that it provides. So I think neutrality is a very key value for CoinMarketCap, and I recognize it very well myself, and the CoinMarketCap team recognized that. Did we ask the CoinMarketCap to fix some of the fake volumes on CoinMarketCap? Yes, we did, and I think all the community agrees that there's a lot of exchanges reporting fake volumes there. Will we have our influence in that discussion? I think also yes. But CoinMarket, all the business units, what I call business units. So I view Binance.com, the exchange, as one business unit. CMC is one business unit. Trust Wallet is another business unit. We have 30, 50 different business units. Each business unit operates relatively independently. And so if Binance wants to put an ad on CMC, they will pay for it. So the Binance.com exchange business will pay the CMC business for that ad, and they will pay at market rates. They'll get the lower tier of the market rate, so they will not be ripped off, because for us it's really left pocket, right pocket. But I think from my perspective, the best thing to maintain value overall for CMC and Binance.com together is CMC being the CMC and Binance.com, the exchange, being the exchange. I think both are strong enough to compete on their own. We don't need to sabotage one business for the benefit of another business. Binance.com can compete. It's already the #1 exchange by most matrices. And CMC is the largest traffic website because it's useful to a lot of users. And also Binance.com will not unnecessarily give some benefit to CMC just to move CMC up. So I think both businesses will compete independently, and they should build value independently. And that does not involve CMC directing all the traffic to Binance.com. So people don't have to worry too much about that.
And you did reference, obviously, the fake volumes, or at least the inaccurate figures on CoinMarketCap. What can you do, or what can CoinMarketCap do to make the numbers more accurate?
So what I did was basically I posted a tweet asking for feedback, and that was probably the #1 feedback that people want to fix. So I just asked the team, just fix it somehow. I don't care how you guys fix it. The team has what they call a liquidity metrics. So they look at the order book depth. They look at a bunch of other matrices to try to fix it. And when after that, so I mostly use CoinMarketCap for the coin market cap. So when I look at a specific coin, I look at that. I did used to use a CoinMarketCap for exchange rankings, but it's so inaccurate right now, so it's kind of less useful. And then I look at the adjusted volumes that they had. I was like, well, that's even less accurate than the reported volume. So I did give those feedback, but other than that, I didn't tell them how to fix it. So I said, look, there's a bunch of matrices you can use. You can tie it together with web visits, or you can tie it together. They also have data on outbound clicks, how many people click on the links for each exchanges to go to the exchanges. And Binance is number one, even though Binance is mostly ranked like 15 and or 20 or 25th spot, because like there's a bunch of other guys with fake volumes in front of that. So we look at those data. Even historically, Binance is number one. And actually, if you look at the outbound data, it's actually very accurate. That gives like a very accurate. So they have a lot of data that they can use to sort of fix the ranking. I didn't tell them specifically how to fix it, but just said, look, that's the number one user requested feature. You guys fix it.
Yeah, well, we'll see how that goes. Good luck to you guys on that. One other thing I wanted to ask about was, you guys launched this leverage trading in October, and you did it with 125x leverage. When high leverage can so easily cause many traders to get wiped out, why did you offer such high leverage?
Okay, so I'll make a confession. The high leverage is more of a PR gimmick. So the 125x is only available for small amounts. So if you want to trade like, I don't know, a couple $100, yes, you can go 100. You can go 125x. And at larger amounts, if you want to trade $10 million, no, you don't get 125x leverage, because if you get liquidated, the liquidity is not the current liquidity is not in the industry is not strong enough to support that kind of liquidation. So it's a tier system where for smaller amounts you get to that kind of leverage. And we have a deleveraging system that if you approach your margin and then you get deleveraged. Most of people actually only use like 10, 20 max. Like most people don't really use above 30, 50x. So the high leverage is really sort of just well, there was 100x and there was 101x. We said, well, 101 doesn't really divide very well. 125 divides much better. If you divide it by 8, you get a nice number. If you divide by 7, you get a nice number. So we just said, well, let's go with that. So most people don't use that high leverage.
Okay. Well, we got a nice admission there. So this is going to be something else that a lot of people are going to be curious about. In early April, 11 class action lawsuits were filed against a number of crypto companies and token projects, and Binance was one of them. The suit named you and your co-founders, He Yi and Roger Wang, as defendants. The lawsuit noted that in 2019, Binance averaged more than $2.8 billion in daily trading volume, had more than 15 million users worldwide, and listed 184 tokens. And it also talked about how in 2018, Binance brought in $446 million in profit. And then the lawsuit said, quote, "How did a company that was barely a year old generate such extraordinary profits? By building a platform that solicited the buying and selling of unregistered securities on a historically unprecedented scale." What is your response to that?
So on that point, our lawyers told me not to say anything, so I will not comment on that. But we have lawyers handling it, so it is what it is. I think every company, well, we were not without lawsuits from the very beginning. We had Sequoia suing us at one point, so that's resolved. Again, I cannot comment on that outcome or on the details, but that's completely resolved. No issues anymore. So we just have lawyers handle it. One of the tricky things in this world is that. In the world I was brought up in, at least the values I was taught, you're innocent until proven guilty. Having somebody suing you is a standard. Well, not a standard. Is a normal part of a business process. But today, many people think that as soon as there's a lawsuit, you're guilty, which is not the right. I don't think that's the right perception. So we'll let the lawyers figure it out. Unfortunately, in this kind of situations, all the lawyers tell you to not comment on it. So I can't comment on the specifics, but we'll see. Yeah.
Yeah, I think what's interesting is that this sort of goes back to our first interview where I was asking you these questions. But yeah, we'll see how this plays out, because I think these were things that a lot of people were wondering about, and now we'll finally get our answer. Um, excuse me. So another kind of controversial issue recently was that Obviously, so we're seeing now that more and more blockchains are using delegated proof of stake. And because of that, some people are concerned about the power that exchanges might have in those systems because of the coins that they hold for their users. And a good example is what happened with the Steam blockchain when Binance initially helped the Steam tokens on the exchange, or used the tokens on the exchange to help Justin Sun as he took control of Steam. And then Binance later reversed course and helped a fork of Steam called Hive to basically remove some of the control that Justin Sun had. So why did Binance change directions with Steam, and how do you think exchanges should handle the power that they have in these delegated proof of stake systems with the coins they have?
Yeah, so to be very frank, and I said this openly a few times already, which is we didn't know it was like a contentious fork. So we go through many wallet upgrades, right? So blockchain upgrades. Whenever there's a blockchain upgrade, it's very often a soft or even a hard fork. And typically the core developers will contact us, say, look, there's a hard fork coming. You guys need to upgrade your wallet and support it. We just follow the instructions, really. So they give us a detailed level of instructions. We look at it, we just follow it. And so when this was the Steam soft or the fork was presented to me as a upgrade, and I was asked, just said, well, yeah, let's go for it. So I didn't even
And who were you asked
I did approve it. My team.
Who
my
asked
own
you?
Team. So we have my own team talked, and actually I didn't talk to Justin before this. So their team was talking to our team on the wallet upgrade, and my team asked me, hey, it was a standard like rubber stamp process where they say, oh look, there's a wallet upgrade. Are we gonna support it or not? And say yes. So that was the extent. Afterwards, the Steam community went ballistic. And I was like, oh, okay, well, that's not very good. So I made a mistake of not realizing that, which I fully admit and take responsibility for. And we do not want to get involved in governance, blockchain governances, weighing our opinions, etc. Especially, we don't want to use our users' coins to do that. So if we want to weigh in, then the only way we would do that is to make a vote feature on Binance.com so that the guys we have a weighted vote according to their balances. And then we use that to vote, but we don't even have that feature today, because we don't really want to get into that. And so after the fact, and Steam works in a very strict way. Once you vote, like what they call power up, which I learned afterwards, then when you power down, it takes 13 weeks to unlock. I think we're still probably in that process, or maybe we're probably near the end of that process. And so as soon as we discovered, we reversed course. We said, look, this is not something we want to get involved with. We did what the community asked. The community still have some resentment on the actions that we took. They think we caused the fork. But the fundamental fact is, after we reversed the actions, Justin Sun probably has a lot of financial, ability to influence that anyway. I didn't look at the data, but for a while, the Steam coin price was going up because both sides were trying to buy more Steam to vote. So we've seen that happening. I didn't really look into the details of that. But from our perspective, our principles are very simple. If it's not a contentious fork, if it's a regular upgrade, we definitely support it. We support the blockchain ecosystem to grow. So we have a standard process. Now we added a check to see if there's a contentious hard fork. But normally we'll just support an upgrade. But our principles is we do not get involved in other people's blockchain governance. That's for their community. That's for whoever holds those coins. So we want to stay neutral in terms of other blockchains governance. We're not interested in that. So one of the interesting things is, right now there is somewhere, I would say, for any coins between like 10 to 30% of the coins on exchange on Binance. Specifically. So for any delegated proof of stake consensus mechanisms, they have to design with this in mind. So ideally, you design with this in such a way that it's either easy for people to withdraw coins from the exchange vote and not have those coins locked for 13 weeks before they can redeposit and trade, or have a way for exchanges to be able to vote on the user's behalf. So we will never vote on our behalf using the user's coins. So there are those kind of questions which are being considered, and someday we may want to support it. But it does raise the question that of some of the blockchain designs where when they design it, some of them have very simplistic designs where they just assume everyone holds their coins in their own wallet, and they never trade, and they just buy it and spend it. But the world is not that naive. So we just have to take that into. I just hope that other designers of blockchains take that into consideration. But our principles are very clear, very simple.
In November, the block reported that Binance had 2 Shanghai offices that closed after being visited by local authorities. And then in February, after some media outlets described Binance as being Malta-based, the Malta Financial Services Authority issued a statement saying that you were not authorized by the MFSA to operate in the cryptocurrency sphere there. So where is Binance headquartered?
Well, I think this is the beauty of the blockchain, right? So you don't have to where's the Bitcoin office? Bitcoin doesn't have an office. So we have people around 50 places in the world, and actually just to make the record correct, just to set the record, the block article saying that we had a police raid that did not exist. Police raid on a Binance office. So that was pure fake. And within 12 hours of that post, the BNB market cap dropped from 2.6 billion to 2.2 billion. So they actually that fake article actually had a very material impact on the BNB holders. So they actually really wiped out $400 million. Yeah.
But just to clarify, I mean, so the block did admit that police raid maybe wasn't the term, but to say that you guys were visited by local authorities checked out in their opinion. Are you going to dispute that?
I don't even know. So I think the story carries a very much different weight if you say, well, a government official visited Coinbase versus the police raided Coinbase. I think those two things are very, very different. So you can't really yeah.
But to say that the office closed after the visit from local authorities, are you going to dispute that?
So yes, I am. So again, there were so basically again also at that same time there was a Chinese CCTV visit of an office in Shanghai where they reported it was a customer support office. So it's an outsourced customer support office. It's not even Binance office. So again, so yes, I openly disputed that. So I think people have all this traditional mentalities they have. They're trying to classify what kind of horse is a car. So you have to have an office. Wherever I sit, it's going to be in a Binance office. Wherever I meet somebody, it's going to be in a Binance office. And you have to have an entity. You have to have a headquarters. You have to have a bank account. All of those things don't have to exist for blockchain companies.
Well, I mean, but even to do things like to handle, taxes for your employees, like I think you need a registered business entity. So like, why are you obfuscating it? Why not just be open about it? Like, the headquarters is registered in this place. Why not just say that?
Well, we don't so we don't really we just don't. It's the same thing as why don't you admit you're some kind of horse? We're not a horse. We're a car. So it's not that we don't want to admit it. It's not that we don't want to. We want to obfuscate it or we want to try to hide. I'm not hiding. We're in the open. I'm on Twitter every day. I go to physical conferences. So we're not hiding. But it's just like, why don't you go back to this old way of being? I mean, we're not that. So,
I mean, so what are you saying? That you're already some kind of DAO? Or, I mean, what are you saying? Because it's not the old way. It is actually the current way. And until you can say, like, we're officially a DAO, like, I actually don't know, what you are or what you're claiming to be.
So let me put it this way. So I don't think we're a DAO in most of the definitions of a DAO. I think that's kind of a binary definition. You're either a traditional company or you're a DAO. I think we're just a team working together really well, and we build a platform that works. And we have multiple places we work. Most of it was actually we mostly work from home even before the coronavirus quarantine. We work in 50 different countries now. We have a large team that works together to a common goal. It's just a new type of organization. I wouldn't classify to be
And
honest, if we classify it as a DAO, there's going to be a lot of debates why we're not a DAO. So I don't want to go there either.
yeah, I mean, nobody would call you guys a DAO. And can I ask where you
Yeah,
are right now, where you're doing stay at home?
yeah. I'm in Asia, so it's 7 p.m. here, so it's 7
Where
a.m.
in
your time.
Asia? Where
Hmm?
in Asia?
I, I, I prefer not to disclose that. I think that's my own privacy.
All right. Well, that's going to have to be where we're going to end because it's now 8 a.m. and that's it. Thank you
Yes.
so much, CZ, for making this fireside chat happen, especially last minute. And I hope everybody enjoys the rest of Ethereal. And did you want to say
Thank
any
you.
last words?
Yeah. Sure. Thank you, Laura. And I always
Okay.
appreciate
All
the
right.
tough questions. It actually makes an interesting conversation. Cheers.
Yeah, I appreciate that you are willing to take my tough questions. I hope we can make this happen
Okay.
again.
That's fun. It's fun.
All
Yeah.
right,
All
great.
right. See you later, Laura. Yeah.
Everybody enjoy the rest of your Ethereal. Thanks for listening.
Cheers.
Hello, and welcome to the first ever Ethereal Virtual Summit. I'm Jesse Grushak, one of the co-founders of Ethereal, and I'm so glad you could join us on this lovely Thursday morning. The weather seems to be about 68 and sunny, though it's been that way for a while. I don't really remember the last time I left my apartment. All quarantine jokes aside, this is a momentous yet tumultuous time in our history. There's never been a better time to learn a skill, program, adapt, or create a life-saving device on a hobbyist 3D printer. The tides are changing as society shifts from consumerism to survivalism. Society is going completely digital, and the current pandemic is showing us how important that is. As I sat down to write this introduction, I decided to reflect on the past few years of Ethereal Summit. Ethereal was created out of a desire to connect people and ideas, and what started as a small idea on an uninfected cruise ship blossomed into one of the most anticipated events in the blockchain space. We're in our 4th year of Ethereal, having done 5 gatherings in 3 cities with 4 satellite events. However, this is the first time we've gone completely digital, much like the rest of the world. And personally, I'm more excited about this event than ever before. Ethereum and blockchain technology is about to have its moment because, as we've stated in the past, the internet is broken. However, this time it's different. This time, it matters. During the past few months, the internet has become responsible for our birthday parties, our news, our work, even our funerals. Everything has gone digital. And as we're gathered here today, we know a new internet is coming, with a new operating system for human beings. And to some folks, this might sound like science fiction, but to others, the architects in the blockchain space, those who are joining us today, those who are creating the decentralized, open source, and peer-to-peer systems that we've known, it's time to realize these creations. I'm super excited to be here with an incredible team, and I'm going to pass this over now to our wonderful head of operations, Amy Crimmins, to share what's going on today.
Thanks, Jesse, and good afternoon, everyone from sunny London. We have 2 days jam-packed full of panels, keynotes, and roundtable discussions. The best way to make sure you know about everything that's going on is to be registered to our email newsletter. You can still do that now at etherealsummit.com/register. I'm pleased to announce that the Ethereal Summit team, along with Gitcoin and CoinDesk, have launched the New York Blockchain Week COVID response. We aim to raise $100,000 for the COVID-19 response of 12 different charities. The funds will be allocated using the quadratic voting system. You can find out more on our website, etherealsummit.com/news, and we'll keep you updated with the rolling total during the event. If you're in the position to donate, we would really appreciate it. The hashtag for the campaign is NYBWGives, New York Blockchain Week Gives. On a lighter note, during the event, some trigger images will appear on your screen. If scanned, these give you the chance to win food delivery, swag, and many other prizes. It's well worth getting involved, and you can find out more again on our website, etherealsummit.com/capture with a K. More on this shortly.
Hi, everyone. Welcome to Ethereal Virtual Summit. We're excited to bring you this virtual summit during a very difficult and uncertain time for many around the world. I'd like to take a moment to thank our amazing sponsors who make this event possible and give a special shout out to Aave and Taurus for coming on board as our exclusive partners. I hope you all enjoy the event and have a great day.
Hi, everyone. This is DeFi Dad. Thanks for joining us. I was going to shave and to brush my teeth and to shower and to change my clothes. But I thought that that would be disingenuous to representing the luxurious lifestyle I am living in quarantine. So thank you so much to everyone for making the effort to join us. I know it takes a lot to find a quiet place in your home. I wanted to remind you that with over 200 speakers joining us the next 2 days, there's a lot happening in the agenda. We've designed the agenda so that depending on your interests, you can choose your own path. And so you want to look at etherealsummit.com/agenda to make sure that you're not missing all of these different talks happening. So on etherealsummit.com, you'll see the MEO live stream happening. However, if you click into the schedule and you see all of these live stream talks in white and purple, you'll also see these cards that indicate that you just click this to join that talk or that roundtable or that breakout session or that workshop in a Zoom room. And then in addition to those purple cards, there are also some VR talks that are highlighted in black. Same thing, just click on it and it'll take you to that part of Crypto Voxels where the talk is happening. There are a few talks tomorrow happening in AltSpace VR. If you have an Oculus headset or any VR headset, just look up the AltSpace VR app. And when you click on the menu, once you're in the app, it'll show you the different talks happening, which it'll show Crypto Mondays. So the Crypto Mondays VR space is where we're hosting that. And thanks to Lou Kerner for allowing us to do that. So other than that, I'll hand it over to my peer, Dror. Dror, take it away.
Thank you, Travis, and good morning from Boston. And now it's time for us to get to work. I would like to ask, as we asked at all of our Ethereal Summit, that you treat this as an experiment. We are going to be learning a lot, making some mistakes, and hopefully getting to see some of our wonderful speaker children. Please adhere to the code of conduct and make the next 2 days full of amazing and insightful experience. In just a few moments, we will be joined by the co-founder of Ethereum, Vitalik Buterin, who will be having a fireside chat with Camila Russo.
Hi, everyone.
Hi, Camila.
Hey. So everyone, welcome to this fireside chat with Vitalik. He hardly needs an intro. He's the creator of Ethereum, basically why we're all here today. And I'm Camila. I'm the author of The Infinite Machine, a book on the history of Ethereum. I'm also the founder of The Defiant, a content platform focusing on decentralized finance. So in this interview, I want to talk about the present situation we're living in, the present situation for Ethereum, and the future for Ethereum. So starting out, I want to address this unique global situation where we're entering a global financial crisis. So the last big financial crisis is what gave way to Bitcoin and the first wave of crypto believers. And so I'm wondering if you think, with so many similarities with the 2008 crisis, people losing trust in institutions, do you think what we're living in now will spur a new wave of crypto adopters and believers?
Yeah, I mean, it's a very good question. I've definitely thought about this quite a bit. And I think there's some similarities between the crisis in 2008 and what we're going through now, but there's also kind of quite a few differences, right? So like one of the big ones, for example, is that 2008 was basically entirely a financial crisis, and kind of the main things that were happening are very kind of financial in nature. And, you saw the Bitcoin blockchain with its Genesis block, say kind of the times on the brink of a second bailout for banks. But 2020 is not really a financial crisis first and foremost, right? Like first and foremost, it's a virus crisis. And then on top of that, it's a political crisis following 5 years of nonstop political crisis of some form. There's a crisis in epistemology, kind of how people learn kind of what's true about the world, essentially. And there are definitely financial elements, like there's obviously all of the money printing going on, and there's kind of, talk about a few people in the US government wanting to delete some of the Chinese government's money, and there's a couple of other things happening. But kind of the financial side is definitely not like the biggest part of the story. So so it's kind of both similar and different, right? Like it's the similar part is that there's definitely this kind of failure of institutions and this kind of desire to see if we can come up with something different and better. But at the same time, crypto is kind of inherently born as this kind of very financial thing, and so there is this question of going forward, is crypto going to continue to be a financial thing? Are there kind of non-financial elements of kind of non-financial problems in the world that crypto should try to do something to address? Is it some of both? And I mean, I think those questions are challenging.
Yeah. Okay. So you don't think this will necessarily spur, like, I guess, like, where I'm thinking of this is, so yeah, like the response that we're seeing to this crisis is central banks having, like printing trillions of dollars, companies taking this opportunity to really censor their users in some cases. Mm-hmm. We've seen it with Medium, mm-hmm. Twitter, and governments in some cases infringing on people's kind of privacy and liberties. People have reacted pretty strongly in the US to that. So yeah, that's where I was kind of going, like, will people see this as, okay, maybe we should find an alternative?
Yeah, no, so I think like the concerns around censorship, the concerns around privacy and all of those things and also the concerns around just institutions failing at doing their job, they're all very real. I think the point that I was making is more that kind of the cryptocurrency space, it has currency right in the name, has been kind of, at least for the first maybe decade or so, has been really focused on kind of financial aspects and kind of censorship resistance of money. And there definitely has been this older kind of decentralization and censorship resistance space with things like, Tor, decentralized social networks, Scuttlebutt, BitTorrent, and all of these things. But historically, it's always felt to me like kind of that's one space, and the blockchain space is maybe a sister space, but it's kind of separate. And there's lots of people in kind of one world that think the other world is a scam. But here in 2020, like, we're definitely seeing a lot of those same themes, but it's just kind of somewhat less financial than before. Like there's still elements of kind of financial, but whereas 2008 was 100% financial, this might be like 1/3 financial. And so I kind of wonder, like how that would lead to this decade being different from the last.
Yeah, no, it's a good point. Okay, so I wanted to still, kind of have you imagine the situation where this thing, leads to really a loss of trust in the dollar. Maybe China has its own very controlled digital currency, and people start seeking refuge in crypto. What do you think Ether's role should be there? Like, can it become a reserve global currency? Is it a store of value? Is it the thing that makes Ethereum network work for decentralized applications? What do you think ETH's role is in that situation?
Yeah, so I think alongside kind of the big crisis, there's definitely a lot of kind of other trends that are happening at the same time. So the trend of kind of CBDCs and things that are not quite CBDCs but seem to be kind of angling close to that, like Libra. And then on the CBDC side, you have China's DCEP, you have all of these other governments starting to look into it. And at the same time, I think there's definitely this kind of element of more and more kind of political discord and political distrust over time. And so within countries, but also between countries more and more. And I definitely kind of think that there's a role for blockchains and Ethereum in particular to play in being this kind of neutral global layer where all of these kind of systems, currencies, and applications can interact. That I think kind of anything kind of created and maintained by nation states can't play that role. So Ethereum as kind of some kind of glue network between all of these different international platforms, I think could easily happen. They might have to think about kind of what that would entail. Ether as an asset, I think if the Ethereum network ends up being used, then Ether is kind of the most natural and base asset to use in a lot of Ethereum applications. And so it'll definitely end up kind of playing a very significant role as well. Like if you have an application inside of Ethereum and you want an asset that kind of within the context of the Ethereum ecosystem is completely trustless, then Ether is basically it, right?
Okay, so in this scenario where people are turning to a more global, trustless system, you think Ethereum could be the network that connects people across the world, and Ether the main asset that they're using?
I think so.
Great. Okay, and then so I asked on Twitter, for people to tell me what they wanted to hear from you, and a lot of people were interested in just like more mundane, things. So if I may ask, what does your daily schedule look like these days, and are there any things that you do to boost your productivity and creativity that you can maybe recommend the rest of us?
So I've been reading a lot of different kinds of things. I've gone through a bunch of books over the last month and a half. I've been doing a lot of kind of studying and deep diving into new kinds of cryptography and a fully homomorphic encryption, which is kind of surprisingly less scary and difficult than I expected it to be. So trying to learn, trying to kind of keep talking to and working with everyone on the ETH2 side as much as I can. Also, have a treadmill where I'm staying, and I often end up kind of being on the treadmill and listening to things at the same time, which seems to be surprisingly effective. You just kind of have a call, and then you get 8 kilometers in for free. It's great.
Yeah.
So trying to do
you listen to any podcasts? Sorry.
Yeah.
Where do you listen to?
So sometimes it is just kind of crypto-related videos. Something totally not crypto. There's a friend recommended to me this podcast called A Hardcore History, and it's just these incredibly long 4-hour podcasts on just historical topics. So I went through a bunch on kind of the history of the Japanese Empire. So I thought that was really interesting.
Very cool.
And then
learning a lot. Cool. Okay. I think that's something we can all take advantage of in this time. Just getting our minds working if we can't get our bodies moving more. Okay.
Absolutely.
So switching to the present day for Ethereum, I guess the biggest thing going on, but I might be biased because I'm writing about it every day, is DeFi. So, wanted to ask you a bit about the space. Are there any DeFi dApps that you regularly use, and if so, which ones?
I have a bit of money in being a Uniswap liquidity provider. I have obviously kind of used DAI in a lot of cases. I mean, Uniswap itself is really useful and powerful. Uniswap is just nice because it's really simple and convenient for a lot of things. So, for example, when I downloaded Status and I needed 10 Status tokens to register my username, you could just kind of go to Uniswap and just grab those Status tokens within one transaction. I mean, I've definitely tried out some of the other DEXs. I've tried out Loopring. I've tried out the Optimism Synthetics demo that came out a couple of days ago. And I still want to try out ZeroX at some point. So just, yeah, so go.
No, go. Didn't mean to interrupt. Sorry.
Thinking, the exchanges and the assets are definitely a big one. And then you could obviously argue that just kind of Ether as a medium of exchange is also a kind of DeFi, right? Payments is part of finance. And I've definitely used Ether to pay for things from time to time as well.
Yeah. So what did you think of kind of the newer DEXs like Optimism that just came out and Loopring?
They're definitely doing a better and better job of being a kind of competitive with centralized exchanges on user experience. So one of the nice things that Optimism does, right, is that they have this model where you have a sequencer, kind of this, it's kind of a central party, except it's kind of reassigned, or the plan is to reassign it once in a while by auction. So it's kind of on Twitter, I made this kind of mini thread a couple of weeks ago about what I call kind of bounded centralization, where you kind of have a centralized actor for efficiency kind of surrounded by decentralized kind of scaffolding that prevents them from doing anything really bad, and you kind of tightly constrain their scope. So they do that sort of thing. And so basically, in any case where the sequencer isn't kind of breaking, you get kind of an immediate kind of pre-confirmation from the sequencer after about 500 milliseconds, and the sequencer then kind of basically puts out a kind of crypto-economic bond that says they'll include this in the next block, right? And if they don't include this in the next block, then this crypto-economic bond, this ETH that they put down, can just get burned. So that's nice. Loopring and I don't think they're doing that, but I think even still, both of these systems, the Optimistic and the ZK, they can go up to kind of over 1,000 transactions a second, right? And so I think a lot of people are not appreciating that, there's people saying that kind of, sharding has a high risk of being incredibly far away and all those things. And I think, first of all, sharding is closer than people think. But second, even if that's true, over 1,000 transactions a second, that's potentially a 100 factor increase from where Ethereum is today. And you need these kind of technologies that have roll-ups that are basically, one of them is in beta and the other one of them is already live. So that's something I'm very happy about.
Yeah. So, do you think, are these DEXs kind of demonstrating that, the DeFi space can continue growing and serving maybe a larger audience than it is now without having to wait for ETH to launch?
Absolutely. I think DeFi definitely has a chance to kind of continue growing and start serving more users. I think the fact that it's improving usability is huge. We saw how Uniswap came along and just massively raised the standard for usability in decentralized exchanges. And with Uniswap, there's obviously the concern of, how do you handle kind of large volumes of trading that you can only handle well with order books? And now we're starting to see, there's both this kind of 0x style off-chain order family, and now there's also this roll-up based kind of fast on-chain family. So that's been great. I think stable coins, the fact that they've been just kind of running stably for a while is great. I'm also looking forward in the stablecoin space to seeing other synthetic assets. Like I think we shouldn't just have synthetic crypto dollars. I think you should have synthetic S&P 500, synthetic other stuff, other currencies, other kind of world assets. Potentially even kind of synthetic assets that are representing things that don't even exist in the real world. Like you can have something pegged to the CPI. You could do lots of things, right? So that's one side, and on the other side, we want kind of more innovation in oracles. And the other thing I want to see is a kind of more governance minimization. Like I think in general, if you have a system where kind of governance is really, really active and they're proud, and if they're very proud of the governance being active, but at the same time, like there aren't really limits on the role that they can play, and you create a system that it has more backdoor kind of opportunities for being hacked. It has more risks in it, and sometimes there's benefits, but at the same time, like I also want to see people building more kind of simpler systems of the simpler variety.
Oh, that's interesting, because it has been kind of a big trend in DeFi recently for these platforms to move towards DAOs and governance tokens. Like Compound did recently with its Comp token. Synthetics also wants to do it. Kyber with KNC. So the space is definitely going in that direction of like tons of like active governance with tokens. But you're right that it does pose a risk. Like it opens up the system. It makes it more complex. So it makes it more vulnerable, right?
Yeah, so and the way I think about this, right, is that the lower level your application is in the stack, kind of the more it should be de-risked and kind of maximally simple, and the higher something is up the stack, and if the more it can be more complicated and kind of more powerful. So that's why I say that I'm kind of both pro governance minimization in some contexts and pro kind of pretty radical governance experimentation in other contexts. Like I think something like a stablecoin, for example, is very low level, and we should be seeing more kind of governance minimized stablecoins. But something like Moloch DAO, for example, like the fact that Moloch DAO exists, I think is great. And then there's like Gitcoin grants and kind of quadratic funding. And when you talk about quadratic funding, well, for that to work at all, you need to have some kind of identity system, you need to have anti-collusion and all of these things, and that already kind of really ratchets up the technical requirements. So you need both, and it's a matter of kind of knowing like whether you're doing a low-level thing or a high-level thing.
Right. It's like I think with time we'll start to see which platforms actually need these government systems and which don't, and are just better off with more simpler systems. And with these tokens, because I think we're still in this point where projects are trying to figure out exactly how to use tokens, and a lot of them are, like trying to figure out a right business model with their token, and so governance plays a role. Like, they're trying to give their tokens utility by having them be a vehicle for the community to participate. So, I'm wondering if it's not governance. How can like platform-specific tokens be used and given utility, or do you think there shouldn't be as many platform-specific tokens?
So I think kind of advertising governance as the primary value of a token is kind of a bit wrong-headed. And the reason why I think it's wrong-headed is that, I've written blog posts about this, right? Like basically kind of marketizing governance of public resources just because of how the economic equilibriums work kind of inherently leads to plutocratic outcomes. Right? And the reason why that's the case is because, like, if you imagine two people, like Alice and Bob, where Alice has, say, $1,000, Bob has $1 million, then Bob will obviously be able to afford 1,000 times as many governance tokens, right? And so Bob will kind of have the ability to get 1,000 times more influence, which you might say is fine because Bob's 1,000 times bigger than Alice in an economic sense. But at the same time, the amount, basically because the amount of influence that Bob can get is 1,000 times bigger, but the amount of benefit that Bob can get from each unit of influence is also 1,000 times bigger, right? Like if Bob has 1,000 times higher kind of probability of affecting some outcome compared to Alice, but because Bob has more money, Bob also kind of in monetary terms gains or loses 1,000 times more from how each outcome goes, right? And so there's some sense in which kind of Bob's influence is quadratically larger, like you have 1,000 times the other 1,000 than Alice's influence. And so I think basically if people really do value tokens primarily for governance value, then the equilibrium will end up being that there would be just like maybe 4 or 5 very rich people or potentially funds or exchanges that'll end up kind of buying them up, and you'll lead to a fairly centralized distribution, right? So that's my concern. I think in general, the value, like people should view the value of tokens more as basically being kind of discounted shares of future revenue, essentially, right? Either that or as kind of utility tokens where you gain utility if you hold a token. Like, and both models are kind of economically fairly legitimate. Right, so like for example, the way that they work in MakerDAO, where you have MKR, and then that MKR might get burned, and it is being burned over time, I think is totally cool. Tokens of the model that say, if you either burn some amount or if you are holding some amount, then you can have some ability to do something within the platform. I think those are cool too. But yeah, making token models is definitely hard, and there's definitely projects that where I think they do have a token. It doesn't really make economic sense for them to have a token, but we have this kind of ongoing crisis in this space that there's a lot of kind of public goods that can't really be funded unless you kind of awkwardly slap a token onto them, and so right. I don't like the behavior, but at the same time, I don't blame the people because we are kind of in these difficult circumstances, and so they're trying to do the best that they can.
You're right. It seems like we still haven't really figured out what how exactly tokens should make this business models work. But okay, so and I wanted to switch to kind of the risks that we've seen in DeFi recently with, there's been so many hacks and financial attacks on these platforms. And, was kind of thinking back to the ICO days where it seems like the fatal flaw for ICOs it attracted a bunch of scammers because the incentives weren't really aligned, and then regulators shut them down. So with DeFi, do you think a fatal flaw for DeFi could be that it's just because of its nature, it's vulnerable to attacks, and then it attracts like a bunch of hackers, and then that draws regulators to shut it down?
I definitely don't think that all DeFi is vulnerable to attacks. There's plenty of kind of more responsible DeFi projects that have successfully survived for a pretty long time without getting attacked. So like the most recent one, right, it was just a project that basically copied Compound's code and just did not understand what they were copying with it and started monkeying around, and kind of got lucky that they were able to find the hacker and force them to return the money pretty quickly. So yeah. It's definitely not an inherent property of kind of DeFi itself, and there definitely is a way to do DeFi responsibly. But the way to do DeFi responsibly kind of unfortunately has to do with like basically you can't your goal, the thing you're marketing in a DeFi system should not be performance, right? It should not be, oh, this has an interest rate of 8%, our competitors have an interest of 6.5%, therefore we're better, right? Because the reality is that the probability per year that any one of these systems breaks is probably still larger than 1.5%. And like people should definitely not be competing on saying, oh, this other thing has collateral requirements of 150%, and we only have collateral requirements of 130%. Like, no, please don't compete on those dimensions, right? The thing you should be competing on is basically like, can you make a system that's simpler? Can you make a system that has kind of fewer moving parts and kind of fewer potential backdoors to it? And we should be aiming toward just getting a few basic building blocks kind of running stably for some amount of time. So now there is, of course, the question of, well, are the incentives in building a DeFi project potentially skewed so that people would value kind of grabbing for users as much as they can over minimizing risk of getting hacked? And so those projects all act in a way that's risky, and so some of them kind of succeed and then bash themselves up over time, and others have incredibly big splats, and they only suffer a small portion of the cost of the splats, and they just say, like, go say, oops, sorry about that, and they kind of walk away. And meanwhile, the regulators get angry at the whole space. Like, whether or not that kind of market failure exists, it might. I mean, that's it's definitely an interesting question. And if there are things that we can do to try to kind of counteract that kind of incentive, we certainly should.
I mean, the reason why I said, DeFi is maybe more vulnerable to attacks than, other kind of less open and decentralized applications is because the code is out there for people to see and like find ways to exploit. And at least like that's what DeFi applications are trying to do. And even trying to remove the team's control over the app is something that most applications are working towards, but can also minimize their level of response at the times of attack. So how do you think, like, what's the right way to balance those goals, like having an open and decentralized system, but also keeping users safe?
And so I think like centralized finance systems get attacked all the time as well, right? So, you have Mt. Gox in 2014, you have Bitfinex in 2016, you had kind of a couple of regular Korean exchanges in the last 2 years, and you had some other Bitfinex kind of situation. So there's definitely centralized financial systems definitely do get attacked kind of over and over again, and they definitely have these kinds of consequences over and over again. We just kind of talk about it less because, well, we're kind of half, used to all of these systems having kind of bad security, and we're trying to come up with newer systems to have better security. I think there's the way out. I think has to do with a couple of different things, right? One is that I think because the code is open source, one of the benefits is that you have a lot of people looking at it, and so if you have a lot of people looking at it, we want more people to be kind of actively going in and auditing other people's DeFi projects and kind of making sure that they work. Another thing is that some of these DeFi projects, they have what get called kind of admin keys or admin backdoors in certain respects, and in the early stages of a project, like, there's sometimes value in that sort of thing, but at the same time, it poses a risk. And then sometimes people do kind of the smart thing, which is they have these kind of partial backdoors where the admin can do one thing, which is potentially just like shutting down a project to everything except for withdrawals, and they can't do anything else. So having better practices in that regard, I think, is important. But there's definitely a limit to how much we can do at the end of the day, because there's always the possibility that some project will come along that just like doesn't care about any of these things and just cares about kind of users, and kind of let's make a big blitz and go quickly. And we should just try to do what we can and discourage that sort of thing.
Yeah, I guess there's a lot of responsibility on the side of the users for now, just like informing themselves of, has this platform done an audit? How, the team behind it, has it been tested? Like all these things before actually, putting money in. Okay, so I want to go now to Ethereum's future, which I guess like the biggest thing in Ethereum's future is ETH 2.0. And so for those who don't know, ETH 2.0 is an entirely separate chain from Ethereum's current chain that will adopt proof of stake instead of proof of work, which is a consensus algorithm that kind of where nodes agree on transactions, and it also will increase scalability with sharding, which breaks the main chain up into smaller pieces. So in this transition, the idea is to have kind of a one-way bridge between ETH1 and ETH2, right?
Yes. So basically, at the beginning, kind of during what we call phase 0 and then phase 1, there's going to be a one-way bridge from ETH1 to ETH2, which is basically just there for staking, right? So if you want to stake, you take your 32 ETH, you deposit your 32 ETH, and then you become a validator and you can start staking. The thing that will happen after phase 1 is this kind of merging event where you basically take the kind of existing state of phase 1 of the ETH1 chain, and you just kind of cut it out of the ETH1 chain and you kind of paste it into the ETH2 chain. And then from that point on, ETH1 becomes just sort of part of the ETH2 system. And at that point, you'll be able to kind of freely move between, being an ETH1 kind of participant and being an ETH2 validator.
Okay, and then the ETH1 old chain just dies. Like it becomes too hard to use, and like the expectation is for everyone to migrate.
Exactly.
And okay, and then with ETH2, where exactly will the ETH1 chain be like transplanted to? Like, is it going to be its own separate shard? I think that's kind of one of the ideas I read. Okay, and then so one criticism I've heard about having the entire ETH1 chain on one shard is that does that have the potential to start running into the same scalability issues that we're seeing now with the current chain?
Right, so the idea is that the ETH1 chain on one shard is not going to be a kind of the only execution thing that runs, right? Like there's going to be other shards, and I mean, worth considering kind of either copies of the ETH1 system on other shards or potentially kind of systems with somewhat different rules on other shards. So applications are going to be able to live on other shards, right? And so if there's not enough space on one shard, because the whole point is that you'll be able to jump to the other ones.
Right. Okay. And then you wrote about this, but I still, wanted to talk about it. Is whether having different applications on different shards, especially in DeFi, where the whole system is so interconnected, does having applications on different shards make it harder for these applications to connect? Like, will sharding break DeFi composability?
And I think so. Applications on different shards can still communicate to each other, right? The main kind of limitation is that they can communicate asynchronously, right? So instead of kind of having a back and forth communication within one transaction, you're going to start one transaction that creates this receipt, what we call this kind of cross-shard message, and then a second transaction on the other shard that kind of later on, usually in the next slot, kind of consumes that receipt and performs some action. And it turns out that for most use cases of interaction between applications, kind of asynchronous is enough, right? Because either you can, payments you can do asynchronously, a lot of things you can do asynchronously. And we also have this mechanism called yanking, where if you need to interact synchronously with something, then kind of first you move your entire contract over to the other shard, then you do whatever synchronous interacting you want to do. And then if you want to, you can move back, or you can just stay there until you need to do something else. So we've definitely done considered a lot of things to make cross-shard interactions easier. Now, will applications be able to still talk to each other more if they're living on the same shard? Yes, and we're trying to kind of improve the other case as much as we can, but there's definitely kind of inherent limits, right? Because you can't make a sequential scale, kind of a scalable system that supports arbitrary interactions, because someone could always create an application that just says, the first thing calls the second thing thing calls the third thing calls the fourth thing, and all the way up to 10,000 things. And so, because, that would basically just kind of force the system to have one computer that's capable of processing all 10,000 transactions, which breaks scalability, right? So, like, there are kind of inherent and unavoidable limits to what you can do within the context of a scalable system, but we're trying to do as much as we can within those limits.
Right. Okay. And then, okay, so we talked about what kind of the limits of ETH2. So what are some of the applications that you think would be possible in ETH2 that aren't possible now?
I mean, the applications would be kind of fairly similar. It's just that they would be a lot more scalable, right? So there's definitely a lot of people that wants to build many kinds of applications. And a lot of the time it's something in the enterprise context, like something to do with every time there's a transaction of a certain type, then kind of save some kind of record onto the chain. And even things like consumer payments, whether that's with ETH or with stable coins, various kind of non-financial applications, and even using kind of things like ENS, just using the blockchain for storing certain kinds of information. There's a lot of things that people are starting to do already, but people are not really doing that much because you have these potentially 20, 40 kind of cent transaction fees. And if you have ETH2 and you have much more scalability, then those transaction fees drop by a factor of 100. And so, the trade-offs become a lot more favorable to those kinds of things running on a chain.
Right. Okay. Okay. And then what are some of the risks that you're most concerned about personally in the migration of ETH1 to ETH2?
I mean, I think there's obviously kind of the risk that on the technical side, we'll run into just more roadblocks and challenges than we expected. That's probably the big one. I mean, in terms of kind of community and political risk, I'm definitely less concerned than some other people are. I guess, I mean, one of the reasons is that a switch to proof of stake and sharding has been part of the Ethereum kind of social contract since almost the beginning. And so there would be just kind of too many people that would be upset if it gets delayed for non-technical reasons. And also kind of a lot of the people that kind of don't believe in that vision already moved over to, say, Ethereum Classic during the DAO fork. So yeah, I'm definitely less kind of concerned that there would be any disruptions from the social side. So there's risks that we see and of unanticipated technical challenges. There's, I mean, also just kind of the ETH2 system and kind of the upgrade to the ETH2 system, and it is taking up a lot of resources, and you have to building a fairly complicated new system. You have to audit it. You have to write the spec. You build all the clients, and there's just looking at the kind of the expense of building out that ecosystem and upgrading existing parts. And it seems like everything is fine in that regard, but you never know.
You never know.
In general, I'm very confident about the transition.
Okay, and I mean, this is a question you get asked all the time, but I have to ask the timing. What's the latest on that? On all the different phases? When should we expect them to launch?
Yeah, so for phase 0, we have a testnet already, right? So Prismatic released a Topaz testnet a couple of weeks ago, and the Shirazi testnet was released a few days ago, and now the Shirazi testnet has, as of yesterday, 3 clients on it. So he has Prism, Lighthouse, and Teku is the third one. So we're already at the point where we have a testnet that has 3 clients on top of it. So that's roughly the equivalent of where ETH1 was a few months before launch. So Now the question is just a matter of like how long do the audits take, or kind of how many bugs do we end up finding? Like how long will it take before we can see a network consisting of all three types of clients with a lot of users and of working stably? So I mean, it seems like a few months for phase 0. And then, I mean, phase 1 and the merge are definitely harder to predict, right? Because there's more work left to be done on those. Yeah, and then on the ETH 1.x side, I think we're seeing a lot of progress, right? So like, we're seeing Beam Sync with another mind releasing kind of already. There's a lot of work on kind of account abstraction and EAP 5059, and there's a lot of people that want to make kind of one or more of these major upgrades by the end of to the kind of ETH1 ecosystem by the end of the year. So we'll see.
Okay. Okay, so a couple of months for phase 0, and then for phase 1, do you think it would be this year or sometime next year?
Phase 1, I definitely expect to be next year.
Okay. All right, and then to finish up, like, what are some of the applications that you're looking forward to getting built this year?
Definitely kind of more stable coins and kind of more synthetic assets and oracles of different kinds. More kind of more governance experimentation and more kind of DAO type things. And I've been kind of very excited about the progress that Status has been making, kind of a Ethereum and a Whisper-based decentralized chat application. And that's been making a lot of progress. There's a lot of what else is there? Just the kind of the community of people are kind of building many thousands of small things, some of which I haven't heard about until someday I just kind of wake up and someone tells me, or I find out from the internet that like, hey, there's this entire company that's kind of publishing some kind of records of all of their purchases to the Ethereum blockchain or whatever. Also, I think kind of cryptocurrency and stable coins for payments. I mean, I think like that's always been kind of one of the original dreams, and I think with the kind of improvements in user experience that we're going to get this year and the next, I think it definitely makes sense to start making another go at that. So.
Great. Okay, so I think that's a good place to end. Looking at the future, I think it's so cool how you've unleashed Ethereum into the wild, and now there's thousands of people building on it. And like you said, you don't even know exactly what's being built each day. And it seems like stablecoins will continue to be an important theme this year, and making the dream of actual peer-to-peer payments possible and easier, right?
No, thank you very much.
Yeah, it was great chatting. Thanks so much.
All right. Yeah. Do you hear me, guys? Does it work? Yes. Yes. Great success. Nice. All right. So, okay. Today we're going to talk about DeFi and money markets. Now, basically, what's important for me to showcase a bit is what basically Aave is for DeFi users and in the ecosystem, based on kind of like a user experience and what different kind of users think about us. So I made it this kind of like a quick questionnaire on Telegram, basically why people use Aave. And one of the things mainly is that people want to earn interest on their stable coins. And basically, some of the reasons are that in DeFi, you basically can get benefits that are better than in your traditional finance. So you see that the traditional finance is kind of like working against you in terms of, for example, this comment on where a bank charges negative rates, which is happening, for example, in Switzerland. And of course, in general, like one of the things why people use DeFi or Aave or any other protocol is that you basically have 24 access into the industry-leading yield. And besides that, you basically have instant available liquidity. And of course, like one of the coolest thing is that as a kind of like a composability implementator, for example, if you're building something on top of Aave or in the DeFi ecosystem, that's basically a building block for you. And then, of course, like we do a lot of memes in general. But the idea of this slide basically is to tell like how diverse the whole DeFi ecosystem is today, and how kind of like the different kinds of protocol, whether it's lending or automated market making protocols, how they actually facilitate liquidity into this space. And all this kind of like different building blocks are actually providing more value to the ecosystem by consuming each other. And one of the interesting stuff is that Aave was launched a few months ago, exactly January, 5 months ago. And this kind of like, we all know that liquidity is a network effect in DeFi. And most of the liquidity that we have in the lending pools that we have, each lending pool is basically a money market. And currently we have one money market, is based on the kind of like building blocks that are currently in DeFi. For example, there's some of the building blocks are basically liquidity swapping, for example, 1inch or Paraswap, or for example, build something on top of our protocol, such as fixed rate advanced interest forwarding, such as, for example, Blazor, 88 miles per hour, and so forth. So there's like a lot of projects here I could chill enormously. But the point of this slide is just to show like that like each and every protocol that we have in DeFi is basically kind of like a cement, and it provides more structure into the thing that we're actually building for the future. Now, like this is like a cool thing that actually we think as the whole like Aave ecosystem as a kind of like a family, and every integration brings liquidity, more people into the family, and more kind of expansion to the whole DeFi ecosystem on Ethereum. Now, one of the stuff that we had also in the protocol launch was flash loans, and it was like a feature that wasn't that much kind of built upon in the first place, because it's a developer feature. So in terms of like flash loans, you have liquidity available that you can actually consume without having that basically. So one of the interesting stuff that happened recently was the Black Thursday, where actually the flash loan liquidity went quite up, and that's mostly of DeFi Saver implementing a feature where you can close your CDP without actually returning your loan. So you basically take a flash loan, close your CDP, and sell that collateral and return the flash borrowing and keep the rest of the funds yourself. And you can have, for example, similar ways to actually create leverage margin positions with using flash loans, or basically collateral swaps, swapping your MakerDAO collateral And then there's even like a no-code flash loan functionality by Furocombo, where basically you don't need development skills to execute a flash loan. And of course, there is a collateral where you can actually take vast amount of flash loan liquidity. So like the interesting part here is that what we're doing with the flash loans is that we're reusing the value that's locked into smart contracts. So pretty much when we look at DeFi in general, we usually tend to look at try to measure like how much value is locked into the smart contracts. But what's important to understand is that we also need to understand how to reutilize that particular value. And DeFi Saver implementation and the Black Thursday is a very good example. I think only on that day, DeFi Saver saved roughly 2 million worth of CDPs during that particular day. And here's pretty much an example. When I popped off, then you go gave me just a little bit. Yeah. So the point, kind of what I'm trying to say, is that like each and every protocol that's on the DeFi ecosystem doesn't basically live in a vacuum. It's more about like the composability, because like the flash loan feature itself was kind of like a tool in the toolbox of developers to build different kinds of interesting things. And I was brainstorming with Marianne Conti from MakerDAO about kind of using flash loans to swap BAT collateral to ETH collateral in their wallets, and asked that someone could build this thing. And basically on Twitter, there was a guy named David Trong, who actually in 4 days built the whole collateral swap thing. And then Fiona, which is basically just a DeFi user, came and actually used that particular tool. So it kind of like showcases the composability on Ethereum, that it's not just basically technical composability, but also there's like a lot of human composability involved. And here you see kind of like a situation where you have a developer tool, and there is basically a product build, and also there's end user actually using that product in the whole composability process, which is for me very cool example. Yeah, here's an example how the collateral swap works.
She says she wanna dance, but she don't know how to. I'm iced out, ooh, looking like a star. Ooh. Her name is Jenny, ooh, bitch don't have no panties. Ooh. I'm Steph Curry.
Yeah, so basically it's just a tool that you can actually flip your collateral in MakerDAO without returning your loan. It's a simple application, but very useful. And there's tons of things that basically people are building now on top of the kind of like DeFi foundations now. In general, like what I wanted to talk about here, besides like the background information and what's going on our side, is pretty much like the money market ecosystem. So if you think about it, like in general, money markets is kind of like a liquidity pools. It's like a big ocean, and I think DeFi itself is very good representation of this ocean, because anyone who plugs into the system, so basically when you have DAI or ETH and whatnot, you can basically participate in this particular pool. So if you kind of look at the DeFi pulse, you will see this particular picture of the ocean. And what's interesting in this kind of like ocean picture or the seas is that there's different kinds of currencies. And I see like similarities here in terms of when we look at into the DeFi space, that liquidity moves from one place to another. And then similarly, we have the same thing happening in oceans, kind of like as a representation. And what's interesting here is that even though like the whole ecosystem is connected, so you can access from one protocol to another one, each and every protocol has their kind of like own peculiarities and own parameters, how the liquidity is or should be structured. So basically, there might be different kinds of currencies, stable coins, risk, and those kind of like base how deep the liquidity is in specific money market. So I think how we see now DeFi is basically the previous picture, but we know that basically there's different kinds of liquidity flows and liquidity needs. And I think in the future, like there's specific kind of like markets of DeFi where you might not have the same, for example, assets as a collateral or stable coins to borrow, but you have some particular risk profiles that you can actually want to package and use in that particular money market. And good example, for example, is the if you look at some countries like Finland. So we see in this particular picture that there's the Baltic Sea, which is actually the connector into the basins and the oceans globally. But as a sea, it's pretty much different than you expect to have, for example, in close to Japan, the Sea of Japan, or in the Pacific. But also, what's more important to understand, like besides those particularities, differences in the basins and the seas, is that you actually have a lot of lakes. For example, in Finland, it's called that we have a land of thousands of lakes, and it's pretty much true. And I see kind of like the money markets of future in DeFi acting a bit of a similar style. We will have like very big liquidity pools. We'll have like the interconnector DeFi liquidity where anyone can access. There will be different kinds of basins there. For example, there might be Aave money market and alternative money markets out there. And what's interesting in this kind of like a lake view is that those might be also kind of like closed pools for different kinds of reasons. So there might be, for example, that the counterparties want to know each other, or they want to keep the liquidity pool, lending pool in the existence of few counterparties that basically they trust, or they don't want that liquidity or that action to be seen by everyone. It could be even like a ZK pool in the future. And also there might be different reasons regarding to, for example, regulation and so forth. So like what I see in the current space is that we are now forming like the ocean of the money markets, which is the kind of like very foundations of the DeFi ecosystem. And now in the future, we're starting to get more and more like concentrations of liquidity in this ocean, and also like different kinds of lakes of money market protocols. And one of the things like what we are now working on Aave and actually releasing is basically a kind of first secondary money market pool. And in this particular pool, we are using Uniswap as a collateral. So what it actually allows us to do is that liquidity providers in Uniswap can actually use their Uni tokens and park them into the new Uniswap pool that we have in Aave to basically leverage out to borrow, for example, stable coins and leverage their current Uniswap liquidity provider functionalities there. And at some point, you can also borrow those Uni tokens, for example, if you want to hedge your different kinds of positions. And as an experiment, this is pretty fascinating because it's kind of like a first time ever we're doing anything like this. And it really provides interesting functionality for the whole DeFi ecosystem. And we get this kind of like a derivatives of market capitalizations around the Ethereum DeFi ecosystem. And like it's kind of like pretty simple. If you are interested in trying out and seeing how the system works and using kind of like Uni as a collateral, we currently support Ropsten. So we launched it a few hours ago publicly. So basically uniswap.aave.com, and you can basically try it out. And once we are more confident with the launch and our audits on the smart contract is finished, basically we are releasing this thing on mainnet, and that's very fascinating. And you still have the kind of the main pool that we have in the protocol, but also there is now this secondary pool. And the idea is to basically add those different kinds of basins of seas, and besides of that, also add those kind of lakes where you basically need the liquidity to be disconnected. And the key difference here is between that ocean example and the DeFi ecosystem is that you can actually connect those lakes with the ocean whenever basically those pools are ready for that. And the main thing is, of course, like we always talk a lot of risk recently because of the different kinds of events that has happened in the DeFi ecosystem. And one of the most important things is that we have some sort of like a governance how we create new pools or how new pools are added into the protocol, and basically how we manage the risk there. So everything boils down to the kind of like a macro and micro governance. So we have the Aave protocol where when there's a new pool that could be added into the protocol, so everyone can create a pool, but eventually to get into the protocol-based insurance where we're using a staking mechanism where value is staked as a first line of insurance, and there is the second line of insurance where basically there is minting of a collateral in case of worst case scenarios with a built-in backstop system. So the idea here is that basically when we are increasing the depth cap in the protocol by adding this new basins of seas or lakes into the protocol to support them, we need to ensure that there is enough capitalization to ensure if something goes wrong. For example, if the collaterals lose their market value in certain amount of time. Now, basically, that's the kind of like a way how we govern the money markets and provide more security there with the insurance functionalities. And also, like, the idea is to incentivize that behavior within our protocol. But besides that, I think one of the issues in the governance today that we have seen recently is that the power is on the holders of certain kinds of monetary policies, which is, for example, the token, and less value is actually in the people who are actually using and consuming that liquidity. So besides the kind of like a macro policy that I explained a moment ago, we also have micro policies. For example, that will be lending pool specific changing of parameters to adjust liquidity, and those things are governed with a token. So all of the depositors are able to participate in that kind of like a macro governance, and it really might seem like a valuable proposition for the whole like current governance systems that I have seen recently. And yeah, pretty much the idea is to have a positive feedback loop. When we create more depth, we should be responsible enough to incentivize basically the insurability of those money markets. And it's interesting to see like how this dynamics will work, because if we have overly amount of debt that we can't insure, the debt just becomes pricier. So it's a way to actually reduce cost of the debt markets that we have. And yeah, so this is basically the team working behind Aave, and we're very proud of what we have achieved so far. We also go by the name of Avengers, and if you want to ask anything after the talk, for example, you can join our community in Telegram or in Discord, aave.com/Discord. And pretty much that was it for today. So, yeah. Thank you, everyone. And
Okay. I want to share my screen though. Okay, probably this is the way. Hello, everyone. My name is Loy, and I'm the CEO and co-founder of Kyber Network. Super excited to be here at Ethereal and to talk about Kyber and how we have been powering the decentralized liquidity for DeFi. Yeah, but first of all, let me just double check if it's working. 1 second. Is it working? Oh, okay, awesome. Okay, let's continue. It's on Vimeo, so sorry for the issues. Okay, so I think most of us are aware that decentralized finance is a major blockchain and cryptocurrency use case. And in order to facilitate DeFi, we really need decentralized liquidity. But I think so far there haven't been much a definition for what a decentralized liquidity is. So this is really our attempt that we have been trying to do for a few months to define decentralized liquidity. So simply put, decentralized liquidity is the liquidity that is available on the blockchain. So what that means is that there has to be a trustless relationship between the liquidity providers and the takers. And all the parameters rate, amount, who is the liquidity providers, who's the taker, must be transparent and verifiable. And most importantly, decentralized liquidity must be utilized by decentralized applications. What that means is that it must be accessible or composable by smart contracts, and there shouldn't be any hidden trust issues or anything that go to some centralized servers. So far there have been a few popular on-chain liquidity sources that we call decentralized liquidity, including Uniswap, Kyber Reserve, Oasis, Bancor, and also Gnosis, DashX. But currently they all work in silo, right? That means they are all scattered around, and it is very hard for any dApp to find the best rate or to even find enough liquidity, right? When it comes to taking from decentralized liquidity. That's why in the last couple of years at Kyber we have building our protocol to really aggregate all the diverse liquidity sources to enable all the decentralized trading in any applications. This is the best of how Kyber works. Bancor, Oasis, and also DashX, and this will provide the simply one single interface for any application, be it Kyber, and they what they really need to do is they just need to send a transaction right to our Kyber smart contract, and they can get the best rate from all the available liquidity sources. And this is one simple example of how a DeFi app can leverage Kyber. This is for an index fund platform, right? Here we have end users that want to buy a set of tokens, right? That has 30% of DAI, 30% of WBTC, and 40% of Link. And what they really need to do is just to send one single transaction with the Ether to the index fund smart contract. And the index fund smart contract will just call to our Kyber smart contract, and Kyber will just find the best rate available for DAI, BTC, and for Link, and to do all the corresponding trade and return all the asset back to the end users. And everything happens on chain and in one single transaction. This guarantee atomicity, right? So that means if either if one of the assets failed to be acquired, then the trade won't happen, right? Everything will be reverted. And it offers full transparency as well, because everything is on the smart contract. This is the ecosystem that we have been building so far. I think you could have you can see a lot of similar and popular names here, including Miter Wallet, Trust Wallet, Engine, Status, and HTC Exodus, and many others. We also have a lot of DeFi application like Set Protocol, Aave, Melonpot, and InstaDApp, and many others. So really, I think there are a few things that differentiate Kyber and that allows Kyber to efficiently provide very good decentralized liquidity. First of all, we run everything fully on chain, right? That means all Kyber operations are done on smart contract. So this, as I mentioned earlier, it offers full transparency and verifiability, right? And all the DeFi application, they can do a lot of trade within one single transaction by just calling to our Kyber smart contract repeatedly, right? And by running fully on chain, we also offer a very straightforward integration to all the smart contract. So basically, it's already composable to them, right? It's already compatible to all this existing smart contract, so they can just form their own smart contract. They can just call to Kyber, and that's it. And the integration is very simple and very easy. And because we aggregate liquidity from different sources, that's why by design, Kyber always has the best rate, because we combine from different sources and we pick the best rate to return to the ticker. And we also support different ways for people to contribute liquidity. I talk more about it in the next slides, but basically we have 3 ways for people to provide liquidity. Depending on their background, their need, their capital, and many other things, right? So we have the ultimate price reserve that is similar to Uniswap, but it's much more capital efficient. That is meant for the token teams and the individual token holders that want to contribute liquidity for their own token. We have the Fed Price Reserve, or FPR, that we really design and spend a lot of resources and time and team effort to design, to build. And this is for the professional on-chain market makers. And we also have the Bridge Reserve that mainly connect to other existing on-chain liquidity sources like Uniswap and Oasis and many others. So as I mentioned earlier, automated price reserve on Kyber is a capital efficient version of Uniswap AMM. Basically, it allows automated market making with customized pricing and very low maintenance costs. And basically for the same size of inventory, our APR can effectively serve more other AMM like Banco or Uniswap. But I believe in version 2 of Uniswap, they have some optimization, and it would be interesting to compare the two. For the Fed Price Reserve, so we believe that automated market making is a really good tool for us to bootstrap the liquidity, right? But in order for DeFi to have like massive and big and serious liquidity, we really need the professional market makers to be part of it, and that's the mission of our Fed Price Reserve. Basically, with Fed Price Reserve, we can allow for advanced and custom pricing strategy from professional market makers to be done on chain. We have a lot of tool sets and that are available for on-chain market making. And in fact, I think we already have, at least 4 different market makers, professional ones, are providing liquidity on Kyber using the FPR tool that we prepare and build. So if you are professional market makers out there, please reach out to us, and we would love to work with you. Yeah, so I think in the last couple of years, we have spent a lot of time and resources to grow and build our ecosystem. And now I think we are confident to say that Kyber has, I think, one of the largest ecosystem of integration and partners in the space, right? And now that we have built something that is worth governing, I think we are ready to ask ourselves, right? What's next for Kyber? And we really think that for Kyber to be more sustainable, we need the active support from different stakeholders from the broader DeFi ecosystem. And that's why we want to empower currency holders. We want to empower other stakeholders in the DeFi ecosystem to be part of Kyber and to really steward the decentralized liquidity ecosystem that we have been building so far. With that, we're launching Catalyst in end of June. It is an important protocol upgrade for Kyber with a new token model. I think I'm running out of time, so I'm gonna talk briefly about what Catalyst is and what you can do with it. So what's new in Catalyst? So we are gonna launch Kyber DAO, or the first decentralized governance for Kyber. In which a lot of important decision and network parameters are going to be met by the DAO. There's going to be staking mechanism for currency holders, right? So in order to be part of the Kyber DAO, they have to stake the currency and they have to keep voting on all the campaigns that the DAO has. And they're going to receive the reward for their contribution. There's also improvement to liquidity contribution. It's going to be much easier for market makers to contribute liquidity to Kyber. We also have a new customizable fees for takers and dApps, basically the existing integration. Yeah, so for the DAO, as I mentioned earlier, the currency holders can stake currency and they can vote on all the campaigns. Basically, it's going to be around the network parameters, like what's the fees, how to distribute the fees, and in the future, it's going to be what's the development decision that Kyber should focus on and things like that. And the reward for the DAO will be very interesting because it will actually come from the network fees collected through the trading activities in the network. So I believe this is going to be one of the first DAOs that distribute the reward to the DAO members through the revenue of the network, not by issuing more tokens or more coins. So it's going to be the first staking token with potentially a deflationary model where the token burns and the staking rewards are to be determined by the DAO. And we also allow the DAO to decide, how much of the network fees collected will be distributed back to the market makers, as just to them to contribute to all the market makers or the reserve. They no longer need to hold KNC to be part of the network. So this will reduce, one friction point for them. And I think as the team and also the community will spend a lot of time and resources to reach out to more professional market makers to onboard them through our APR. So you can expect, the liquidity on Kyber is going to be a lot better compared to what we currently have. And for the taker, so now we allow them to really set their own additional fees on top of the network fees. This will basically allow them to be more innovative on how they want to generate their revenue. And we also have things like reserve routing, so that the takers can decide where they want to take the trade from, and they can also optimize for the better rate return by the network. So really, our goal is to allow the developers to innovate and to build much more innovative application on top of Kyber. And I believe most of them are going to be around decentralized finance, and so they don't have to worry about their liquidity issues. Yeah, with that, I think with the launch of the Kyber DAO, the success of Kyber's protocol will now be in the hands of the currency token holders and also the broader community as well. And we aim to be the single on-chain liquidity endpoint for DeFi, onboarding more professional market makers and introduce resources. And also provide more tools for people to be part of the liquidity contribution. So we really, welcome everyone to work with us. If you have any idea, please feel free to reach out to us. These are the few ways that you can, and if you have any question, I welcome you to ask the question there. We have our Twitter and also have our community Discord. Yeah, thanks a lot for listening, and yeah.
Hi, everyone. I'm Simona, and I am a Chief Engagement Officer for PIPO and OST. And I'm going to be chatting about empowerment versus power today, and really looking at the evolution of economies and how we can potentially build better ones. So without further ado, because we are on a tight schedule, here we go. So one of the main things that I want to take us through is really what are the main differences between the two concepts. So power versus empowerment, if we look at some very basic definitions, we see that power is very much geared towards a more selfish stance. It is very much around a capacity to direct and influence the behavior of others, whereas empowerment tends to be a much more, let's say, democratic, much more giving stance where authority and agency is given to somebody to do something. And so really this change of dynamics is pretty much, as far as I'm concerned, what we are all trying to do here by redesigning and re-engineering models to serve the many versus the few, and also enable and equip everybody from individuals to communities, wherever they may be, with the tools needed for thriving. And so if we look at those individuals and communities, initially, we look at some very, very basic definitions of community, which are mostly and most of the time related to a physical space. And this is very much how communities were defined for a very long time. But what I like to draw your attention on is that third definition of ecology, which is actually a group of interdependent organisms. And this is kind of where I feel we are beginning to think back towards and also look at this interconnectivity and collaborative stances in the rebuilding of communities and economies in the Web3 world. And so what this means is we're moving towards a one-dimensional view of ourselves as humans and our roles to a three-dimensional view, to a 360-degree view. And what that leads us to is this evolution from community 1.0 to a community 3.0. And it's these communities 3.0 that will be the makers of these economies that are built for thriving. And the way I kind of look at this is an evolution that takes us from these small units, this very, very physically bordered, let's say, entities, to a 360-degree approach where we aren't just cogs in a machine and in a market, but full participants to the global processes of life. And what that does is that it brings us to these very, very interesting points where we move from, again, a position of static, very one-dimensional roles to these ingredients that are needed for thriving, because certainly we do not have these right now. And what I mean with by these, and I'll go through them very quickly, is changing the goal. So we should be moving, and I feel this is the prime moment to be moving from a GDP-obsessed kind of stance to a meeting of human needs position. Moving from a self-contained markets to embedded ecosystems by seeing the big picture. We're moving from nurturing from these very rational economic cutouts that economy textbooks have taught us that we are, to a place of nurturing human nature, because we are actually very social. We're depending on the living world, where we're very interconnected with each other and our surroundings. Getting smart with systems is all about ever-evolving systems and ever-evolving dynamics versus just a simple supply and demand curve. Designing to distribute, this is all about going beyond redistributing income and looking at redistributing wealth, particularly, again, when it comes to wealth that's in land, in enterprise, in knowledge, in technology, and the power to create value and the power to create money. Because, again, this is all about getting ourselves into a place where it's much more of a thriving dynamic versus a very power-driven one. Creating to regenerate. Clean environments, we've somehow gotten to this conclusion that they are a luxury. They're not. When we get to a really regenerative and redistributive economy model, we end up recreating and regenerating and really building these circular versus very, very linear processes, which is definitely something that we should be moving towards. And then agnostic about growth. This is something that I feel is potentially the most difficult one, but it is about creating and redesigning these economies to from a need to grow regardless of whether they make us thrive, to making us thrive regardless of whether they grow or not, right? So that balance needs to be a lot more secure. And so, because I mentioned the these kind of one-dimensional measurements or metrics, it gets us to this Kuznets curve, which I'm sure everybody's familiar with. There's also an environmental one that talks about those clean environments that I was talking about. And this image and this theory has been disproven, but it is still very much at the in the top kind of concepts that economic students learn. But actually, and this essentially says that inequality is a given. You have to have inequality when you have growth, but in time that peters out and it balances out. The point is, it doesn't. But what we don't realize is that actually inequality is not an economic necessity, it's a design failure. And this is a great quote from Kate Raworth, who has written about donut economies, and a lot of the content here is from a lot of the research and a lot of the writings about the fact that we need to redesign these models. And actually, we're in the prime spot to do this. This is a great snippet from Albert Mee's keynote at ETH London, one of the last in-person events that we attended. And it is incredibly exciting because it's true. This is the first time in such a long time that so many parts are available to us to be worked on, to be put in the service of rectifying these design flaws that we have kind of put up with for so long. But maybe this is the time when we can change those things and really make a difference. And so I absolutely love this quote. And what that gets us to, because we have all of these tools to play with, it gets us to the ability to build these open source circular economies. And I like to call it a recipe because I think, with all of the cooking happening during quarantine, maybe we should be cooking this. And these are the main ingredients. So modularity, and we know this from from open source, but if we apply this to broader economic models, it really has the opportunity to get to systems that work because they are open source and not despite the fact that they are open source. So modularity is a key one. Parts are easy to assemble and rearrange. I think this is very, very important. And it's something that is incredibly relevant to us building software as well. Open standards, these components need to be designed to common shapes and sizes so that, again, that modularity is very, very simple and accessible. Open data, information on location and availability of material. This, as an ecosystem, we have a little bit more work to do, but educating, making sure that people know what is available, where it is, and how, have those instructions there is incredibly important to come back to that empowerment piece, right? We shouldn't be hoarding them. We should bring them to the light and make them very, very accessible and readily available. And then transparency, of course, allowing for improvement and adaptation of that recipe. And this, again, is all about empowerment, being able to have all of those moving parts and adapt them to your specific needs, to your specific problems, to your specific communities is incredibly important. And this, again, is something that we need to keep in mind when we are creating and reshaping current models. And so what we get to is a flow of networks. By enabling this open source economy redesign, we get to this point, which actually is incredibly relevant to us in Ethereum and in Web3. It is this network of flows, because a distributed network, you have a much more equitable distribution of income and wealth, and being able to map everything to this and to these flows is going to benefit us all, and again will put us in that thriving mode versus the usual linear top-down kind of dynamic that we have gotten used to, but really we're all hating and wanted to change, because that's why we're here. And so with all of these things in mind, with all of these principles and all of these recipes, and the fact that we are ready for these things to happen, we get ourselves into this regenerative by design economy. So right now we have that very linear flow without the lovely wings of regenerate and restore. We just have take, make, consume, use, and that's it. And so by enabling these wings, by enabling these extra elements that really should be there because they are part of natural systems. Again, we forget we're part of nature. We're like nature. So these are the natural flows that we should be replicating in our economies. And what that means is sustainability, right? Communities can implement those solutions based on those local needs and resources. The focus on thriving, we get to a place where we aren't obsessed with growth at all costs, which, by the way, no economist has ever looked at what that diagram looks like, because really where does that get us? Exponential growth all the time ad infinitum really isn't sustainable. And then resilience. So one of the main things that we have seen time and time again, and yet again, we are in this place with the current situation, we just do not have resilient systems. So increasing diversity boosts resilience. And I put there biomimicry, which is a concept that's been used by Robert Dulanovich and Janine Benyus. And it's a very, very important piece, because actually this diversity really is key. And it's something that we do not have, particularly when it comes to our monetary situation, which is a monetary monoculture that we have been perpetuating for way too long. And I want to give this example because I want to show you a very, very simple illustration of why diversity means resilience, and why we should be, doing our utmost to promote diversity. The panda only eats one type of bamboo, and it's been on the endangered list for a good many years. The gray squirrel, on the other hand, eats anything. It will eat bugs, it will eat nuts, it will eat, I don't know if you're in New York in Central Park, maybe it will eat a whole bunch of other paraphernalia, but it's doing incredibly well because it has a diverse diet. So diversifying really does make organisms and systems much more resilient. And what we get to by this diversifying of not just value and how we define value, but also the monetary culture, or breaking that monetary monoculture that we are in right now. So diversifying value, again, we have been so obsessed with money is the only way to measure value. But actually, if we diversify the different types of value that we take into account and that we guide our transactions by, the human value, the social, the ecological, the cultural, the physical, there are so many more. And breaking the monetary monoculture, again, is about breaking that monopoly of the current currencies that we use, and then redesigning currencies, not just money flows. This is, again, a very important piece. And again, it puts us in prime position to be looking at a finance in the service of life, not life in the service of finance. And I want to just cover a couple of these complementary currencies, because actually, breaking this monetary monoculture has a lot to do with diversifying currencies and diversifying how we structure currencies and how we produce them and how we interact with them and how we transact with them. So these are two great examples, and please feel free to research them further. There are many others, by the way, but the Swiss Weir is a great example. Created in 1934, it was to be between 16 people. They were all owners of businesses, and they decided to have this complementary currency working alongside the Swiss franc. It's several peer-reviewed papers are, assigning Switzerland's thriving stability to its existence. And then the Torquez is another great example in the Rabot district of Ghent, where again, it wasn't a thriving community. And so this was introduced to exist at the same time with the euro, but the spending within the community was done with Torquez, and then the euro was used for things like taxes and bills. Very, very important, and again, a very interesting way of diversifying currencies and diversifying money, so that we aren't constantly in the situation of all eggs in one basket, which again, clearly is not a resilient thing to do. And I want to leave you with this meme, because again, we love a meme. And this is actually, the metagame team came up with this, but I think it's a great illustration of this evolution from power to empowerment, from a very static economic cutout and a very selfish stance to a much more thriving stance. And it gets us to this Homo economicus, which actually is a persona in economic studies that is very, very focused on this monetary side of things and is very, very focused on growth at all cost. And then you have the meta sapien who is very much about being part of a community, being using their skills and their value that they put out for the betterment of the whole. And it's very much focused on this redesign for thriving. So I think these are the main things that I wanted to touch on. And again, I will say that we are in this very, very fruitful time. And I know we sometimes get sidetracked, and I know we sometimes focus on the wrong thing. But if we keep these principles and these elements at the forefront of our mind when we build things and when we create things, it really puts us in this incredible place of redesigning things for thriving. No longer the same models where we constantly deal with crises, we constantly deal with inequality, and it's an opportunity that for decades we haven't had it, yet here it is now. So I would like to thank you so much. And here is where you can find me. I would love to continue these conversations. I think they're incredibly important. Thank you, Ethereal. And Ethereal Virtual is looking good so far. So congratulations, team. And thank you very much.
Hey everyone, it's great to be here talking at Ethereal this year. My name is Hugh Karp and I'm the founder of Nexus Mutual. Often to work out how we progress, we kind of need to look back in history to understand where we've come from. So I'm just going to give you a little bit of history about where insurance has come from and risk sharing and where our vision of it is for the future. One of the earliest records of insurance is from around 3000 BC, where Chinese river merchants used to spread their cargo amongst different ships. And then this way, if one of them sank or capsized, only part of the individual's load was lost. It made the risk was shared together in the community fashion, and society became much more resilient as a result. Moving to 1754 BC, the Code of Hammurabi was introduced. And amongst other things, it allowed the transfer of risk from merchants to moneylenders. And the loans were in fact written off if the merchandise was lost or abandoned or stolen. And it's actually quite important because this is one of the first examples of risk being specifically transferred from one group of individuals to another who are more able to handle the risk. Expanding on this further, the Phoenicians and Greeks invented bottomry loans. So the way this worked was backers of merchants would provide a loan to fund a voyage, and they'd profit if the voyage was successful. But if the ship's cargo was lost to pirates or bad weather or for any other reason, the loan would be written off. And this is the kind of the first commercialization of insurance that's starting to grow and expand. Returning more back towards community-based solutions, craftsmen in the Middle Ages would often join a guild. It provided them many benefits, but what they would do is they'd pay an annual membership fee. And it'd also include support. For example, if their workshop burnt down, the rest of the guild would pay to rebuild it. Or if they died, their family would be looked after. So these became the first versions of more kind of formalized life insurance policies. In the 17th century, insurance started being backed by individuals or even groups of individuals. Ship owners or merchants would publish a sheet of information to describe the cargo, the destination, and any other pertinent information about the voyage. Those who then accepted the risk wrote their names under the description and the terms. And this is where the word underwriting came from. So these groups of these underwriters discussed the deals and the terms in Lloyd's Coffee House, which then later became known as Lloyd's of London. And this brings us up to insurance, I guess, as we know it today. Big insurance companies diversifying risk across product lines, geographies, and many other factors. Commercialization of the process has been pretty much completed. There's a heavy focus on capital efficiency, including regulatory arbitrage, where risk is shifted to the most favorable jurisdiction, where perhaps the regulations are a bit lax or less capital needs to be held. Alignment of interest is now at its weakest, with end consumer and insurance company directly taking different sides. Heavy regulation is required to address two main issues. The first one being agency risk, which is essentially the risk of the insurance company managing the money on the customer's behalf. The money insurance company holds is essentially there to pay future claims and after taking a fee. So if that's mismanaged and the claims can't be paid, it creates big issues for society. So regulators step in with many rules, requirements, how that money should be managed, how much capital, how much money should be held, and make sure the people with the right skills are in the right places to do it appropriately. The other main reason for regulation is heavy information asymmetry between the customer or the insured and the insurer. It's very hard for the general public to know how reliable or how solid or stable a particular insurance company is. So the regulator is there to provide minimum standards and transparent reporting on the financial position. I've alluded to this a few times so far, but this kind of gets to a fundamental concept in insurance, which is actually about connecting the customer who has risk with capital that wishes to take it on. The entire evolution of insurance has actually been driven by the relentless need to optimize capital efficiency. The more effectively insurers can coordinate capital with risk, the more profitable they will be and the lower the end cost to the consumer. If we go all the way back to the Chinese merchants, both customers and capital are effectively together. Capital is relatively small because the customers aren't deep-pocketed. They are merchants and traders trying to make a living. They're essentially just sharing risk together. In this model, interests are much more aligned as capital is intrinsically linked to the risk. They're effectively in the same group. But this model often struggles to scale because the capital can only be accessed within that small group. It can't necessarily grow big. It must remain within that community or is constrained by the size of that community. As we move to the shipping merchants, the money lenders step in and start providing capital. Risk starts being transferred further from its source as it's easier to access capital from outside the community. The commercialization process starts. With Lloyd's, the drive for easier capital formation continues. Wealthy so-called names provide the capital. They even join syndicates that jointly back specific risks, and the commercialization process continues, and the capital moves further and further away from the customer. With modern insurance, capital is now very distant from the end customer. Capital efficiency is very high, interest alignment is low, and frictional coordination costs of all parties are high. There are many parties in the value chain, and so much of the process is still manual and paper-based. This results in at least 30% of the premium being lost in inefficiencies. If you walk around the square mile in London today, then you can see just people, mainly men in suits, working around with folders full of paper, still ferrying information from the insurance companies or the reinsurers to Lloyd's and other capital backers to sign terms and agreements. Nexus Mutual's aim is to bring insurance back to its roots of community risk sharing. The difference is that we now have Ethereum to supercharge the capital formation. Token economics and incentive mechanisms can give us new tools to massively reduce coordination costs. And this is what Nexus Mutual is fundamentally about. Efficient capital coordination where all the benefits are handed back to the members of the community, and rather than being passed on to capital markets and for shareholder profit. It's all about handing the benefits back to the members of the organization. We're starting by offering a community-based solution for crypto native risks. Insurance is fundamental financial infrastructure for every economy. If you need to build a bridge, you need insurance. If you launch a satellite, you need insurance. If you build a railway, you need insurance. Doesn't matter what you're doing, really. Insurance is just there. Problem is that crypto and DeFi and Ethereum virtually have no access to insurance. It's really hard to get to regular institutions or regular insurance companies to provide any meaningful cover. They are there on the edges, but they've got a long way to go. So essentially, we're building a community-based solution to tackle these risks ourselves. Our first product is smart contract cover, which can be used to protect against bugs in Solidity code. It's a community-based solution for a community-specific problem, but it's just the start. Nexus Mutual's vision is actually much greater. The protocol can be scaled to cover any type of risk. It can cover crop insurance, earthquake cover, shipping, and I'm sure many other product lines. We've created a generalized platform that we should be able to price any risk that we wish to, as long as we get enough members and enough scale to do so. Our goal is for one day Nexus to be a competitor to the large insurance companies, but one that's fundamentally different. one that hands all the efficiency and coordination benefits back to its members, one that works for its customer base and its membership organization and gives them all the benefits of sharing risk together. Keep it short and sweet, but if you'd like to find out more, then head to our website or message me on Twitter. But yeah, thank you very much. It's been great to present.
Hi, everyone. I think I'm live. Yes, I am live. Fantastic. So hello, everyone. Thank you so much for joining me here today. My name is Matteo Liebowitz. I'm a research analyst at The Block, and I'm going to share some thoughts on the open finance value proposition. So hopefully by the end of this, I've convinced everyone that the pursuit of growth in open finance is a legitimate and worthy cause. So we only have 20 minutes. Once I'm done with definitions, I'm going to walk through one case study and hopefully illustrate how it reflects some of open finance's core tenets. So let's start with definitions. I think open finance broadly refers to financial services and products, things like lending, exchange, derivatives, asset management, payments, that satisfy the following two properties. So the first one being permissionless, the second transparent. And it's these two properties that distinguish open finance from legacy finance and naturally also form its core value proposition. So today we're going to be looking at these terms through the context of MakerDAO, our case study. For those that are unfamiliar, MakerDAO is the Ethereum-based credit facility that allows any user to lock up collateral and draw a synthetic US dollar-pegged stablecoin DAI against the value of their assets. So that might be a lot to take in at once. Hopefully, over the course of this presentation, I will shed some further light on how MakerDAO actually works. So let's start with this term permissionless, and really referring to this idea of unencumbered and non-discriminatory access. So I think when it comes to MakerDAO, there are really two perspectives to consider here. First being protocol agents, so those that are interacting with the service being offered, and then third-party developers, so developers who are building on top of the MakerDAO protocol. So if an open finance product service is permissionless, it means that anyone in the world with an internet connection and some ether can access it regardless of their geography, their age, their gender, their race, their political affiliation, etc. So who are these protocol agents? Well, in MakerDAO, we have 3 core agents. It's a slightly simplistic view, but here we go. So first off, we have the borrower, and they are seeking to borrow USD denominated debt against the value of their crypto assets. Then we have savers, so they are seeking dollar denominated savings, and also low volatility store of value. And then finally, we have the governors and underwriters. These are the entities that set monetary policy and risk parameters, and also serve as the lenders of last resort within the MakerDAO system. And in return, they receive some portion of the interest that is generated by these borrowers. So how does permissionless access actually improve upon the existing experience for these agents? So let's start with the borrower. Really, we're talking about access to financial services for previously excluded demographics. So let's think globally. As I'm sure you'll know now, there are about 1.7 billion unbanked globally. If we think domestically, in the United States itself, which is the largest economy in the world, there are 55 million people that are either unbanked or underbanked. So they are not being served by the existing financial system. When it comes to things like opening a margin trading account, which is kind of analogous to the product that MakerDAO provides, you need a $2,000 minimum to open one of these margin trading accounts. So that's pricing out a significant portion of the population. And then often you also face with accredited investor requirements. Even just locally, if we think about, and locally being, it's a loose term of the word locally, but if you think about the existing cryptocurrency market and market participants, financial services are jurisdictionally constrained and predominantly concentrated in areas like North America and East Asia. So if you're residing in Latin America or an African nation, then often you're not going to have access to these types of cryptocurrency related financial services. The second core benefit for borrowers is this idea of eliminating data-related issues. This is really by design. So by foregoing know your customer processes, protocols simply cannot leak sensitive financial-related information. So on the bottom right here, you see a headline, BitMEX exposes customer email addresses. That's absolutely not going to happen with one of these open finance financial services. And you know, there are various different examples here, Equifax being a big one from last year where they leaked hundreds of millions of social security numbers. Now let's turn to the saver. So again, you kind of have the same unbanked, underbanked implications as we discussed with borrowers. So this idea of access to savings account, no minimum to open one of these accounts. And then you also have access to global access to US dollar denominated savings. And that's particularly significant in the context of hyperinflationary currencies. So about 2 weeks ago, there were riots in the streets of Lebanon due to the inflation of the Lebanese pound versus the US dollar. And we've all had similar stories in Argentina, where the peso is down about 90% versus dollar over the past 5 years. And similarly in Venezuela regarding their Bolivar currency. The second factor here is this idea of eliminating counterparty risk. So on the top right, there's this headline, Greek banks prepared to plan to raid deposits. So they introduced a 30% haircut on customer deposits. So by the very nature of these protocols, you're not going to see things like withdrawal limits or customer deposit haircuts. And naturally, you're also averting scenarios like bank runs, which we do see even today. So recent examples include a Canadian bank as recently as 2017, obviously Greece in 2015, Bulgaria in 2014 as well. And then finally, we have this third set of agents, the governors and the underwriters. So really here, we're talking about an opportunity to build upside exposure to the fintech industry that has traditionally been reserved to VCs. So anyone can go out and purchase this MKR token and suddenly have upside exposure to the MakerDAO credit facility. And an additional factor is this ability to influence monetary policy and risk parameters, which has previously been restricted to central bank governance. So now you can be part of that discussion. You can be in that room itself. So next, let's turn to the developer perspective when we think about permissionless. So how does open access improve upon the existing experience for developers? The first thing to consider is this idea of seamless, unencumbered innovation. Really, you can think about smart contracts as open APIs, and you can bootstrap services using existing infrastructure and liquidity. I think there are a few industries that are growing at the pace of open finance. Each new protocol that launches spawns multiple derivative protocols, and that leads to this exponential growth. And here on the screen, you'll see 3 examples that are all tethered to MakerDAO itself, but crucially offering differentiated products. And I think that speaks to the massive potential of open infrastructure when you think about innovation. So on the left here, we have DeFi Saver. It's an advanced loan management tool providing services like recursive leverage and automatic margin call protection. In the middle here, we have Chai, which is a wrapper for DAI, so that you can continuously earn savings rate without having to lock your assets in a particular contract. And then on the right here, we have Staked Ray. So this is a yield aggregator. It rebalances a portfolio of stablecoins automatically according to the highest fixed income opportunities at any given time. I think Staked is a particularly interesting use case. Tarun Chitra, the CEO of Gauntlet Network, often describes, and I'm paraphrasing here, but often describes this as the impressive and instantaneous gravitation of the open finance industry towards regulation national market system, Reg NMS, which requires regulated exchanges and brokers to provide their clients with best execution. So Reg NMS was introduced in 2005 after decades of securities market activity, and open finance has brought it to the market within a matter of months. So again, that kind of speaks to the rate of innovation here. Second factor to consider is this idea of eliminating platform risk. There are numerous examples of major tech giants like Twitter and Facebook revoking API access to third-party developers. Suddenly overnight, this foundational infrastructure is being cut off, and this really just creates additional risk to an inherently uncertain entrepreneurial process. Obviously not very conducive to innovation. So what MakerDAO provides instead is guaranteed immutable infrastructure with 100% uptime, and that is certainly a paradigm shift. So now let's turn to this second property, transparency, and this refers to things like accountability, risk management, decision-making. So what kind of beneficial insight are we afforded by MakerDAO's transparency? First is superior risk management. So if we go back to the financial crisis of 2008, this was largely a result of opacity regarding the assets that were underlying these mortgage-backed securities, and also the extent of leverage within the financial system. So in 2007, the ratio of loans to deposits hit 3.5 to 1 in the United States, and that's double the ratio found in the second most highly leveraged banking system, Russia, and triple the ratios of the UK, Germany, and Japan. So there's this enormous amount of leverage within the US banking system. No one really had any idea. No one could audit this leverage. So if we turn to MakerDAO, DAI's solvency is guaranteed by, in theory at least, by the over-collateralized relationship between collateral assets and outstanding debt. And due to the transparent nature of the MakerDAO protocol, we can observe at any time, we can audit and observe the collateral portfolio. So that's what we see on the left here, MakerDAO's collateral portfolio over time. You see it's still predominantly made up of Ether. And then on the right side here, we have the system-wide collateralization ratio. So you can see that historically, the collateral ratio has hovered over 300%. So that means there are $3 worth of Ether backing each individual DAI. These two lines here, you have the turquoise one being the system mandated collateralization ratio of 150%. And then the red line is at 100%. So if the system-wide collateral ratio falls below that line, then suddenly DAI can be considered insolvent. So again, anyone can monitor this in real time and ensure that the system is safe. As a DAI holder, you now know both the extent of leverage within the system and the asset composition of the collateral portfolio. So the second advantage that transparency provides is this idea of superior behavioral insight. As I'd like to turn to this quote from Joseph Stiglitz, who says, "I think we can have a better regulated economy if we had all the data in real time knowing what people are spending. It would enable the Federal Reserve to actually set interest rates in a much more efficient way." And I love this quote, and I'm in absolute agreement here. So again, the transparent nature of MakerDAO provides us unencumbered insight into user behavior, and that allows for superior decision-making from protocol governance. So here I'm just going to share some data. This is quite simple here. On the left, we have DAI daily transaction volume over time. We see that, well, this is really just over the past 60 days. We see that that's fallen, but still hovering around $50 million. And then similarly, DAI daily transaction count has come down over time. It's now hovering around 5,000 transactions per day. Obviously, you can get more sophisticated here. So on the right, we have the average transfer volume per transaction, which we see has been climbing over the past 60 days. Then on the left, we see DAI daily velocity, which is daily transaction volume over outstanding supply versus DAI price. So usually we see this pretty clean inverse relationship between DAI price and DAI velocity. On March 12th, we see this anomaly appear where velocity and price spike at the exact same time. And then since then, this relationship has reverted back into an inverse relationship. And we're seeing that as price comes down, velocity is also going up. And that's kind of the relationship we want to see. So again, MakerDAO governors can look at this data and make superior decisions when it comes to things like monetary policy and risk management. And finally, you can get even more granular. So on the right here, we can actually look at the user habits of DAI holders. This is the top 20 addresses by transaction volume inflow. As you might expect, a lot of it has to do with speculative use cases, things like exchanges, Oasis, Kyber, lending protocols like Compound and Fulcrum. Uniswap is also on there. And then on the left, we can see the number of addresses per DAI balance range. So you see over 30,000 addresses with between 0 and 1 DAI, fewer than 5,000 addresses with between 1 and 2 DAI, and then all the way into the millions. I think there are around 4 addresses that have somewhere between 2.5 and 4.5 million DAI. You can kind of use this data and back into a Gini coefficient, and again, have a better sense as to the economic status of participants within this DAI-based economy. So the third factor I'd like to consider is this idea of superior accountability. So you have this transparent political process, both in the soft social contract-like commitment to open discussion that MakerDAO governors and shareholders align with. And then you also have this hard commitment to execute on transparent and immutable blockchains. So on the left side here, you see the cumulative MKR sold off in the post-Black Thursday debt auction. So as mentioned earlier, the underwriters of MakerDAO, these MKR holders, bear responsibility in the event of defaults. And you have this programmatic guarantee to recapitalize the system. So again, anybody can look at the Ethereum blockchain and see that MKR is being auctioned off over time and that the system is re-entering into a sufficiently capitalized state. On the right side here, you have these two tables. On the left, you see transactions committing executive vote decisions to Maker's governance contract. So rather than enshrining changes into law, you see changes actually enshrined into code itself. And again, that adds particular guarantees. In the event of malicious behavior, as you can see on the right, you have these time-locked protocol changes. So anyone can observe these time-locked changes and exit before they are affected. And this is really important when it comes to protecting system users. So it kind of gives everybody the benefit of hindsight before events have actually taken place. And then finally here, we have some more data around MKR voter activity. So anyone can analyze how particular MKR holders are voting and the frequency at which they are voting as well. And this is kind of this data-driven way of evaluating commitment and sensibility to the protocol's core values. This is definitely important when it comes to things like delegation and representation within the system. And it's certainly a stepwise improvement from the way that we traditionally allocate our influence to social representatives. So just to wrap up here, I don't know whether I'm ahead of time or not. I think slightly so. But just to wrap up, MakerDAO is just one of dozens of projects that fall under this open finance umbrella. You have the same permissionless and transparent properties packaged into various different use cases, all of which have the potential to make significant strides when it comes to things like financial innovation, economic inclusion, social mobility, risk management, and accountability. So on the right side here, we have the Blocks Open Finance Index. This is an attempt to measure the aggregate economic activity across various non-standard financial services. You can see that the OFI is up about 50% year to date and 130% over the past 12 months. So it's staying very promising and steady growth within this industry. And I am very, very excited to see where we end up in 12 months' time. That's it for today. And thank you so much for having me.
Hey y'all. Okay, so it looks like I'm live now. So I'm Alexis from Open, and I'm going to be talking about DeFi risk management. So DeFi is incredible, and it's enabled a ton of financial innovation that I know a lot of us are super excited about. But at the same time, there are a number of risks in DeFi that we need to be aware of and also figure out how to mitigate. So that's kind of what we'll be talking about today. So what are some of these DeFi risks? We've got kind of a lot. We're looking at ETH volatility, inter-protocol risk, admin key risk, financial risks, hacks, smart contract vulnerabilities. The list goes on. There are a lot. So how do we go about mitigating these risks? Well, there are a couple of different things that we can do. The first thing is that we need to be aware of these risks. As products and projects, it's our responsibility to convey these risks, whether technical, financial, or otherwise, to our users to help educate them and help them understand. As users of these products, it's important for us to learn about these products, to become educated, to be optimistic about this innovation, but also cautious about where we're putting large sums of our money. So, and then the number two, the other aspect of risk mitigation is using risk mitigation tools. And today I'll be focusing on one of these tools, which are protective put options. So what is a protective put option? A protective put option is an instrument that gives you the right, but not the obligation, to sell an asset at a given price, which we call the strike price, by a certain date, which is the expiry date. So that's kind of a mouthful of a definition. So let's break it down with an example. So say ETH price is currently at $200, and I'm worried about ETH downside, volatility, and flash crashes. Then what I can do is buy one of these protective put options, which says that if ETH price falls below $180 before June 7th, I can still sell my ETH for $180. So what does this mean? Going back to what we talked about, ETH price, say ETH price is $200 today, and then I wake up tomorrow morning and ETH price is $140 or $100, then that's a ton of value that I would have lost. But if I hold this protective put option, then even if the market price of ETH tomorrow is below 180, at 140, at 100, whichever, I can still sell that ETH for $180. So I'm able to protect myself against these drawdowns in ETH price. And these different put options have different expiry dates. So in this case, I'd have this ability up until June 7th. So let's go ahead and kind of map this back to the definition we were talking about earlier. So the asset that we're protecting is ETH. The strike price is $180. So if ETH price falls to 180 or below, that's when I would use this option. June 7th is my expiry date, so I can use this until June 7th, and I have the choice to sell my ETH for $180, which is that right, not obligation. So in the example we talked about what if ETH falls from 200 to 140 and it's more profitable for me to sell it for 180. But I could equally wake up tomorrow morning and ETH price could be $250. And then I'd want to sell my ETH for $250, which I could do because I'm not obligated to sell my ETH for 180 if I hold this option. Rather, I can choose to if that's helpful to me. Okay, so now that we know what a protective put option is, how do we actually go about acquiring one of these? How does this process work in DeFi? So the first thing that I would do is, as someone looking for protection, I would pay a premium to purchase this protective put option, and this premium would go to a pool of protection sellers. In return for giving these protection sellers a premium, I would be protected in the form of this protective put option. And so with Open, this protective put option is something called an O token, which is a fungible ERC20 token, which gives me this protection. So what I'm essentially doing here is paying this protection seller to offload some of my risk. They're taking on some of that risk for a premium, and I get protected. So then what happens if ETH falls in price? Well, there are a couple of different choices that we have. So the first thing we can do is exercise. And this is actually what we just talked about previously, where in the example we saw ETH falling to, we were talking about ETH at 200 and then falling to 140 or $100, and me using this option to sell ETH for 180. That's what we call exercise, which is when we give up our options and our ETH, and we get in return the strike price amount of USDC. So you always have that ability when you hold this option to be able to exercise it. Now, the other thing I could actually do is sell the option itself. So remember that the option in this case is a fungible ERC20 token. So that means I can buy and sell it just like any other asset. So I can take this O token, I can go to an exchange, and I can sell it to receive a premium. So if the premium that I'm getting when I sell it to this exchange is higher than the premium that I paid for the O token initially, then I'm making a profit. And so this is another way for me to be able to use this put option. And if you want to learn more about kind of the pros and cons of selling versus exercising, and when, what scenarios, which action makes more sense, you can check out this link here at tiny.cc/seller exercise. Okay, so now you might be wondering, what about selling protection? Who are these people on the other side of the equation who are taking on this risk? And how do they do it? So here's what happens. These protection sellers take some USDC collateral and they put it into a vault to mint O tokens. So this is kind of similar to in the maker system where I can put collateral down into a vault and I can mint DAI. So here, these protection sellers are minting these O tokens, these option tokens. And then what they're doing is they're selling them to a pool of buyers on an exchange and earning a premium. So they're taking on this risk in return for this premium. So as a protection seller, you have to be comfortable with the risk that if ETH does hit that strike price, you would potentially have to give up all of your USDC collateral if a buyer exercises. So that's definitely the risk that these protection sellers are taking on. However, when these buyers exercise, the protection sellers do get the buyer's ETH in return. So why would people want to do this? Well, they might be comfortable taking on this kind of risk to earn a premium. They might also be looking to receive ETH at a lower price and kind of not mind if they're exercised on. But it's important to be aware that when you are selling protection, you are taking on risk and you're being paid to do so. So how are these protective put options useful in DeFi? So what we've talked about so far are kind of these ETH put options. So these put options protecting ETH collateralized with USDC. And we've talked a little bit about how this can be helpful to protect against volatility, flash crashes, and provide this ETH downside protection. So for example, in kind of a Black Thursday-like scenario, if you're an ETH holder and you're experiencing this kind of extreme volatility, this put option would give you the ability to recoup USDC for your ETH if you weren't comfortable with that volatility. So speaking of Black Thursday, another instrument that could have been really helpful in that scenario is an ETH DAI option. And so with an ETH DAI option, you're protecting ETH, but you have DAI as the collateral asset that these protection sellers are putting down. So both ETH and DAI, both USDC and DAI are stablecoins. And so the ETH DAI options could also help with this downside protection, volatility, and flash crashes, but you also would be taking on some DAI risk. And where it becomes really useful to have ETH DAI options is actually to unlock DAI liquidity. So remember, when you exercise an option, you receive what the protection seller locked up as collateral. So if the protection seller locked up DAI as collateral, that means that you receive DAI when you exercise. So these ETH DAI options allow there to be this DAI locked up in this protective asset that can be unlocked by exercising in the case that people are looking for that. And so this could be helpful for CDP owners who are trying to protect themselves from liquidation, or market makers in the ETH DAI ecosystem who want a specific hedge. This can also be used as insurance for DeFi projects, actually. And this can provide protection against technical and financial risk, immediate claim payouts, and trustless claim and risk assessment. And so now, how does that work? So let's go through an example. Let's use Compound as an example. So say that I go to Compound, I have some maybe DAI, I go to Compound, I put that DAI on Compound. Then in return, I get CDAI. And CDAI basically gives me the right to come back to Compound at any point, give Compound my CDAI, and take my DAI out in return. Now, what if there is some sort of adverse event that affects Compound, whether that's a technical risk like a hack or a financial risk like a liquidity crisis? Then what I can do is, if I was kind of scared of those risks, I could come to a platform like Open or another options platform, and I could go ahead and buy a put option on CDAI. And so what this would allow me to do is, if there was some adverse event that affected Compound, I could go ahead and give up my CDAI and my O tokens and receive collateral that a protection seller had put down in return. So in this case, if there's anything that causes the price of this C token to go down, whether that's a technical or financial risk, I can exercise this protective put option. So that's where you kind of see protection against a number of risks, technical and financial, immediate claim payouts. I'm not waiting for someone to come and assess the claim, say that something happened. Because this is an option, I can exercise it whenever I want. And so this is another really cool area where these protective put options can be helpful in DeFi. So what else is possible? The cool thing is that options are really versatile instruments. With them, you can hedge ETH, you can hedge Bitcoin on Ethereum with TBTC or WBTC, any ERC20 on Ethereum, you can now hedge with these options. You can build insurance markets like we talked about. You can actually develop volatility oracles. You can use advanced strategies like spreads, strangles, or straddles for other kinds of protection. And a really cool thing is that with just put and call options, you can construct any financial payoff in existence. So these are incredibly versatile instruments, and we're only just starting to scratch the surface of what's possible with them. So if you're excited about building with options, you can check out tiny.cc/biddle and learn a lot more about what else is possible and what you can build to enable a safer and more secure DeFi. So how do you get started? You can check out open.co. If you have additional questions, you can go to tiny.cc/open Discord, and more than happy to answer or discuss. And then you can find us on Twitter at open and me at Alexis Gaba. So hope this was useful and that you learned a little bit about DeFi risk management. Yeah, thanks for taking the time, and enjoy the rest of Ethereal Summit.
Hey, everybody. Thank you for coming to hear me talk about some of my ideas. I'm really excited to share them. Today, I'm going to be talking about how traditional finance might turn into legacy finance. And just some caveats off the top. There's a couple reasons to just this talk's going to be kind of about what could happen and what could happen on a long time horizon. Last week, I kind of gave a talk that talks about a lot of the risks and why that might not happen and how the community needs to come together. to address those things. And if you want to see that to kind of temper maybe some of the possibilities in this talk, I pinned that to the top of my Twitter profile, which is Scott_LEW_IS. And the other caveat is that, this isn't stuff that's going to happen in the next week, month, 12 months, year. It's really kind of at scale, and we're going to get there. If we get there, it'll be because we get there. We're going to get there in time. And so with that all said, first want to talk about how liquidity exists and how customers, when they come to the market and they have something they want to trade. And when I talk about customers, we talk about someone that's using the market to transform their risk portfolio. It's not someone that's using the market to try to make a lot of trades to make money. I consider those more, for this talk, I'm going to talk about them as market makers, but that's really like market makers, high frequency traders, quants. But customers are just people that are using the market for what it's kind of supposed to be used for. And then on the other side of the market, that's the liquidity. We have market makers whose kind of job is to balance order flow and to adjust the price so that kind of the buyers and the sellers roughly equal out. And so let's think about how markets grow. And to do that, I'm going to share my first slide. So it comes from competition to trade against customers. And if we start off with the market and we have one market maker or a specialist, they might start making market in that product because there's a few people that really need that product. And so let's say they have 2 customers. Those customers are going to get a pretty wide spread because that one market maker is going to be charging monopolist prices. And so the market will probably be really illiquid, high transaction costs. But if our customers that really need that product, that might attract more market makers, more liquidity. And so let's think about a second market maker joining that market. Now the spreads are going to tighten because rather than the one market maker being a monopolist, they'll now be duopolist pricing, and that pricing will be more competitive. And when that pricing, those transaction costs go down, that would attract more customers because there may be more people that wanted to trade the market but didn't trade because the costs were too high. And as kind of that bigger group comes into the market, that will probably attract even more market makers to kind of compete and to split up that customer order flow. And kind of that pricing for how much it costs to transact goes from monopolist pricing to duopolist pricing to oligopolist pricing to just kind of like something that's more of a wide open competition. And when you get wide open competition and kind of this market matures, a lot more customers can be attracted because the cost of trading go down quite a bit. And that you can think about that as kind of a liquidity flywheel, which is interesting. But another thing that's maybe a little more interesting is where does it stop? And it stops when kind of the market hits its total addressable market for that structure. Prices kind of get as good as they might get, and the market matures. And so this is when how liquidity works starts to matter, because the structure of the market is going to affect where that point in time stops. And I want to take a look at a kind of a fun market called the Minneapolis Grain Exchange. Here's their website. They trade North American hard red spring wheat. You can see kind of, I think the design of the website, it kind of reflects the excitement of the market. It's pretty sleepy. It trades kind of the third most popular wheat future in the world. It's a very kind of back and away market. It's not terribly easy to trade in this market, whether you're a market maker or a customer. And the structure of the market kind of keeps people out. It turns it into a silo. And like I can't trade on the market today. if you wanted to, it'd probably be hard. If you worked at kind of a traditional bank that wasn't like a commodities industry player, might be too expensive for your firm to get involved in that market. And a lot of people are kind of kept out of the market because it is siloed. But kind of the key question is like, what happens when there's this siloing? It keeps the amount of smart people that can look at the market and can speculate on it and speculate whether there will be a wheat shortage goes down. And kind of smaller markets with limited participants, the wisdom of the crowd isn't quite as wise, and it's harder to balance flow. And in 2008, there was serious fears there wouldn't be enough wheat. And the price on the Minneapolis Grain Exchange went crazy. Essentially a supply of a failure in the underlying market. And this kind of dragged up the other Kansas City wheat, Chicago wheat too with it during this time period. But it was caused because of the siloing of liquidity. And this is kind of where we get the first idea of how DeFi is a bit different, because DeFi de-silos markets from each other. And it does that because you have like one universal financial login, which is your Ethereum address. And if a DeFi protocol wants to keep people out of the market, they actually have a lot higher costs to do that. And everything is natively open. But in traditional finance, sort of like the Minneapolis Grain Exchange, everything is natively closed. Because the Minneapolis Grain Exchange can't just let anyone log in with Google and start trading, because they have to do all of these other checks, because if you just buy a bunch of wheat futures, you may not have the money to actually collateralize those wheat futures. And so there's a lot of stuff that has to happen that's very expensive for a small exchange like the Minneapolis Grain Exchange to do. And one of the things that I hope happens is that in the future with DeFi, all of these products can be traded by anyone that wants to trade them, and these barriers can come down. And these sort of sleepy silos will be less important. Will be not less important, will not actually be silos. But then let's shift a little bit to talk about a different type of silo, one that's maybe not sleepy, but is instead dark. And for that, I think a good example of that is auction rate securities. This was kind of a niche market, but an enormous market. I think the market was 200 billion in size, and it was very hard to get involved in this market. It was an interbank market. There's little transparency, and this first kind of became a bit more known in 2006. The SEC basically found a large portion of the market was involved in some very bad practices, and these 15 firms had to pay a somewhat paltry amount of $13 million. And this included violations like intervening in auctions by bidding from a firm's proprietary trading account and then asking customers to make or change their orders. The reason they were doing this was to prevent failed auctions, because if the auction fails, the real customers realize the market has serious problems. They probably won't want to interact with it. They did other stuff, like they had express or tacit understandings to provide certain customers with higher returns than the auction clearing rate. And essentially what the SEC found in this like very large settlement as far as number of participants, even though the financial penalty was not that high, was that like this market sort of somewhere on the spectrum of like being rigged, and being rigged in a way that was designed to make the customers of the market think the market was very healthy, when it actually was not. And so the SEC did their enforcement action. Great, problem solved, maybe. So then things just kept going as they were going. And an astute observer might wonder if it wasn't actually the bad behavior of these 15 different firms, but actually some problems with the underlying market structure. And what happens if the people participating in this market actually say, hey, this $200 billion product is actually pretty broken and maybe we shouldn't be doing this. Well, you're probably not going to be an auction rate securities dealer anymore. And if you spent your career building up customer relationships in this space, and that's kind of your only real long-term expertise, you're kind of in a really tight spot. And it kind of turns out that like when these bankers were in that position, they kind of finagled it. And even after getting caught, that didn't really seem to change that much, because 2 years after 2006, the financial crisis hit. And what happened when the financial crisis hit? Things actually got much, much worse. The auction rate securities market collapsed. And the people that had their money in this market did very poorly. And they weren't able to these auctions that were supposed to be very liquid and safe did not exist anymore, because the banks that had been supporting them were in dire straits from the financial crisis. This led to more regulatory action that was much, much, much bigger than before. UBS had to buy back 18.6 billion in securities, finding that they used profoundly deceptive sales practices. While they were telling their clients these securities were safe and liquid, they actually kept the purchasers in the dark to sell the clients their inventory. Merrill Lynch, which had to become part of Bank of America during the financial crisis, actually stopped their own analysts from reporting the truth about this market, and instead published a report telling them it was time to buy. And then Citigroup, 7.3 billion in repurchases. They actually got caught destroying evidence related to the probe. So we don't know what their deceptive sales practices were exactly, but it probably wasn't that good. And the question is, like, why should the financial system exist in these small silos? Like, why is it good for humans to rely on a financial system that is so closed off, and where the only people that know how the market is operating is the people whose livelihoods depend on people thinking the market is operating perfectly well? I don't think that's a good situation. And I think as long as we have these hidden silos, where in the financial system, where finance is happening, we're sort of always going to be waiting for the next crisis to come and hurt people. And one of my hopes for DeFi in fixing this is that by de-siloing the liquidity and kind of making transparency the default setting, it's sort of just, it shines a light on everything. And like the chicanery in these auction rate security auctions, it couldn't happen in like an open, transparent DeFi protocol, because everything that happens on the auction is visible to all participants in real time. And everyone can make a decision whether they would like to participate in the auction, and they can evaluate whether that auction is an economically meaningful, or like whether the auction makes sense to participate. And if the auction is completely toxic, and everyone can make that judgment, I doubt it will be easy for salespeople in these markets to sell these toxic products to their customers, because it'll be so easy to find out the truth about the health of these markets. And even though DeFi is just right now not nearly big enough to support any of these markets or solve any of these problems, there is hope that if DeFi can avoid a lot of the risks and avoid falling off the rails, that this liquidity flywheel and this like one unified market for liquidity can create a bigger flywheel with a bigger total addressable market and de-silo the financial system and create something that's safer for humans. And I think that's something that's worth spending your time building. But anywho, yeah, well, yeah, thanks for listening, and yeah, that's all.
Hello, everybody. Can you hear me?
Hey, Michael, how are you? Yep, can you hear me?
Indeed, indeed, Peter. Peter, you're not coming through.
Oh, man.
There you go.
Okay, we can hear you now.
Can you hear me now?
We can indeed. It's good to see you both. How are you doing today?
Very good, thank you.
Thank you so much for joining us on this virtual stage here. For those of you who don't know, I'm being joined by Shaylee Adenolfi from Consensus, who has written extensively about central bank digital currencies and is currently working to sort of help build that future out. And Peter Munnings of Adhara, who recently signed a really exciting deal to work with 5 central banks to help build what might be the future of central bank issued digital currencies. My name is Michael Del Castillo. I'm associate editor at Forbes, specializing in blockchain and cryptocurrencies, and lately have really been gravitating towards the work that central banks are doing. In some people's eyes, to leverage the best that blockchain has to offer, and in other people's eyes, to undermine all the great progress that cryptocurrencies are making without central banks. So I think it's a really exciting space. There's a lot of controversy, a lot of potential benefits, and we've got 2 great leaders in the space to talk to about that today. With such an informed audience as I know that we have at the Ethereal Summit, I'm usually loath to start off with defining terms because everyone is so well informed. But with central bank digital currencies, I think it's particularly important to make sure that we're all on the same page with 2 particular words there, which are digital currencies. The reason why I think that's important is because, as we all well know, it's been a long time since any of us has received a paper paycheck. Many of us aren't taking paper dollars or euros or any other currency out of our wallets to pay for anything. We've been receiving digital money for a while, and we've been spending digital money for a while. So I want to make sure that we're really clear on what we're talking about here, and specifically, what are some of the actual benefits of what we're talking about when we talk about CBDCs, as opposed to the digital currency that we've had for decades. So I kind of want to start off with just an open question to both Shaylee and Peter. When we talk about a central bank digital currency, how is that different than the digital currencies that central banks have been working with for years in a pre-blockchain world?
Peter, you
I'll
want to
jump
go
in
ahead and
first
start?
then. Sure. So I think central banks, it's true, have been working with digital currency. We call that the wholesale or interbank market, which allows banks to pay each other. The money that you receive in your bank account is commercial bank money. And the real benefit, which Shelley can talk about on the retail side, is central banks being able to replace or substitute the physical cash that you would have in your wallet with digital cash. And that is directly issued by the central bank. So that comes from the central bank to you, and it would be much like holding Bitcoin or Ether in a digital wallet. You would hold the private keys for that. You'd be able to spend that, but it's backed by the central bank, just like notes and coins are backed by the central bank. The benefit on the wholesale side is that wholesale interbank systems currently are only designed around one currency. There's a US system, there's a UK system, there's a Euro system, there's a South African system, etc. What the exciting thing about the distributed ledger version of these, or the blockchain version of these, is that they're being designed from the ground up to be interoperable. And that's a brand new thing. That's something we haven't ever had before. And because they're interoperable, you can do stuff intraday, you can do stuff during the day, you can do stuff almost immediately that you would never been able to do before.
So we're fortunate in the sense that your work, I'm addressing both Peter and Shaylee, sort of represents flip sides to that coin. No pun intended there. Peter, you've been largely focused at Adhara on the wholesale level. So why don't we start off kind of focused on that layer of central bank digital currencies, the wholesale layer. First off, if you could just very, very briefly give us an overview of what Adhara is and what Adhara's relationship is to that wholesale layer on the CBDC.
So Adhara is a company formed by a bunch of people who come from traditional banks. Deutsche Bank, Ed Bud, Julio Fora was at Santander, myself at First Trend. And we all saw this technology. We realized it's going to have massive implications for the future. And the whole point of blockchain is you can disintermediate intermediaries. And in the cross-border payment space, in the even in the interbank settlement space, in many of the business applications, there are intermediaries. There's friction in settling trades, and blockchain has the potential to get rid of a lot of that friction, to take out some of those intermediaries, and to simplify the whole process. And so we formed Adhara about 2 years ago to just say, we see this industry changing. We see this technology massively affecting the financial market infrastructure, and we want to be positioned to both be part of that and to benefit from that going forward. So we work with central banks. We work with companies who work with central banks. My background is largely working with central banks to do pilots around how would they use blockchain technology to enhance or to improve or to build things that have never been built before in the interbank settlement space. And then Adhara builds applications on top of that. So, for example, cross-border payments or liquidity management.
Before we, Peter, I do want to get into some of those details, especially some of the exciting projects that you're working on. But before we do that, I want to ask Shaylee if you could kind of unpack a little bit more about Consensus's focus, and if Adhara is really at the wholesale level there, looking at improving the way that the current financial infrastructure is interoperating. What is Consensus's target down at the retail level?
Right. So for us, we are definitely focused on the retail side, and that's digital banknotes minted and burned by the central bank, distributed to individuals and businesses. Now, there are still questions concerning what that will look like in the future, right? And we're seeing this. Bank of England came out with their white paper and the Bank of France and several banks globally have come out with their views on what the retail CBDC space could look like. And so we're just kind of thinking through our design of how we would implement this. One question, I think we are starting to see trends in the two-tiered model of CBDCs. So commercial banks and service providers would be the distributors of CBDCs, while the central banks would be minting and burning, right? But I think it is an interesting monetary tool for central banks to have that ability to distribute funds directly to citizens and businesses at the same time. So that there's going to be a balance of that. We're looking at privacy versus transparency and other features.
So I do want to get into some of those design choices that you're considering, and perhaps a couple that you've more formally made. But before we drill into that detail, I want to come back to Peter here and ask you, Peter, if you could kind of unpack a little bit more of the concrete work that you've done so far, because Adhara and yourself, even before Adhara, have done some real work with central banks. And I think there is a lot of skepticism out there about how central banks are interacting with the technology. As we're picking apart that acronym, we started by picking apart the DC, the digital currency, but I think it's also interesting to pick apart the C, the central. Central bank in a decentralized world is sort of a contradiction in terms. So as people approach central banks' interest in a decentralized technology, what are you seeing on the ground in the real world?
So, I mean, I've been very fortunate. I previously did work for Consensus and was involved with Project Ubin with Consensus, which was the Monetary Authority of Singapore, the Central Bank of Singapore. They've been running that for a number of years, and we did some very, very exciting work with them. I then ran the project Korka. Korka is an African language word meaning pay. That was with the South African Reserve Bank. It was a fantastic project where we built a real world pilot, a test platform with 7 commercial banks, the central bank, completely heterogeneous system. So there was, some of the banks were running their own nodes on premises, some were running in cloud. It was a fantastic project where we built a highly performant network and showed that it was comparable to the existing centralized systems. And now we're partnering with Finality, who are working with 5 central banks, 5 currencies, US dollar, British pound, the euro, the Canadian dollar, and the Japanese yen. Once again, working with them to provide the technology layer, the blockchain-based layer. And I think the key thing here is
Peter, could you go into a little bit? Peter, I'm sorry to interrupt you there. Could you go into just a little bit more detail? What is Finality, and what exactly was the partnership that Adhara set up with them?
So Finality is the culmination of a multi-year project called the Utility Settlement Coin Project, which has been funded by a number of commercial banks, 16 banks now, or 16 financial institutions, 15 banks in the NASDAQ. All large, what they call GSIBs, globally systemically important banks. We've put around $60 million to build this platform. And this is kind of where the distributedness comes in. So the banks who would be supporting this would be running a distributed network. The central banks would be issuing onto that network, and but then all of the applications would be fully distributed. So your resilience, you get the similar kind of resilience as you would on a public Ethereum network, for example. You get a whole lot of benefits in terms of interoperability. And as I said at the beginning, the different currencies are actually being designed from the ground up to be interoperable. And so you can get, and the key thing here is you can get true, what we call XVP, or so distribution versus payment, or payment versus payment, so DVP or PVP. And you're able to do that in an atomic fashion. So you take out the counterparty credit risk, and that's a massive, massive saving for commercial banks. So our partnership with Finality, as I said, is this organization or company that's been formed by, and the shareholders are these commercial banks, to build a distributed platform on a permissioned blockchain ledger, to allow settlement for PvP or DVP transactions.
So Shaylee, you know, moderators love when panelists go after each other because everyone loves some excitement there. Forgive me for being a little antagonistical here, but what do you think about you know, Adhara working with banks, working with existing central banks, working with some of the people that in the early days were kind of considered the competition?
Right. I actually think it's fantastic. I'm not gonna fall for that one. I think banks need choice. Adhara is offering a fantastic product, and I think what we're doing at Consensus and what Adhara is doing is very complementary, because you know their focus on the wholesale side, our focus on the retail side. There is some overlap in there, but there are definitely differences. So we'll just the world is big. There's enough room for all of us here.
Your Adhara is, admittedly, Peter, I'm sorry to be antagonistical. I actually find Adhara's work very, very interesting. And I am very intrigued with central bank use of blockchain. But Consensus is targeting a different layer. They're kind of not looking so much exclusively at banks, though obviously banks are involved, but more at the retail layer. People like me and you, our moms and dads, their relationship with money. How is Consensus taking a look at how the retail layer could be improved using blockchain technology?
Yeah, so we're hoping that the central banks would create a large-scale private permissioned Ethereum-based network, in which they would appoint intermediaries and service providers as nodes, right? And the reason why Ethereum would be the best choice here is because of the innovation that could happen on top of the core ledger. And so our focus would be on the core ledger for CBDCs, but as you know, we are very, we're doing a lot in the DeFi space, and Ethereum's a choice for tokenization right now, because of the standards, the large developer network, the adoption rate across the world. So, you know, I think in the short term, we're going to be focused on private permissioned, and eventually we'll see integrations in the public space, but that could take a while.
So when I had asked Peter to kind of help us define the term CBDC, I thought it was interesting that the example he gave was, you know, replacing the dollars that are in our wallets. To a large degree, you know, those dollars are already replaced, right? I kind of keep some paper money in my wallet in case of an emergency, you know, maybe for tipping purposes. But for the large part, that money already is replaced. So could you talk to us a little bit more? I think we really need to be clear about how life would be different, how the user experience would be improved if the money that is already largely digitized was leveraging blockchain technology. Shaylee, I'm sorry, that was addressed at you.
Oh, sorry.
How is the retail experience improved over the already dematerialized currency if that dematerialized currency is using a distributed ledger instead of a centralized control?
Right. So I think because of the decline in cash, central banks are, I think on the end user side, you may not see a big change initially, right? But it's an option, and eventually, you know, there will be the capability for people to transact in digital currencies, and then for businesses to give payroll payments, you know, to people using digital currencies directly minted by the central bank. So there will be a shift in the payments landscape. I don't think users will feel that much of a difference if they're already using things like PayPal, Venmo, but it'll just be a different option. For financial inclusion, it may be beneficial. It depends on the devices that people have that are financially excluded to date. And I think in cases, it remains to be seen. Behavior change is going to take time, and also policies, the roles of different actors in the ecosystem will change. So I think for end users, it may result in more innovative financial products that they get to see at different levels and different types. So just remains to be seen, I think.
Okay, so there is one specific.
Maybe jump in here. So in a first world context, I think Shadi's right. In a third world context, and there's been lots of studies in third world countries where people are being paid a social grant or getting money into their account, and the first transaction they do is they go to an ATM and they draw the entire amount out as physical cash. And there's two reasons for that. One, they don't trust what's going on the bank account. They don't understand that. And two, they can't see it. There's no visibility. So if they walk into a store and they're buying a bag of groceries, and the bag of groceries, let's say they've got $100 in their account, and the bag of groceries comes to $101, and their card swipe is declined. For you and I, we would reach for the other card, the one our wife doesn't have access to, or whatever it is. But for most people in the world, they don't have that luxury. They don't have that option. And so and so they sit there embarrassed now. They don't know, is it $1 over or is it $100 over? They're not sure. By holding the physical cash, they can see exactly what's going on. And the whole point, I think, of digital cash is that it would reside in a way that's, one, visible, two, it's backed by the central bank. So there's it's issued directly to them. It's like physical cash. And they're able to use it like they can use physical cash, except that governments will be able to now do kind of money drops or directly push money to the people who need it. And so it's an additional monetary lever that central banks will have. And that's very significant. And then when it comes to cross-border remittances, those kind of things, if you can link it up with something like Adara's building on the wholesale side, you now get a massive improvement. So we know that cross-border payments throughout the third world is very expensive and very slow, and you potentially could change that. So I would disagree that life is not going to change. I think life may not change for some first world environments, but in the third world environments, I think we have the opportunity now to frog leap some technology and bring a real change to people's lives. And certainly at Adara, we're aware of that, although we're not working directly. We definitely want to make sure that what we're building is interoperable with these new systems that we see coming along.
Awesome. Thank you for that, Peter. Let's go ahead and switch gears to another possible benefit of central bank digital currencies. And we will once again go back to our panel name here for some useful guidance, which is in the age of COVID-19, talking central bank digital currencies in the age of COVID-19. For just a little bit of context there, I think that it's worth pointing out that we saw a fascinating intersection between the wholesale world and the retail world of central bank digital currencies in some of the early drafts of legislation that was created in the US by lawmakers that were looking to take advantage of the fact that there was this multi-trillion-dollar stimulus package that had just been approved. And for the first time in recent memory, lawmakers, central bankers, and other elected officials were asking, how do we get this money in people's hands? And the concept of the digital dollar exploded into mainstream consciousness. We had some stories at Forbes that were getting multiple millions of views, which is incredibly rare. That the world is paying attention to digital dollars, and COVID-19 is one of the big triggers in that interest. So the open question, what were you seeing there? Some really interesting laws were being proposed. Some are dead in the water already. Some are still going. But what are some of the benefits of getting trillions of dollars worth of stimulus money into citizens' hands by using Ethereum and other blockchains?
Yeah, so I'll just start with this one. I think it planted a seed in the minds of the U.S. government, which is good. And the government is big, various agencies, different perspectives on how to distribute those funds. What's the best way possible? I don't think today we're ready to distribute from the blockchain perspective at scale, right? But we are ready for proofs of concept. And I think that those will hopefully be accelerated globally with governments as a result of this emergency use case that was highlighted through things like the stimulus package and other things happening globally, right? That there will be a need potentially in the future for governments to reach citizens directly, and that there needs to be a tool that they can use to do that. Also, there were lessons learned here in the U.S. from the 2008 financial crisis, right? And how banks did well and citizens did not. And lawmakers want to make sure that doesn't happen again.
Unpack that a little bit more, Shaylee. I think that's really interesting when you say in 2008, banks did well and citizens did not. How would reimagining our architecture before the next crisis, before the next pandemic, perhaps change that dynamic?
Yeah, I think so. It's about creating a more resilient and a ecosystem and different options for both governments and banks to use in the time of crisis, right? So that you're not reliant on any one entity. Here we have different things happening at the state level or I guess governors are making decisions differently here in the US than what maybe the federal government is saying around policy when people can go out. So I think money can play a big part in how different states, federal government leverage their tools to, reach their citizens. It's just about optionality in times of crisis.
So, Peter, you must have been watching very eagerly as we started seeing multiple bills coming out around the digital dollar concept. Can you kind of paint a picture for us about what you were doing at that moment? And as those bills started being made public, and I'll be clear, drafts of bills in large part, what were you thinking? What was your reaction? And perhaps more importantly, can you give us any insight about what your clients were thinking? How were they reacting?
So, I mean, we were interacting with various treasurers kind of on those critical days. So one legislation was coming through, but two, they were just dealing with massive shifts in the market, and their hedging strategies were being put seriously under stress. And we expect this to happen again. This is probably not the last time we're going to see this kind of thing. And the realization that, intraday liquidity management, in other words, how do I manage the money that I have, I need to move around right now today. So there are some tools, but I think what we want to do is bring much better and much broader set of tools to treasurers to be able to manage their positions and to reduce, as I said, counterparty credit risk, so that the problem with any kind of trade is let's say I need dollars and I'm offering pounds. Someone's got to go first. Someone's got to actually transfer one leg of the trade, and then the other leg gets transferred. By putting it onto a blockchain, you can now do that atomically. So in other words, either both legs will go through, or neither leg will go through. So we reduce the risk, and we can start doing these things in near real time. And as a treasurer, I can start to move the money into the right place at the right time to make sure that, for example, if margins are getting called, and traditionally I wasn't expecting to have large value of margin calls happening, and now all of a sudden those are going to be happening, and I've got to move money quickly into the right place, or my counterparty I'm starting to get majorly exposed. Being able to reduce that risk significantly by having these platforms in place is important. So I think it was more a case of the Treasury saying, hey, you've got to get the systems in place, you've got to get them through. How's it going? Where are we at? What's happening on that? They're aware that, you know, there's a huge amount of work that has been going on. We're not looking at proof of concepts, we're looking at putting robust production systems in place. And it's just a case of moving as quickly as we can at the moment to meet the needs of you know, both central banks and commercial banks to make these systems work.
So it seems to me, and please do correct me if you think this is a wrong image, but I tend to imagine central banks at the top of a financial infrastructure, with the layer immediately beneath the central banks being wholesale banking, which has traditionally been very helpful in getting money created by the central bank at the top layer into circulation at lower layers through various means, which I don't think we need to go through in this conversation. And then beneath the wholesale banking is the retail layer, which is sort of the last to receive those assets and the ones that sort of put them into use. That's the layer that's removing the money from the wallets, right? Whether or not it's digital or actual physical dollars. And when, you know, with that sort of visual image of central banks at the top, wholesale in the middle, and then retail at the bottom, I think it's really interesting to take a look at one of the bills that was proposed, which was from Speaker Pelosi, which originally had language in it that called for a pass-through wallet, where the wholesale layer would literally be bypassed. And it started to look a little bit more in that description of what Shaylee was talking about, where central banks had more direct access to the retail layer. And the indication in Speaker Pelosi's bill's wording was that she wanted to ensure that that direct access existed. That wording was removed very tellingly. It was removed very, very quickly. And I heard rumors and talk on the backside in my work that there was some pressure from the wholesale banking layer via different measures to remove that wording. Is there some behind the scenes machinations going on where wholesale banks are putting pressure on lawmakers to make sure that they have that middle ground secure? Or are we going to see a world where the wholesale occasionally takes a step back and lets central banks have direct access to retail?
Yeah, so sitting in Washington, D.C., I will say the lobbyists are very active in this space, but I do think commercial banks see the movement towards CBDC as well and are beginning to respond. For example, JP Morgan has JPM Coin, right? And it's focused on correspondent banking and international payments, but it's backed by a similar use case as central bank currency. So even the retail side is seeing where CBDCs could head and making their own plans accordingly.
Peter?
Yeah, I mean, I can't comment on who's lobbying who, but yeah, there's no doubt that there are going to be winners and there are going to be losers as we move forward. And I think there's going to be a realignment of the structures. And there's no doubt that as Shaylee said, the big correspondent banks like JP Morgan are already well entrenched in the space and are looking to protect their interests, which they must do moving forward. And tellingly enough, are seeing the same kind of technology. So JP Morgan, as you know, has sponsored and are still supporting Quorum, which is an enterprise Ethereum client, for their own use, but they've made it an open source project and it's been used. We've used it previously with some of the projects we've done, and it's a fantastic product. And so, yeah, so I think the point is there is a new technology. It is profoundly shifting the market infrastructure, and there are going to be things happening both at the wholesale level and the retail level in the future. I think I think the economists are nervous that this opens the door for more of a narrow banking. If central banks can provide one-to-one kind of backed dollars directly to citizens and businesses, as Shaylee said, the fractional reserve banking model starts to fall down, and various economists have got various views around what that would look like. But definitely, this is a technology that is changing the way that the banking infrastructure, or let's say financial market infrastructure, moves. And we've heard a lot today about DeFi in the context of public blockchains and cryptocurrencies. But we often speak about DFMI, or distributed financial market infrastructure, and that's a reality, and that's coming, and that's going to change the way that things work, and change user experience at the end of the day, and change the way that, for example, international organizations are able to move funds into third world countries, and those are scary, but they're also very, very exciting, and we've got to be kind of mature and grown up about how we implement these systems.
Absolutely. Shaylee, something Peter said I thought was really interesting about the fractional reserve model starting to fall down in that scenario. Some people would be really excited about the fractional reserve model falling down. From the retail perspective, and I don't know if you want to speak on behalf of Consensus, but on behalf, from your perspective as a Consensus employee, should we be concerned about the fractional reserve model falling down? Or is the fractional reserve model falling down something that's sort of inherent to public blockchains, and maybe why Ethereum and Bitcoin was created in the first place?
This is me personally, not speaking on behalf of Consensus. I don't think we need to be worried about that just yet, because from what we've seen, it seems like central banks do want to have the two-tiered kind of distribution model, and for maintaining financial and monetary stability, right? Because they don't want to just upend the retail banking system overnight. There will be gradual disintermediation of some sorts, and things will change, like Peter said. But I do think in emerging markets, you will see the most impact and leapfrogging of systems, and we just have to wait and see what will happen. There will be a balance, I think, in the shift towards decentralization.
So let's talk about business. Let's talk about the business of making money off making money. Obviously, if either of your projects were philanthropic, they would likely be very short-lived, unless you can get a bunch of investors who are willing to give money for a tax write-off. I think that it's interesting to look at how you're making money. So Adhara, you signed a deal with Finality. Finality had existing relationships with 5 central banks. Consensus has been around since almost the beginning of Ethereum. And you have customers, you have people that you're charging. Where is the money being saved or made within the CBDC world that is allowing you to charge for either technology, services, consulting, etc.?
So I'll jump in quickly. It's very simple in the commercial bank world. It's the ability to manage money on an intraday basis brings saving, but the ability to reduce counterparty risk. So as I said, the exposures that banks sit in, and banks are sitting on large exposures when they trade. The ability to remove that by having the settlement of both legs at the same time, and that's massive, and that's a huge move forward. And then just so from our perspective, cross-border payments, both from reducing the friction on the regulatory burden, so making it easier to report those trades to the regulators, and making it more visible to the regulators who they spend a lot of money trying to figure out who's trying to bypass the system, who's laundering money, who's financing terrorism, who's financing crime. If you can make that easier for banks to report and it's more visible to everyone, there's a massive saving there and a reduction in friction. So there's a numbers. There's all sorts of places that banks can make money, and that's why they're paying us to do the work we're doing.
Could you, I imagine that there's some brilliant technologists in our virtual audience today who don't necessarily know the ins and outs of wholesale banking. For those folks, could you sort of unpack a little bit, describe, first of all, what is this counterparty risk that happens at the wholesale banking level? And how would that be removed by giving each counterparty access to a node on a distributed model?
So, I mean, really simply, if there's a trade that, let's say, crosses two currencies, so let's take a really, really simple trade. You've got pounds, I've got dollars. I need your dollars, you need my pounds. We're gonna trade those. So at some point, I have to transfer those funds into your account, and you have to transfer the funds on that side to my account. And the original risk is called Herstatt risk because there was a German bank. And this was a time zone problem, and so the American banks had all done the transfers, and then overnight the German bank went under and wasn't able to pay in those days the marks into the account. So what had happened is the money had moved on the dollar side and couldn't move on the German side, and so they were caught short. And so those are the risks. And so there's massive insurance that's put in place around making sure that you're not left exposed. With blockchain technology, what you can do is you can say, well, let's lock it in with an algorithm. Let's make sure that we're using clever cryptography to make sure that if the dollar leg moves and let's say the pound leg doesn't move, then the dollar leg just rolls back. Or if the pound leg moves and the dollar leg doesn't move, then the pound leg will roll back. But if they both move, they both move, and that's what we call an atomic transaction. And that simple thing. It's a really, really simple thing, but it has a profound impact on the way that trades are done around the world.
Awesome. Thank you so much for that, Peter. That was really helpful. I appreciate the clear example there. Shaylee, I'm not sure if you had a chance to tune in to some of the earlier panels at the Ethereal Summit, but I thought it was really interesting what Vitalik Buterin had to say about Ethereum itself, the Ether cryptocurrency, being someday a viable alternative to central bank currencies. I think I wouldn't be doing my job if we didn't sort of highlight that as a possibility, right? Like, it can't be a coincidence that consensus is focused at the retail level when retail investors all over the world already have wallets filled with Ether. A cryptocurrency that doesn't rely on a central bank to be minted or moved. So what is it about consensus's relationship with Ether that makes it a particularly powerful business when looking at the retail applications of central bank digital currencies?
I think the end goal of having Ethereum as a settlement layer, the mainnet, could be interesting. But I don't know if central banks are ready to do that today, right? So that's a possibility for the future. And we will just have to work with regulators, commercial banks, and continue to build out the decentralized finance products that are interoperable and see what happens. But we're still working on it. I don't have a good answer, but it's a possibility, right? There's a lot of adoption of Ether globally already, so remains to be seen.
So a lot of, and we've been focusing largely on sort of Ethereum and the central bank digital currency space, at least at the abstract level today, because you both come from companies that are using the blockchain. But there are non-Ethereum blockchain projects going on around the world, including within central bank digital currency. I'm sorry, including within central bank offices. But I do think they're largely permissioned systems. They're largely private blockchains with limited access. I think it's important to sort of note that there is this question out there as to whether or not a central bank digital currency should be some sort of a privacy strengthened implementation of a public blockchain, or if it should be a permissioned blockchain from the ground up. That's an open question. Should central bank digital currency be minted on a public blockchain? Is the technology out there yet to make sure that we're not opening up the door to a surveillance capitalist society? Or is there more nuance there?
That's a good question. So it's a really good question. And I think, as Shelley said, there's no central bank in the world that would consider that at this stage. But the technology is there. There's no doubt in my mind that the ability to issue and to control the token contract into which you issue, and to make that compliant, the technology is there. It obviously hasn't been tested, and I don't think there's any appetite at this stage to do that. But the benefit of using something like Ethereum in a permissioned network is that you get all of the benefit of the day-to-day testing and the hardening of the code and the hardening of the constructs and how it's put together. A simple thing like calculating gas for opcodes. So most of the audience hopefully will know what that means. But in other words, if I do a piece of code within the Ethereum virtual machine, how much does that really cost the Ethereum virtual machine as a whole? All of that benefit comes in to permissioned Ethereum networks, as opposed to trying to build something from the ground up. So there's definitely a benefit of kind of the hardening and the testing that's going on the public network in the permission space.
Shaylee, is this just a long game to get people to use Ether, or is there some more nuance there?
I think there's more nuance. It's a good question. I think governments will probably, once they've seen that Bitcoin, Ethereum are here to stay, if they haven't already, they will start to adapt some of their internal systems to be able to integrate with public blockchains, right? And it won't be payments at first. Maybe it'll be digital asset related management, or settlement and trade, right? But eventually there will be some integration, and then we'll see what happens.
Great. Peter, sort of wrapping things up here, I want to turn the attention back to Adhara and your work. You had a chance to go into a little bit of detail about the recent deal with Finality. Can you update us on what the day-to-day looks like there and what we might expect in the future? Basically, what are you doing now and what happens next?
I mean, we're busy building, testing, making sure that the code works as we advertise on the tin. So yeah, it's a very, very busy. I must say, we've been more busy during this kind of lockdown period than we expected, and I think it's partly because of the pressure to get the work done, but it's come down to a very exciting and very interesting and very robust and kind of very normal software engineering project. And it's very exciting to work in this space. We definitely do feel like we are building the future financial market infrastructure. And it's just, as you would guess, a load of, sweating the small stuff, making sure that everything works as advertised. And looking forward to seeing where it progresses in the space. Probably about as much as I can tell you at this stage. It's a fascinating project.
I know that you have to navigate what you're allowed to say and not, but a quick follow up there. Is the code done? Does it do what you wanted it to do? or are you still at the build phase right now?
So at the basic level, it's done. It's working. It does what it says it does. There's all sorts of as we interact with or as Finality interacts with regulators, there's all sorts of additional questions that are being asked. There's all sorts of new and interesting use cases that are coming through, and so as we approach those things, as you kind of take the step on the regulatory level and questions get asked on the technical level, and you need to address those and answer them. So it's kind of a bit like rolling a snowball, bits fall off, bits get added on, but there's great momentum. And yeah, so at the basic level, everything works. I mean, Ethereum has been working for a number of years, and effectively we're building smart contracts on top of Ethereum. We have built smart contracts on the top of Ethereum, and there's some integration work that's happening, but fundamentally, yeah, it works. It does what's advertised. Project Cork was 2 years ago.
Sorry, Peter, I didn't mean to interrupt you there. Go ahead, Peter. Last thought there.
Yeah, so as I said, Project Cork, we showed that banks can transfer government or central bank issued money between themselves. So it's more around how do you integrate into a securities platform, how do you integrate into other environments. So it's the peripheral work that's happening at the moment, which is very, very important. It's got to be done before you can go live with these things, but fundamentally everything works on the blockchain level.
Very, very exciting. Thank you, Peter. Shaylee, can you tease us in what's next for consensus in the world of CBDCs?
Proofs of concepts, working on the design, what are the different functionalities for the central bank, for the network operator, the gateway, right? The commercial banks, large retailers. What's the design look like for onboarding and offboarding users, minting, burning, monitoring, and maintaining the network? And what's that balance between privacy and transparency? It's going to be different for each government. And we're just learning and building and, iterating on the design as we go. But I will say that, private permissioned Ethereum is available. It's ready to go. And many governments think of Ethereum as public only, but we are working very much in the private and permission space today. So just want to make sure anyone from governments listening in hear that.
It's at this time that if we were on an actual stage, I would ask the audience to give our speakers a round of applause. But I don't think they can even unmute themselves to do that. So I will thank you on the audience's behalf for coming and talking and sharing your insights with us. As always, looking forward to see what you do next and seeing what central banks do as well. Thank you so much.
Thank you, Michael. Bye.
Thanks, Michael. Fantastic. Thanks, Shelley.
Hi, everyone. My name is Aisha Kiani. I head business development and Ledger Prime. This is actually my third Ethereal Summit. I still remember the first one very much vividly, but not to take anyone's time any further, I wanted to quickly dive in and start on what I'll be talking about today. So, well, first of all, thank you so much, Travis, for giving me this opportunity. When he and I had the conversation. I wanted to talk about, the growing market of ETH options, because I had newly joined a hedge fund, Ledger Prime, and at that time, Bitcoin options, Bitcoin futures, was the talk of the market. But then, there were slowly ETH options emerging in the market too. But knowing that consensus is, the Ethereum forward, at ETH Denver, I was very surprised to see that, there's not as much talk of another form of trading that has been, in traditional markets for, good 30 to 40 years or so. And that kind of like provides the hedge to companies, to traders, and protect downside. So that's why I wanted to bring up derivatives today. And then, I'd also discuss on how, the crashes have happened, on March 12th and, around that, and how, crypto was able to survive because, the downside that's provided by derivatives in many forms and shapes. So, okay. Yes. Okay. Awesome. So as far as Ledger Prime goes, we are a quantitative hedge fund. We are owned by the same holding company as LedgerX, which is a derivatives exchange. LedgerX was formed 5 years ago. We've been around for almost a year and a half. We primarily trade options using quantitative and systematic investment approach. Targeting steady capital growth and superior risk adjustment. We also provide our investors a low volatility exposure to digital asset markets via quantitative and systematic strategies. We also market make using consistent and predictable market liquidity and provide market depth, with narrow spreads and transparent price discovery, which allows our investors and participants to trade more efficiently. So like, as I started off my presentation, that the entire crypto ecosystem is still like very much a dislocated ecosystem, given that what we're doing at this point. So, what we see on a given day is like derivatives exchanges are highly leveraged. They're leveraged at up to 125 times, on most given days. Liquidation and margin calls on these derivative exchanges are often instantaneous. Movement of funds or crypto are not, especially during times of market distress as mempools get clogged. There's no comprehensive prime broker, central clearinghouse, or cross-platform margin, which means that a trader could have a long position in one exchange and short on the other one, which could get liquidated. And then the other thing, as most of you know out there, is that most exchanges still take crypto as collateral. So which means, if the BTC value is down, your collateral value is going to go down. And there's no circuit breaker of exchanges. The reason I wanted to bring this up is that on March 12th, that was, our fund, Multicoin Capital, for instance, because they published a very comprehensive report on it, started saying that how there's some traditional infrastructure that's crypto also needs from the traditional asset markets. So I also wanted to bring up a certain point that this is the current like CeFi system, as I know that there's a separation now, DeFi and CeFi, and we all know that Bitcoin and Ethereum networks in their current forms cannot operate at global scale as much as we would like it to be, as much as we would want Ethereum to, be traded, on all exchanges and whatnot, or be even accepted as a currency. that kind of volume at any given day could always clog the system. And that's a glimpse of it we only saw on March 12th. But the other thing is that this is something that we need to be cognizant of if we are working on our current infrastructures and trying to make it more of an adaptable market going forward. So what happened was, like, during times like of in crisis, they become so congested that arbitrage cannot keep prices in across all venues, causing massive dislocations. And certain dislocation particularly happened on March 12th, where Bitcoin dipped down to almost $4,000 for 15 to 30 minutes. And it wouldn't have happened if markets would have operated correctly. So what really happened? Like I keep talking about like March 12th. Basically on March 12th, it was the last end of the domino effect, right? Like the last like just the last block of domino effect just going down. So miners, lenders, and speculators had all leverage long leading up to this date, partly because we were in a semi-bull run. Like, January and February had been good months on our end. And the drop in crypto markets in the previous week as a result of global market turmoil, oil prices dip, and then finally US acknowledging, the existence of COVID-19 began to reach loan market margin call levels. And as a result, lenders started to liquidate crypto collateral aggressively to protect themselves, which caused aggressive selling. I'm not calling out only crypto markets here. Yes, we do know that, all traditional asset markets, there was a global sell point, but beware of the fact that on any given day, New York Stock Exchange, if trading goes below 7%, there's a circuit breaker for the markets to adjust correctly. We don't have that. So we, on any given day, could go anywhere from 30 to 50% and, just pretend that it is all normal. So, and this started to impact leverage long positions on various derivative exchanges, which automatically liquidated, resulting even more selling. All of this resulting in a vicious cycle of further liquidation. As Multicoin also pointed out about BitMEX, and I think at this point almost everyone knows what happened at BitMEX, that there was only a 20 million bit side liquidity remained above Bitcoin price of $0, which is like unseen and unheard of. But we had gone to that level. They had to take some time off, correct themselves, and then go back up, and it all survived. Now, like I said before, that Bitcoin's clogged mempools, exchange delays, lack of cross-platform collateralization, prime brokerage, excess leverage, and all of this contributed to market crash. So a market with a very less or infrastructure in place, and then add a pandemic to it, we hadn't seen this coming. So the other thing is that we've seen the growth of DeFi space in past couple of months. I would call it, I won't even call it a year or so. And we've started seeing platforms that are trying to again do borrowing, lending, exchange, be very decentralized exchanges. I wanted to bring up a point. I was a very early employee at Consensus. I was actually hired for Singular DTV ICO, and even back then in 2017, there were DEXs coming up. Like Singular DTV had launched a DEX. So I think that a concept of DEX isn't like novel, that just took off like in 2019, and everyone just said that, oh, we all need to exchange our ETH and to help the ecosystem. I think like from a CeFi side, or from the other side of things, we think that we have worked quite a lot to get semi-institutional interest that we've gotten in past, a couple of years or so. And that's why, Bitcoin dominance is about 59 to 60% on any given day. And, we would like the DeFi space to head in the same direction if we want Ethereum to have, the kind of adaptability that, anyone and everyone would want it to be, aside from the fact that, how much of functionality it can support. So just like, the crash on the CeFi side on March 12th, DeFi had its also shortcomings. We all know about MakerDAO and how the walls became undercapitalized. The Keeper software was not built to dynamically adjust gas prices in response to network congestion. So miners did not include Keeper liquidation transaction in blocks. And as far as Maker Protocol was concerned, no one was bidding at the collateral liquidation auction. And someone took an advantage of it, decided to bid as low as 0.48 million of ETH collateral, and succeeded in doing so. This is something that I've taken from Multicoin Research. I've mentioned them already. And then the other thing I wanted to talk about is that this is not the first time that DeFi had seen a hack, within last 6 months or so. We've seen the BZX hacks during the ETH Denver weekend, price manipulation of Maker on Syntax, LendMe and Uniswap just recently lost $25 million. So again, I'm not saying that there's some serious shortcomings that cannot come over it. I remember vividly on how there used to be hacks on Binance and Coinbase every now and then back in the day when they were coming more into play in 2016 or 2017 or so. But I think that a lesson that we would like to give out, traditional shops like us, to other DeFi protocols, that look, guys, we're here to help. So you don't have to do this in isolation and make it into a very small market. We can help you. At the end of the day, we all have the same goal for these cryptocurrencies to be widely adapted and traded widely. About was I wanted for everyone in the audience or whoever is watching to know the growing market of Ethereum derivatives market. BTC is currently traded on CME, Ledger X, Backed, Deribit, Binance, and whatnot. But then there's also ETH options. March 12th could have been the end of crypto, but it honestly wasn't, because in the next few days, we started to see bullish activity again with liquidity. And we also noticed crypto decoupling itself from traditional assets. Now, great news for all of us is that, I think this is the time where we all can focus on how to become better. And I think that despite of a lot of traditional infrastructure not being into place for CeFi, like regulations, clearinghouses, brokerage, derivatives have been playing a significant part in helping markets mature effectively, and have attracted some serious institutional play as more and more derivative trading platforms come into play. So as I show that, even on May 20th for May 20th, this current month, we've seen about close to 12 to 13 million of options being traded on Deribit, which is a very good number given that it only started almost less than 6 months ago. So wanted to bring a couple of strategies that everyone should look into. Protective puts through the purchase of put options. Miners, stakers, and investors. I know that there's going to be a lot of miners in the audience right now, can protect themselves from downside price exposure and volatility, which could hamper their treasuries and business operations. Guys, options is one of the best way to protect yourself from downside and volatility if you are trying to trade ETH smartly. Put options, just like for insurance, for other industries, help place a floor on price and dampen overall price volatility, making it more predictable and manageable. It's your shot, it's your call, how you decide to put it, your strike price on, where do you think, what's the max amount of risk you could take. It's totally up to your call. Covered calls, options, they generate yield by selling call options against their long token exposure. When a party sells a call option, they get the premium from the sale upfront, often more than 25% annualized. This is your annualized yield on the option size is definitely much more higher than any DeFi protocol that is currently offering. Because it's advised investment strategy, and I'm not out here giving investment advice, but I'm all just saying is that there are better venues to invest your money wisely if you want this ecosystem to grow maturely. Covered calls can help offset operational costs that otherwise would have to be generated by selling crypto, as well as help offset any possible price depreciation. As I mentioned earlier, the liquidations happen as fast as they could, and not a lot of market makers were hurt to a point where they had to close down, shops completely, and like where a downside investment could have like resulted on a 25 million bad trade or anything. So I think that's where the options help with the investment in the current volatile landscape. And then costless collar, by combining a protective put and covered all, an option user in exchange for some upside exposure in token price appreciation. Option users can make the cost of hedge costless, enabling one to obtain downside price protection and price stability for minimum upfront resources. So again, if you have it, you put it up, you decide on your own, in exchange for some upside exposure. Now, where do we all stand, right? Like like I said, this is not from an investment advice perspective, but this is from more of our safety and our protection and our downside protection perspective. We see that options can provide downside, smooth out volatility, and generate higher yields than many current DeFi protocols. Key infrastructure players continue to launch and grow. Prime brokerage and custodians like Tagomi, Copper, and Anchorage, fixing the cross-platforms collateralization. Xmargin is an upcoming player that provides cross-marginal solution with no central authority. And then most importantly, connecting DeFi with CeFi. Professional trading desks like Cumberland, B2C2, FalconX, and Jump are well equipped to absorb large market orders with minimum market impact, dampening negative liquidity gaps as observed on exchanges on March 12th. Like I said, we are here to help any DeFi protocol out there that is willing to, go on more of, a larger scale route, because we think we all are betting against the same thing, our cryptocurrencies, but we all think that crypto has the potential to be a global scale, to be at the global scale. But if we'll continue with like dividing the ecosystem, like even much more, into smaller parts, and just even focusing on that, focusing our resources on that, I don't think, on a global scale we'll ever be able to, achieve the unity that we all are aiming to be. So I think, we're always there for you guys. We've recently joined Chicago DeFi Alliance, and we'd be mentoring DeFi protocols on market infrastructure and providing them the similar guidance, because at the end of the day, we would want, less hacks, less bad trades, or less, bad reputation coming to, our industry, in like whether it's in the DeFi format or NFT format or whatever it is. At the end of the day, we all a big, giant, happy crypto blockchain family. And, I take this Rune's statement very seriously, that CeFi and DeFi will eventually merge. As I've said, in the course of past, almost 15 minutes or so, is that we all are aiming for the same unity. We all are aiming for, these crypto assets to grow, to, flourish. And that's why we would want it to, be taken as well as probably Bitcoin or, ETH, and many options has been taken, on the CeFi side. So, we all are striving for the same thing. I also wanted to bring up like one point that I saw while I was researching for this is currently DeFi is only about 1% of, what the CeFi activity is, which kind of like says a lot. Like if we were to combine sources, it's going to be a much better play for, everyone combined. And, by May 2022, DeFi is expected to have about 10 million of users, which is comparatively still very small number. But again, if all of is combined in one form or the other, if all of this is protective, and if all of this is traded well, I think we shouldn't have any issue with the possible mergers that MakerDAO had initiated. Thank you so much again. I wish I could have taken some questions, but I can I think, okay, perfect. Awesome. Thank you guys. I think that's all from me. Thanks, Travis. I just leave. I think that's.
Hey guys, I'm Flory Marquez, and I'm the founder and SVP of operations of BlockFi. For those of you who are not familiar with the BlockFi platform, we make financial products powered by crypto. Our three products that you can access today are an interest account where you can deposit crypto to BlockFi and earn up to 8.6% per year on those assets, and that includes stablecoin. We also offer trading and US dollar loans backed by crypto. We've had a tremendous past few years. Most recently, we're really proud to have just raised a $30 million Series B. I'm blown away by the fact that we now have over 100 people working in 5 offices across New York, New Jersey, London, Argentina, Poland, And we have over 500 million assets on the platform and customers in over 100 countries. So we've gotten really big. My role at BlockFi has been to do a number of things. I like to joke that on the first day of every year, my job completely changes. And that has included building and currently managing the client service team, building and managing operations. I've built our initial trading team. And most pertinent for what we're going to talk about today, I've built and scaled our marketing team. So when I was asked to come on and talk about, how do you successfully scale apps geared towards retail consumers, the first thing that came to mind was a quote that one of our investors said to me recently. And that's, there are two ways to build a business. You can either invent a completely new technology, something that doesn't exist, and I think Ethereum is an example of that, or you can take an old idea and apply a new technology to it. And that's what we do at BlockFi. We take things that have existed for hundreds of years, typical financial products, and we apply it to a new asset, crypto. 3 years ago, when we started building BlockFi, building a crypto startup without using blockchain technology directly, so not building it on the blockchain, was not a popular choice. My co-founder and I, it was tempting to potentially raise an ICO and be able to scale really rapidly, but instead we chose the longer and slower way to build a company, which is the traditional VC funding route. And the reason that we did that was we recognized two needs. One was the fact that we needed to build financial services for people that were currently investing in crypto. And the reason for that is that the banks won't touch it. And in order to do that, we needed to build a regulatory compliant platform. And to us, that meant building it the traditional route, like a typical fintech company. And the second reason was that we realized that what crypto and Ethereum needed was a company that could entice a non-technical audience. And I think that that audience includes both traditional investors and the traditional finance side of things and consumers. So today, we're going to talk about scaling a company with a consumer-first mindset. So how do we grab all of those people out there that are currently not using crypto and convince them to go into the space? And I think the BlockFi story is a bit different from most of the companies that you'll see over this conference. Most companies here are building completely new solutions that have never existed before. And as I said before, at BlockFi, we keep things very simple. We're taking old systems and making them available to crypto. And I think what the Ethereum ecospace needs is both. We need companies that build on the protocol and expand technology to create systems that have never existed before. But we also need companies that can build the bridge between how consumers are interacting with centralized applications today and convince them to purchase or get into crypto for the first time. So our vision from the beginning was to make crypto digestible for a regular consumer. And I kind of think about BlockFi as the gateway drug for crypto. So can we convince you to get your assets off of just the regular banking system and give you a reason to invest in something better? And the way we started out was 3 years ago. We looked around the blockchain ecosphere, and there were a lot of things that made it difficult for a non-technical consumer to get invested into crypto. And I think I can summarize it in three things. The first was crypto suffered from a bad reputation. It was associated with illegal activities. I think we've come a long way since then. The second was that companies that were building real products were building for an already advanced technical audience. So when I would go on crypto company websites 3 to 4 years ago, the language and the description of the products was extremely technical. And it made me feel as a non-technical person that I didn't understand enough about what these companies were building to deserve to get involved or invest in the space. And the third reason is that unlike typical consumer-facing companies, most blockchain companies didn't offer the basic customer experience that other centralized applications did. And that includes things like a working support email and a phone number where if you call, someone picks up the phone. And at BlockFi, I think we believe that our bar is the same as any centralized application when it comes to customer experience. So as we think about, how do you build consumer-facing apps and what do I attribute our continued rapid success? I think it comes down to one main theme, and that is an unrelenting focus on customer experience. And I can break that down into three things. The first is always putting the client first. So when you're first launching a company, it's going to take a while for your app to be able to self-service potential clients. And what I mean by self-service is an example like Uber. If you're taking an Uber and your driver doesn't show up, now you can, in 3 clicks, get reimbursed for the no-show and get your $5 back, and you never had to talk to a client service representative. When you're first starting a company, it's going to take a while for your technology to be able to get there. So the key is making sure that you have the ability for clients to interact with you, and that interaction gives your first adopters trust in your service, which then fuels later adoption and allows you to get to the stage where you can have a self-servicing app. The second thing, putting client experience first, is speaking in terms that people know. So one thing that we've really focused on is how can we take a design or language that mimics what people already know how to use on other applications on their mobile phones and make that applicable to the BlockFi app. And I think you can expand this beyond just UX and UI and think about it as language when you're describing certain things to people who have never invested in crypto. And the best example that I can think of is when we're describing stablecoins. Stablecoins are super powerful, and I think they can change the world, especially for a lot of people who live overseas and don't have access to stable currencies. But when you're explaining it to a non-technical consumer, one thing I like to do is compare it to a Venmo balance. A Venmo balance is not cash, it's not FDIC insured, but you can turn it into cash whenever you want to. And while that's not a accurate technical description of what a stablecoin does, that type of language allows consumers who aren't currently in crypto to feel like they can understand what that type of technology does and how they can use it. And the third way that we've focused on customer experience is building products that people know how to use. And in some ways, I think it's on us to almost obfuscate the blockchain when we're building our UI. We've always focused on creating an interface that simplifies user actions. And one thing that I think is very challenging when you're building products is to be able to separate yourself from the complexities of the backend and the infrastructure that you're building and take a step back and think about, for a regular consumer that is non-technical, what do they actually need to know? What do they want to know? And how can we design an experience to simplify that process? So those are the key points that helped us get to where we are today. And the real reason that I'm very excited to be here is because we have a very exciting product announcement coming out. And I'd like to invite our Director of Product Management, Jerry Michaels, up on this virtual stage to help me let you guys know what we've built.
Hey guys, can you hear me okay, Lori?
Yeah, loud and clear.
Awesome.
So,
yeah, so
Jerry, we're really excited to have you. What do you want to tell our audience?
Yeah, so today's the first day where we've launched our BlockFi mobile application. It's available for both iOS and Android on the App Store and Google Play.
I'm super pumped. I've already downloaded the application and given a very non-biased 5 out of 5 star review on the mobile store. Before we get into the nitty-gritty, I know that being on this stage holds a special spot in Jerry's heart because he's a longtime holder in Ethereum. How long have you been investing in it?
I've been investing, but more so interested in Ethereum projects since 2016. So I'm a big fan of BlockFi, obviously, but I'm particularly interested in DeFi projects like MakerDAO, Uniswap, Compound, etc.
Yeah, and I think that's important because I think you've always had a very kind of like deep understanding of blockchain technology. So I think when I was talking about earlier, the importance of kind of separating ourselves from the complexities of what's going on the back end and creating a simple design, that's definitely a challenge you've had to work through. What was it like designing our mobile app, and how did you get it to the simple form it's in today?
Yeah, so I mean, when we're working with engineering and design, we're trying to strike a balance. We want to be robust, acknowledging the important aspects of a blockchain transaction, but we kind of want to put a layer of abstraction on top of it, because a lot of our clients are first-time crypto users. So it's critical to be able to clearly define their intent, what they're trying to do, without having the client worry about the intricacies of any given blockchain.
Yeah, definitely. And I think that's one thing that we've really worked on in the app, which is at a high level, you can interact with it and never have to see the complexities of what's going on behind it. But we do give people the ability to dig in further and get those details if they need it. And I think that goes to a big theme, which is, how do you simplify something as complex as the blockchain?
Yeah, so I mean, when we're working to simplify that a bit, we're trying to use different elements of like conversational language on the platform to guide through users through like a step-by-step approach. So for example, they're executing a trade or applying for a loan or trying to deposit or withdraw crypto into their interest account. Ultimately, we feel that there's a huge population of users that don't yet fully understand crypto, and that's fine. We want to cater both to crypto veterans and, more importantly, new joiners who are experiencing BlockFi and crypto as kind of their first take. And I think you'll see that kind of in the way that we went about building the application.
Awesome. So enough about it. Do you want to show us what it looks like?
Exactly. Yeah. So I wish I could do a nice live demo pushing the phone to the screen, but to save the audience from any hiccups, I just have some screenshots just that I wanted to talk through. So with the mobile app, we tried to take a really clean approach, just showing just relevant information that a customer wants to see about their accounts. So you hit our dashboard, you see your overview of your interest account in dollar terms. You could see the assets that you're using with us on the platform, what your balance is, how much interest you've earned, that you've been paid so far, and what you've earned so far for the month. Off the home screen, you could just dive right in a little bit deeper. I'm looking at my interest account and seeing my breakout by different assets. I can choose a particular asset and just see the overview of what I have on the platform. I can see the interest rate that I'm currently earning. And I mentioned a little bit of that conversational language in our design. And an example of that is like, for example, as you go through a withdrawal workflow, just trying to abstract a bit what's going on, saying, how much do you want to withdraw? Where do you want your funds to go? You could have already pre-saved cryptocurrency addresses to your account, so you're not fumbling with alphanumeric public addresses, just selecting quickly on the fly. And then just with a couple clicks, you're reviewing the blockchain transaction you're about to execute and ultimately go through your transaction. So this is our first step. It's an exciting launch for us, and I'm super excited to get feedback from our users. And we have a lot coming up over the next couple months to keep building additional features into the app and responding to feedback and keep iterating.
Awesome. Yeah, I'm super pumped that I can finally access that sweet 8.6% on my phone now and constantly check my balances in times like this when the economy is not doing its greatest. Definitely getting a stable yield makes a big difference. So thank you for all the hard work you put into getting this onto people's phones. And we're really excited to get downloads on the App Store and the Android Store. And thank you for letting us come on stage and unveiling our new product.
Thanks for having me. This is awesome.
Alrighty. Well, if you guys want to reach us, as I mentioned, we have excellent client service, and you can reach us at support@blockfi.com. Give us a call, follow us on Twitter, And I'll look out for your downloads and reviews in our App Store. Thanks, guys.
Thanks, everyone.
Hi, everybody, and thank you very much for joining my call. One second, I have issues with voice. All right, so I open again. Sorry, seems to be some technical problems. So again, the talk today is about the institutional case for digital currency. I'm going to look a little bit from institutional point of view about how these things are built. About myself, I work as a chief blockchain scientist at eToro and have a team of scientists building products for eToro called eToro X Labs. And I work in the university as the head of the financial transparency group at the University of Copenhagen. My background is within math finance and working within trading for a while. And I joined after eToro acquired Firma. So going all the way back to Bitcoin, one of the early applications has been around tokenization of assets, and projects such as Scarlet Coin in the early days, looking into fantastic ways to try and tokenize different asset classes. We've seen also the growth around BitShares, looking around the variety of asset classes that are tokenized, but had some dependencies on the BitShares ecosystem. Until what we've seen today, which is quite extensive, a bunch of stable coins. Most of them are USD based, even though some of them are trying to cover more and more currencies. And the later growth toward the adoptions and the potential that we see now, both by the Central Bank of China looking into central bank digital currencies. We've seen before a long talk about central bank digital currencies, as well as institutions adopting their own currencies like JP Morgan coins. And Sweden as well is experiencing with it. And France have an open goal for building such a currency. So it seems like in order to achieve the next stage, which is very promising, we need to move towards more adaptable system that are more in line with the way institutionals are working and thinking of it. So what I'm going to cover here, we're going to look both from the point of view of developed economies and emerging economies. And much of the promise in developed economies is around much better monitoring system for risk, looking at systematic risk in live using a system that have live reconciliation, ability to mitigate a lot of the post-trade challenges and actually save on post-trade processing, having improved AML and connections, and generally a reduction of costs around the trade cycle. Looking more into emerging economies, we see a possibility to lower the cost of remittance, which are still quite high. And we see a lot of effects that can help support the governments that are a bit more challenged and making more inclusive and enhancing liquidity in many of these markets. In most of these areas, we can see a lot of support for building stable coins and others, but we need to work a little bit forwards toward the regulation and working closer to it. The opportunity for impact in developed economy, also including the vast increase in market turnovers around currencies, including a bunch of currency swaps and derivatives, but we've seen a very large increase of about 3 times the size over the last 15 years. This market is ranging to be over $12 trillion, and all of the trade and changes could work really nicely within stablecoin and can be more cost effective. Going to developed economy still, we have large markets for derivatives, and we start seeing much more infrastructure that is affiliated for it. But this market is now $640 trillion and has a bunch of derivatives. Large part of them are interest rate contracts. But here we can still see a lot of settlements and work around stable coins to be able to be more efficient. So in short, we have large costs around settlements of derivatives, where gross transfer is in the range of $12,000 billion. And the estimated yearly cost is about 12 to 15 to 32 billion. Also in terms of KYC and AML, we have, based on research of Thomson Reuters, we've seen that the average cost for 1,000 biggest banks is $60 million a year around KYC, which means it's a yearly market of 60 billion, not including costs about the delays in inefficiencies around the KYC, as well as fines that many of these banks receive. 1 second. Okay. All right. In terms of emerging economies, we've seen a lot of debt market there, which is based on US dollars already in these days. And a lot of this could be cleared and settled using stablecoins. And this amount in percentage of the market outside of the US is roughly 20% of it is in emerging market economies of debt. Again, about 4 trillion in size and been growing rapidly. We also see opportunities for building more stable coins in varieties of currencies to allow you to have debt in your native currency. Another very interesting element in here is we've seen a long growth from the 80s of the personal remittance amounts in US dollar billions, as well as a large growth in the percentage of GDP in the Sub-Saharan Africa that is actually covered by that. But one of the largest challenges for entrepreneurs is that there are quite large costs for setting up remittance-based businesses of $20 to $30 million. But part of the element of that is, of course, that with building decentralized technologies, we can really reduce a lot of the cost around of this infrastructure. And using existing decentralized infrastructure, you can actually connect to a bunch of those. And this can actually reduce the cost of setting up remittance-based businesses and innovation. So if we look at the opportunity for impact in emerging economies, we can see that, well, cross-border remittance has $600 billion euros a year. The average cost for a small transfer is 7% of the amount. So it's roughly to 42 billion. As well as we've seen a lot of growth in economic value in Sub-Saharan Africa through investment in ICT. And we've seen growth of 150 billions, but we think these numbers can be much larger with making it easier for business to operate it and requirement of less cash. So what are the tools that we can actually use in order to provide some of the services? So one of the nice things from an organization and institutional point of view is that real-time reconciliation is available almost by construction when you're using digital currencies. You can see the value of all of your assets, and you can see a transfer in low cost, and you can even provide retention services and custody on top of it. More interestingly, even that the programmable smart contracts can offer ability of building like Lego blocks of a variety of services that can really be an enhanced multipliers on building technologies. We'll get a bit more into it in a little bit. From a more personal point of view, the instant global settlement give you a low transaction cost, as well as can help you with transparency of seeing all the funds related to what you do, and give you ownership and direct ownership of all of your assets, as well as integration to custody service. The risk ahead that we'd like to see much more work built into is trying to really understand if building stuff around decentralized finance technology can have implication in terms of financial stability. We have seen some new products. Some of them were discussed today. Like if we talk about loans and flash loans, they can create new transactions that weren't possible today. You can build transactions which are fairly complex that can run in a very quick and dependent manner. Would that have any implication of financial stability? Will that have issues of compliance with local regulations? Working with one market which is global may not make you completely comply with all of local regulation. Also, in terms of monetary policy, we need to see how the things are affecting that. There are also a new set of challenges that we can start thinking about and working on, and we can contribute a lot. Transparency is very basic to work with blockchain technology, as you can see the variety stuff on the transaction. However, it is very complex to do it in the way that is required by different regulation regimes. And you need to make it in a way that is a harmony and compliance with a variety of regimes. Also, we need to see how that's related to systematic risk and exposure for different parts coming from financial technologies. So back into the compositional Lego blocks, these have a lot of effect, and we would like to see more of these areas build around areas which are really related to regulation and growth of the technology. What I mean here is while we reach a $1 billion market cap around DeFi, it's still market that is highly built towards people which are highly advanced and are highly acceptant of problems. So even if we've seen some of the hacks that happened recently, we're still seeing a lot of understanding to those. because this is very common for a more complex kind of part of the ecosystem. However, if you want to work directly with regulators, you want to work with scalable technology that leads to end products and end customers, you need to build a technology that is much more robust and has to deal with AML, KYC, and identity. These areas could be connected to a vast majority of whatever DeFi application we offer today. You could offer any decentralized exchange an identity layer on top of it and possibly affect liquidity pools. And I would love to see more people working on these kind of problems. The same in terms of credit issuance and credit scoring. These are very basic issues in the normal system. And credit is also used by the companies that actually are funding a lot of the DeFi companies. But we'd really like to see how can we build more around it? How can we actually connect this element directly to DeFi technology? Can we offer different lending rates for people based on the credit scoring? This could be a very interesting element and could be allowing us come closer to what is expected today by traditional companies. So we're really meeting a part in the road where we can go to see a lot of work that is done on the permissioned and permissionless blockchains, where the permission blockchain currently is where you see a lot of development, a lot of corporate development around large projects. And we also seen some of that in some of the work that is built around central bank digital currencies. Mainly because of scalability, which prevents you to build a trusted and large-scale system, as well as encryption, because a lot of transactions require to stay private. And while we have advances around zero-knowledge proof and around multi-party computations, we're still not able to see it in the mainstream of transaction around the crypto space. The same goes in terms of KYC and AML integration. In a more permissioned infrastructure, it is natural to have that directly because you have a prevention of who is joining the system. However, in a permissionless blockchain, adding a KYC AML layers and identity layers is not trivial as well, especially to make it in a way that will make it to the level that regulators can live with that. This is a big challenge. But I think that these areas could be done with decomposable smart contracts and can easily allow us move more to the permissionless space and having the potential, the same of the internet on a public domain where we can see a lot of money application moving there. One challenge that is not trivial to solve there and is maybe a little bit controversial is anything to do with the revertibility of smart contracts. These challenges is something we face already from the really, really early phase and times of the decentralized internet, when we've seen the fork in Ethereum happening around the DAO and others. Because for a system to be fully scalable, you need to have some mitigation of mistakes, and these are still not built today. But this would be a very interesting area to look into developing, both in research, but also in terms of applications. So to conclude what we're discussing here today, we've seen that we walk a long way. We have actually built a long and great invention within decentralized finances. We really benefit from the composability of smart contracts that allow you to actually integrate a bunch of systems. And I think it will be very interesting to see if we can add more systems that are really based on regulations. In terms of transparency, the technology is very basic and great for it, and the infrastructure can help us build it and mitigate a lot of legacy issues around it. And reconciliation can allow us live monitoring risk, can allow us live seeing risk and seeing a problem as they occurred, and can prevent fraud in live, and improving transaction with risk and replying to them in live. Still, we need to start talking more about how we work with compliance, how do we actually move ourselves towards the direction that is led by the institutions and where the vast amount of assets are there. And also to see how we can add real life value and real value added to applications today. We also want to see how we can affect systematic risk and how we can use the technology to really reduce a lot of them in the next financial crisis. Yeah, if you're interested in more and getting in touch related to that, please welcome to contact me and our teams. In eToro, we are very committed to create social trading access to the global financial market and make the access really transparent. And in eToroX, we are building more professional-based markets for the pro players. And we have a bunch of tokenized assets, 17, offering 15 different stablecoins and a few others. And as well as in the financial transparency group, where we accept PhDs and postdocs, and we build a lot of research on this area. So yeah, thank you very much.
Hi, everybody.
Hi, everybody. Hi, everybody. Hi, everybody. Hi,
All right, sorry about that.
All right, sorry about that. All right, sorry about that.
I am going.
I am going. I am going. I am
Jeez. Okay. There we go. There we go. There we go. There we go. Great. Okay. Great. Okay. 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 Nope. 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 Okay. You can hear me now. It's good. Great. Okay. I'm live. Apologies, everybody. Apparently, there's a few things that you can't work out in the green room. You just have to play it by ear when you go live. So, hi guys. My name's Carolyn, and I'm head of strategy and BD at Thesis. It's the parent company of the Keep Network, and I've been in the crypto space for about 5 years. I started out as one of the first employees at Consensus, and I actually helped put on one of the first Ethereals. So did that for a while, and then I left to join a Bitcoin maximalist startup, Casa, with folks like Jameson Lopp and Elena from Trezor. It was a really interesting experience, and I got a refresher on some of the fundamentals of Bitcoin, like resilience, security, adversarial thinking, and empowering individual sovereignty above all else. At the end of the day, I'm a technologist, builder first and a hodler second. So I said goodbye to the Bitcoin-only world, and I was really excited to meet Matt Luongo at Thesis. And they're working on some really interesting stuff around bridging the best of both worlds with TBTC. So the title of this talk is from money Legos to blockchain Legos. And what that means is, you know, if you think about it, some of us came from the world computer and unstoppable code meme. But right now, the big one is DeFi, what we've been talking about all day. So money Legos is the idea that decentralized finance can allow you to stack all these homespun financial primitives on top of each other, and you can build a trustless, customized finance stack, which is awesome. And I'm going to talk today about TBTC, which is an important money Lego that actually serves as a connector piece between blockchains. And you'll hear more in a second about why it's important that we start thinking about DeFi and the crypto ecosystem in terms of blockchain Legos instead of just money Legos. So to jump into that, let's talk about DeFi. Today, DeFi is around $850 million market cap, give or take. And I think we're all excited about this, but the question is, can DeFi keep growing? Is it as exciting as we think? Because when you start to compare it to the 26 billion market cap for Ether, you realize maybe we're going to hit a ceiling soon. And when you think about projects like Maker, these projects that are limited by collateral, we're all thinking, how can we get access to more value on Ethereum to do more DeFi? Stack those Legos, right? And to me, the next obvious pool of collateral is Bitcoin, which is just a little bit bigger than Ethereum. So one way to think about this problem is, how do we bring Bitcoin or DeFi to Bitcoiners? honestly, I think this is a little bit paternalistic. If any Bitcoiners are watching this, they'd say, Bitcoin doesn't need DeFi, right? Bitcoin is DeFi. And another way to look at it is, sure, Bitcoin's the first DeFi with be your own bank and digital cash. Great. Let's just move on to the next thing, loans, stuff like that. And another way to look at it is, how do we bring Bitcoin
Hey everyone, my name is Lung. I'm the Chief Technology Officer at the Ren project. And at the Ren project, we're building RenVM, which is an interoperability bridge between blockchains. So today I want to talk to you about how we can use something like that to bring cross-chain assets to DeFi. I want to talk about what universal interoperability is. I want to touch on why it's important, and I want to touch on some of the technical challenges in achieving this. And I want to talk about how we can solve some of the challenges and ultimately arrive at the solution that is RenVM. So jumping straight in, what is universal interoperability? Well, interoperability is talked about a lot, and it's a label that gets slapped on a lot of different projects, and often because projects exhibit a very specialized form of interoperability. And when we talk about interoperability, we're really just talking about the ability for two blockchains to talk to each other. But when we talk about universal interoperability, we're saying that we want these blockchains to talk to each other about any particular asset between any two blockchains and for any application, even if it's an application that doesn't yet exist. So the problem with specialized forms of interoperability is that they're only good for the specific thing that they specialize in. And I think, when we built the blockchain community years ago, we couldn't have imagined some of the applications that we have today. So when we build a universal interoperability solution, we need to make sure that it's going to continue to work into the future. So why do we want this? Well, basically, it comes down to the fact that some projects are good at some things and some projects are bad at some things. Now, these could be technical solutions, which are probably the more focused on things. So whether we're talking about transaction throughput or we're talking about transaction finality, but it can also be a financial thing. So we can be talking about market capitalization or liquidity, but it can also be a community thing. So we can be talking about marketing and user adoption, or we can be talking about, the grassroots DeFi ecosystem that a blockchain like Ethereum has. And the other thing we talk about generally is diversity of asset classes. So this slide was taken from the end of last year, so these numbers are probably a little bit out of date. But at the moment, most of Ethereum DeFi is built on the back of ETH. And it's also built on the back of a few stablecoins. But we look at the Bitcoin market cap and we see that there's a much bigger pool of assets to tap into there. And it's not just Bitcoin. This is also the case for Zcash, Bitcoin Cash, Litecoin. Most of the top 10 projects are not actually accessible to Ethereum today. But being able to tap into that using a universal interoperability solution will allow us to use these different assets and different asset classes in our DeFi ecosystems. And this is great for lending and borrowing platforms. It's great for automated market making bots. It's great for liquidity. It generally just helps us build a more mature and capable DeFi financial system. The other thing that we get with diversity is a bit of risk diversification as well. So if a single asset class crashes, we may see that our other assets remain stable, or they do something else, or they maybe don't crash nearly as hard. And this can help us keep our systems less likely to liquidate or continue to be stable in times of volatility, or at least more stable. So there's already a few approaches to interoperability, but none of them really hit what we might call universal. There's atomic swaps, which are great for exchanging two assets. As long as you already know who you're going to exchange the asset with, you already know what assets you're working with, and you already know the price, and you're okay with either party being able to cancel the swap at any point. So this is a pretty limited use case, and there hasn't been huge adoption of atomic swaps. And they don't work for general applications, and they don't actually work for every single blockchain either. The other approach is oracles, which allow us to access a price feed from assets on other chains. And this can be useful for creating synthetics, and synthetics can be useful for gaining price exposure, but they're not useful for being able to redeem the underlying asset. If you had a synthetic Bitcoin, this is not the same thing as actually having access to Bitcoin. Then we have multi-sigs, and we also have custodians. These are solutions that are sort of active at the moment in some way or another, and we'll talk a little bit about them in a minute, but they allow for tokenized representation. We also have relays, which allow us to take the headers of one chain and embed them in another. And this can be useful for transferring information from one chain to another, but relays aren't always bidirectional. For example, you can't put something into the Bitcoin blockchain as far as a relay goes, because its scripting language is just not powerful enough. And finally, we have layer 1 protocols. Layer 1 protocols try to address interoperability right within the blockchain itself. For example, Polkadot or Cosmos. And while this is super useful, it's still not quite universal, because Bitcoin doesn't speak those languages. Zcash doesn't speak those languages. Litecoin, even Ethereum don't. And it's unlikely that they'll adopt them. So we need a different solution. We need something that can cater to all of these blockchains, all of the assets, and allow us to still communicate with any kind of application. So the interoperability solution we're looking for, it needs to be able to support a wide range of assets. It needs to be able to support data and events, and it needs to be able to protect itself against adversaries. Supporting a wide range of events is a pretty obvious need. the use for cryptocurrencies and access to assets on other chains is sort of the core desire when it comes to universal interoperability. The ability to cater to data and events allow us to directly call smart contracts. So it's not a very good user experience if you have to move your asset, and then as a second step, you have to interact with a smart contract. This, when you want to sort of compound this over multiple chains and multiple applications, this gets very messy very quickly. And obviously, every decentralized system that we want to build needs to know how it's going to protect itself from adversaries, both rational and irrational. So let's jump into how we can support assets. But generally speaking, the most general and flexible approach to moving assets between chains is something called tokenized representation. And at a high level, they all do more or less the same thing. Let's say we want to move Bitcoin onto Ethereum, and we have some user, Alice. She would take that Bitcoin and she would put it into a private key. And that Bitcoin would be locked in that private key for redemption at a later time. And then that private key would return a minting signature that gives Alice the right to mint an ERC20 representation of that Bitcoin on Ethereum. And then at any point, Alice can give that ERC20 to other people or use it inside a smart contract. And then someone can burn all or part of that Bitcoin and redeem the underlying asset again and get their real Bitcoin back on the Bitcoin blockchain. So the secret, or the interesting stuff, the guts of it all, is how do we manage this private key? The first and most obvious way is to use a central custodian. And there are solutions out there like WBTC that have recently been adopted into MakerDAO that do exactly this. You have a single custodian that takes control of the private key, and they manage its security. Now, this has a few advantages, and it has some obvious disadvantages. It's fast. The custodian only has to provide one signature. It's cheap because as far as on-chain transactions go, we're still only talking about one signature, which is about as cheap as it gets. And it's easy. We have a pretty good understanding of how to manage individual private keys. This is something we've been doing since the birth of blockchain. But obviously it's trusted and permissioned. So you need to trust that the underlying custodian is going to behave, both in the sense that they're not going to run away with the money, and in the sense that they're going to honor all use of the system. So if you deposit a Bitcoin into their private key, they will mint you an ERC20 representation. And if you burn an ERC20 representation, they will give you back your original Bitcoin. But even if you do trust them, it's still not fault tolerant. This single custodian could have an accidental fault, whether malicious or otherwise. Their system could accidentally go offline temporarily, and you might miss a price opportunity. Or it could be hacked and they could lose funds that way. So even if you trust the custodian, there are other ways in which this sort of single central system can fail. So the next most obvious step to take is to turn this private key into a multi-sig, which we have in this diagram a 2 out of 3 multi-sig. So it's similar to a custodian, but instead of a single entity being in charge, we have multiple entities, and they collectively are able to take custody of the Bitcoin and collectively mint it as an ERC20. And in this case, you may only need, let's say, 2 out of 3 or 15 out of 20 or something like this. Now, this is an improvement, and it still has some of the advantages, but it has its own disadvantages. So it's still fast. Each party in this multi-sig only has to do one signature, and they don't have to communicate with each other. It's not cheap, though, because when you want to take these signatures and you want to put them on chain and you want to make as many of them as possible to be as decentralized as possible, this starts getting very expensive to verify. It is easy, where most people are pretty comfortable with multi-signatures. Most blockchains support multi-signatures. However, it's still not quite there. It's still semi-trusted and semi-permissioned, because at most, at least on the Bitcoin chain, you can have 20 out of 20 in a multi-sig, which is still not very decentralized. We want to be able to do much better than that. It is fault tolerant to some degree. Depending on how you configure it, you can have some parties go offline, but either accidentally or intentionally. So the next step up is multi-party computations. So this is sort of a newer solution. And what this allows us to do is it allows us to take a private key and kind of turn it into a multi-sig by breaking it down into cryptographic shares that we can distribute to hundreds of nodes. This is great. It's cheap because to the chain, it only looks like a single private key. It's trustless and permissionless in the sense that we can scale this up much larger than we can scale a multi-sig. However, modern MPC algorithms that are used for ECDSA signing are not fault tolerant. there are moments where a single machine can go offline and the whole algorithm has to be restarted and retried again. And this is not very practical in a globally distributed Byzantine network, which is the setting in which we're operating. So at the Wren team, we've developed a new MPC algorithm called RZL, which gives us these features that we really want. At any point in the algorithm, up to 1/3 of the parties can fail and the algorithm can still proceed. And it's also much more efficient than modern MPC algorithms, so we can scale it up much larger. Right now, we're running this on 200 machines, and they're able to achieve a theoretical maximum of 700 transactions per second at that size. So RZL is cheap. It's trustless and permissionless. We can scale this up to hundreds of machines, and it's fault tolerant. And it also remains Byzantine fault tolerant. So much like Tendermint consensus algorithm or many of the consensus algorithms out there, it is able to proceed in a safe and secure way as long as less than 1/3 of the participants are adversarial. So this is how we implement asset support. We use this tokenized representation where the private key is managed by an MPC algorithm. So next we need to think about data and events and how we can attach them to our asset transfers. This is because we want to be able to directly call smart contracts. If we don't have the addition of data, then we can't know what smart contract we're calling, and we have to break it down into multiple steps and expose the user to wrapping and unwrapping. And this is going to get very messy if you want to start interacting with multiple DeFi applications on multiple chains with multiple different types of assets. You're going to be exposed to many, many different steps, and users are going to have to juggle all sorts of tokens to make this work, and it's just not viable. So instead of sending it to a private key, we actually send it to a script. We make sure the script is only spendable by the MPC network, so it's essentially equivalent. And inside that script, we put a hash of our application data. And when our MPC network signs our minting signature, it also signs this hash, and that kind of commits to this application data. That means when we present it to the chain, where we're going to mint our tokenized representation, this data cannot be modified. So we can leave this up to third parties to submit on our behalf. We can avoid gas. We can avoid all of these complications. So it looks something like this. Alice transfers it to a script. That script contains the amount. It contains a hash of the data, and it contains a little bit of extra stuff saying that it can only be spent by the MPC network. And instead of just signing the amount, the MPC network also signs the amount and the hash. And then we can present this to the chain, and we can also present our application data, and the chain can verify that that data ultimately hashes to what was signed by the MPC network. So using this technique, we can support data and events. So lastly, we need to think about how we can protect ourselves against adversaries. All Byzantine networks have some attack threshold. They have some threshold beyond which they're no longer safe and their properties no longer hold. So it's important that we understand what that threshold is, what can happen, and we can make it as hard as possible for a rational adversary who wants to profit from the system to be able to do so, and as hard as possible for an irrational adversary who just wants to attack the system because they want to attack the system. Maybe they're a government, maybe they're a competitor, or maybe they just want to watch the world burn. So a common solution to this is understanding that there is an amount of value in our universal interoperability protocol that can be extracted. And we call this the locked value. These are all the assets that are currently away from home that your universal interoperability protocol is managing. And we want the cost to attack the system to be higher than that locked value. And the easiest way to do this, and the only way to put a theoretical limit on this that we know of, is to require a bond. So every node has a bond that they have to submit in order to participate in the MPC network. And collectively, we want to try and keep this bond value above the locked asset value. Now, traditionally, this is usually done with things like liquidation mechanisms. And this works very well for DeFi applications, but it does not work for cross-chain interoperability solutions. And it doesn't work for a number of reasons. So instead, RenVM uses something called adjusted fees. So when we have our locked value, let's call it L, and we have our bond, which we want to keep, let's say, at 3 times larger than that. As L grows, or as B shrinks, both are sort of equivalent in direction, we need to suddenly adjust B. Now, typically in a liquidation mechanism, you would require all of the nodes to bring in more collateral and bump it up. And if they don't do this, they would be liquidated, which is very dangerous. It's risky for the nodes. It reduces the capacity of the system. And it cannot stay in a recovered state if there's strong market volatility, which we know happens in crypto all the time and happened as recently as March of this year. So instead of liquidating, we adjust the underlying fees. Now, when you adjust the fees of the system, one of two things has to eventually happen. Either the bond becomes worth more because the fees being generated by the system are more, or demand shrinks in response to the increased fees. But either way, the balance between the locked value and the bond value is restored, and we can keep the bond value greater than the locked value. And this means that at any time, if someone steals the locked value, only at that time, when they're actually malicious, do we take away their bond and we use it to restore the peg. So such a system allows us to restore the peg. It has no explicit price feed. It has no risk for the nodes, which is not the case in a liquidation mechanism. It's strong during times of high market volatility. As more market volatility is there, volume typically increases, so fees increase, and so capacity increases. And only slashes nodes under adversarial conditions. The downside is that there's latency. If you increase the fees, the bond value doesn't instantly increase, nor does demand instantly drop. But this is why we have other protection mechanisms. And also it requires continuous governance, but you can get around that by having a model that the node operator commits to, and then the node always votes in accordance with that model. So to protect against an irrational adversary and to protect against latency in response to demand and the bond value changing, you introduce a large number of nodes. So as I said before, RenVM uses 200 nodes. And we shuffle those nodes randomly and regularly. You can shuffle them literally every single block if you want to. And the only sort of limiting factor is the fees of the underlying chain that you're working with, let's say Bitcoin. And you can also introduce some level of community governance and reputation to help secure the system that an irrational adversary typically has a much harder time of subverting. So RenVM has all of these features. We bundled all of these solutions together and we've called it RenVM. It allows us to support Zcash, Bitcoin Cash, Bitcoin, and Ethereum today, but can work on theoretically any two pairs of blockchains. It can bounce a single transaction through multiple chains and multiple applications in a single go so that the user never has to experience wrapping and unwrapping. It protects itself against adversaries using the mechanisms we described, and that also allows it to remain capital efficient in the face of increased demand. We'll be live on mainnet very soon. We expect to be live sometime this month. At this stage, we're just waiting for our audits to be completed, but that is stinted for a mid to late May release. So if you want to learn more about it or you want to start building with it, come check us out on Telegram, follow us on Twitter, check out our GitHub, get in touch with us, let us know if you have any criticisms, any questions, and we'll be able to hopefully absorb your feedback and have a chat with you. All right. Thanks very much, everybody.
Hello and welcome to our talk, Scaling DeFi Security, Your Approved, Your Crypto. My name is Tal Be'eri and I am a co-founder for Zengo and I lead the security research there. And as a result, the topic of our talk today is very much focused around security and things we found in DeFi apps. So a little bit about Zengo. We were founded in 2017, got VC money a year after, 20 employees, and we are hiring. So hit me up after this talk if you want to join us. And our mission is to create an easy and secure crypto experience for our users, all from their mobile device. And Zengo makes crypto easy. You can buy, store, and earn crypto in a tap. And when we say easy, we found that easy is actually very hard, and we need to work very hard to make things easy for our users. And the first hard thing we did was to implement state-of-the-art cryptography of distributed key generation and signing using multi-party computation and threshold signature scheme into our wallet. And as a result, it is easy for our users. So no more private keys. You can create a wallet in seconds because there's no seed phrase to memorize or write down. It supports multi-chains because this happens in the mathematical level and not in the application layer. So we support BTC, ETH, and many others. And you can buy, store, and crypto in a tap. And Zengo loves Ethereum. We supported Ethereum from the first version of Zengo. We added the ERC20 support soon after. And in DeFi, Compound was our first DeFi integration, and more are coming soon. So let's talk a little bit about our integration of Compound into the wallet. We wanted to use Compound to allow users to earn interest on their ETH and ERC20. We want to make it easy. So we created a dedicated user experience with iPod-like wheel, so people will get it and it will be natural for them. But also we took a deeper look into the security of Compound, which resulted in the liquidation white paper that discusses the internal working of Compound and led to the issue of beta proof that we are going to discuss today. So what is beta proof? When you connect a dApp with a wallet, the user is asked to approve access to their token. So naturally, most users assume they approve access for a specific transaction of a specific amount, just as you approve apps to access Gmail and so forth. But in most dApps, what actually happens is that user grant access for all of their holdings in this token forever. And this is, of course, a very risky situation. So how did we get to this place? It's mainly a result of some problems with the ERC20 standard and the way the apps have understood it. So ERC20 startup is relatively old, from 2015, and authored by Vitalik. And ERC20 thought about allowing other smart contracts to use the ERC20 on behalf of the users, and they created a dedicated method for it, which is approved, that allows the user to say, okay, I approve that smart contract or dApp to access my money. And there is an amount parameter. It said how much money this smart contract is going to take. But asking for approval each time is inconvenient, both for developers and users, because having another transaction means more fees. It may mean more time to approve that transaction, because there are two transactions and they both need to be confirmed on the blockchain, and more user interaction. The user needs to approve two messages. So the easy solution to get around that was to have this approved only once by approving gazillion amount of max amount in this token, and then forget about it, because this approval will allow the dApp to access user funds forever and for every amount. But of course, this is not secure. The user approves access to all funds, and a dApp, which may be rogue or vulnerable or buggy, can spend all of the user funds. And this hot potato, this problem, was then transferred to the wallet. So as a wallet, how can you convey this message that this dApp is asking now to access all of your money, even in the future, and it can spend all of your money? It creates a lot of anxiety, and rightfully so. So again, the easy solution for the browsers and wallet was just to hide it. Let's not tell the user what they are actually doing. We'll call it approve, or not tell them at all, and hopefully everything will be all right. But of course, this is not secure. We can see on the left hand side of the slide a screen of a shot of a dApp browser that is about to give full access to user holdings in a specific token via approve, and all the drama is hidden from the user because it's confirmed payment of 0 ETH and 2 cents of fees. So nothing tells the user they're about to give access to all of their possession in this token to that dApp. So the user is not does not worry, but not for the right reason, just because they are unaware of that security problem. And let's see it, an exploit of that live with the beta proof demo. So we created that demo in order so users can see for themselves what it is all about. And we took care also of the setup phase. This is done over a testnet, so no real money is lost. And we provide the user with the testnet gas and testnet token of FRT. And the user gets free token, 100 free token. And we are all set to test against the rogue app. And this app allegedly is used to swap FRT for ETH and ask for approve all. The browser doesn't show that approve all, just the same transaction of 0 ETH and a few cents for fees. And now we actually gave all access to that rogue app. And now once we interact with this app and want to send only one FRT, then this rogue app will actually send all of our money to an account they own and steal all of user money. No money is left there. Okay, so I hope it convinced you this is something very dangerous. And now let's go back to the presentation. So we needed to solve that problem for our users, and therefore we created a generic construct to bind dApp spend with ERC20 approve. That way, with a single user interaction, an approved transaction is sent to the ERC contract, and the actual spend function that of the dApp are being called. We're sending them in parallel to reduce latency. And although it sounds trivial, there are a lot of details in the actual implementation that we solved when we implemented that construct. Then we use that construct in our compound integration, and we're working directly with the protocol smart contract and not via dApp. So we solved that issue of better proof to our users. But what about other wallets users? We want to take care of them too. So we shared our solution as open source. So every wallet can use it if they want. We reported that issue to the vulnerable wallets. So now they are aware. And we also shared some solution to user at risk that allow them to close open approval to existing dApps. Then we went on to raise user awareness. We created a publicly available demo rogue app that you saw the video was using that, and you can experiment with it in this link. And we shared our insight with the publication. And thank you, CoinDesk and others, for picking that up and raising the awareness. And we had quite good results with that. So many publications picked that up, and hopefully many users read about it and are more educated and know the risks and can avoid maybe more vulnerable wallets. And secondly, vulnerable wallets themselves are either fixing right now or have already fixed. So this is very good, and I think we had improved the security of DeFi a little bit with that. So what are the main takeaways from that story? So first of all, we have to understand that security is an everlasting process. And as DeFi grows, so does the threat, so does our investment, required investment in security. Security is never, we are never done with security. We will never solve it. We will just have to continue and invest in it more and more as the usage increases. And what was appropriate in the early days is not acceptable today. So in the early days, there wasn't too much money in dApps, and maybe they were mostly used for non-financial applications. And the users were tech-savvy early adopters of Ethereum. But right now, as DeFi goes into mainstream, we have mainstream users that don't want to know and care about the inner workings of Ethereum and ERC20 approves. And we're handling also as a community, a lot of user money is locked in DeFi contracts. So we need to take very good care in handling that money. And therefore, we need to upgrade our security. And just to illustrate, we can think of what happened with Zoom, with the recent Corona outbreak. So Zoom, in one day, turned from a player in a niche market to a mainstream application being used by many mainstream users. And as a result, a lot of security problems that were already there surfaced and was highlighted. And as a result, all Zoom is doing right now, just fixing that security issues. And this is a lesson that we can learn in the DeFi community. And secondly, there's maybe a greater lesson. And so we were not the first one to learn about Better Proof. There are Medium posts about it from years ago. And we could easily take the easy solution and just do as others do and ask for maximal approve and be done with it. But we decided to take the harder path and try to solve it and raise awareness for that. And and I think we had encouraging results as for our efforts. So I encourage you also to try to take the harder path, do the right thing, and protect DeFi users. With that, we conclude. If you want to learn more or talk to us, we have a vivid social presence, so talk to us. Take care and have a great conference.
Hey there. Hi, everybody. Thanks for joining us. I hope you're enjoying Ethereal Summit so far. We're kicking off this next panel entitled Challenges of Operating and Growing a DeFi Platform. There's Felix. Hey, Felix. So we've got a great lineup, great set of DeFi leaders, I think, in this space. Great group of panelists so far. Just by way of introduction, my name is Jordan Lyle. I'll be moderating the panel. I work at Consensus. I'm a product lead within the Codify group. I work on a number of different projects. My team is responsible for the DeFi score, which is an open source framework for analyzing risk in DeFi. We recently launched the Inspect product, which is kind of like a dashboard for security and transparency information across the different DeFi protocols. So I'm really excited to kind of kick off this conversation here. Let's start by doing just a quick round of intros. Tell us a little bit about yourself, who you are, the company you represent. Try to keep it around a minute. We can start with Felix. Go for it.
Sounds good. Yeah, thanks for having me. My name is Felix, and I'm the co-founder and CEO of Set Protocol. What we built is an crypto asset management protocol that enables anybody in the world, whether you're a human, an alien, or a robot, to manage any type of asset using any type of asset management strategy. And what we've done is we built token sets, which is the predominant venue in which you can get a set. And we have about 24 traders who are implementing strategies on Set today. So we're continuing to grow, and we're pretty excited to kind of expand the number of strategies that we're offering to offer it to more users and to be able to handle much larger amounts of kind of rebalances.
Got it, great.
Hey guys,
Antonio,
I'm Antonio. Thanks. Hey guys, I'm Antonio, the founder of DYDX. DYDX is the leading decentralized platform for margin trading, borrowing, and lending on top of Ethereum. So we've been live on mainnet for about a year now, and we've originated over $1 billion in loan originations. Recently, we announced our move into the derivative space. We're launching a BTC perpetual contract. This is going live very soon and is currently in private alpha testing. And this is basically a way to get synthetic price exposure to Bitcoin. And we're really excited about this launch.
Awesome. Hey, Kyle. I don't hear Kyle. Kyle, you're muted.
Hi, I'm Kyle Kistner. I'm co-founder of BZX. BZX is a margin lending and trading platform. Some of our products include tokenized margin loans and tokenized margin positions. It can easily be used as a whitelist on trading platforms and other DeFi front ends.
Thanks, Kyle.
Hey guys, I'm Varun. I'm the co-founder of Neo. So we are essentially a lending and borrowing marketplace. So we were part of the Consensus Accelerator. I've been live for almost 1.5 years now. So it's been in the space for quite some time. So currently working on the next version of the platform. So moving from just being a lending and borrowing marketplace to more of a financial control center of sorts, so that you basically can manage all your assets and pretty much everything when it comes to DeFi on one place. So excited to have a chat with you guys.
Great, excited to have you. Yeah, I'm really excited for a couple different reasons to be kind of a part of this conversation. Like you all have founded, are leading kind of key pieces to like the DeFi landscape, key projects in this space. Let's start out by kind of setting up a framework here. How do you guys think about DeFi? Just high level in general. There are many different ways to kind of slice up DeFi, many different terms that are also kind of used. When you think about DeFi and how do you approach it at your organization? Who wants to kick us off?
I can start. So I first heard about Bitcoin in 2013, and I was fascinated because we had this form of money that had all the properties of the internet. It was 24/7, it was global, it's accessible by anybody, and you can send it instantly from one person to another. And that underlying technology, I believe, can be extended to do everything else in kind of the financial and legal world. And you should be able to, once you have the first form of money, which is Bitcoin, you should be able to do other things like lend, borrow, transact, build derivatives, or perform asset management strategies on it. And really, that's what DeFi is. It's the smart it's this ecosystem that's implementing all of this. And I think that it's become quite amazing how this has come to fruition over the course of the past year and a half. So that's really how I see DeFi, and we are building this from a first principles perspective. We're doing it from, instead of building on top of the existing financial world, where you're essentially applying lipstick to a pig, similar like all the companies like Plaid and PayPal etc. We're rebuilding everything from scratch. And everybody on this panel is building a small component of that. And what's really powerful is the composability of these different projects to build much more interesting things than had ever existed before. So I think that's how we currently think about DeFi and how we fit in.
That's great. I like how you framed it as almost like just the next step after Bitcoin, after Satoshi. This is just whatever we call it, it's just kind of the next step in the path towards decentralization. This is what it's happened to being called now. Any other insights there on kind of at a high level how you think about DeFi in general?
Yeah, sure. I mean, actually, from our perspective, we have kind of been fintech founders. So, I mean, we've been in the fintech space for close to around, 5 to 6 years. And frankly, we actually started off, trying to actually create a neobank in India. But the problem was, the banks just didn't have APIs for us to, create something on top of. And that's how kind of we discovered DeFi. And when we started off like 1.5 years back, the term DeFi itself actually kind of didn't exist. We were just attracted to this proposition of, being able to build on something without someone's permission, specifically a bank. And that's what actually got us excited. I mean, the way we kind of have come to think about DeFi now is just basically a progression from, of finance, from probably banking, which is basically driven by banks, to fintech, which is basically, removing middlemen, making it more efficient, reducing branches, to eventually, sort of DeFi is what we define as, essentially fintech 2.0, wherein we basically completely get rid of the middleman and make it as efficient as possible and let the transactions sort of happen and connect peers from around the world. I mean, fintech and banking has always been very local, and DeFi kind of makes it global, completely, peer-to-peer, and that's what kind of gets excited.
Yeah, I think that was a great introduction by Felix and Varun. Just want to piggyback off what both of them had said. My experience personally is through working at Coinbase. And what I worked on at Coinbase was, as an engineer, worked on a lot of the fiat payment integration. So integrating with things like banks, payment processors, PayPal, etc. And the thing most people don't realize about Coinbase is probably, I would estimate, like 75% at least of their company effort goes to dealing with the traditional payment side. And a very small proportion of it, in terms of the effort spent on Coinbase's part, is actually integrating directly with the crypto side. It's actually, in a way, a lot easier to build some of these new financial products in DeFi rather than in CeFi, which I think is a really important point. And then just to piggyback off what Felix said, I think DeFi is really kind of the epitome, or kind of the continuation of a lot of the promises that we saw with the introduction of Bitcoin. Like Felix said, with Bitcoin, you have for the first time decentralized money, but kind of what's the point of money if you can't do anything with it? So that's why we had the integration of things like decentralized exchanges, and after that, decentralized lending protocols and decentralized derivatives. I think these are just the continuation of the promises and kind of the reason why a lot of people were excited about crypto in the first place.
So the way that we think about DeFi is we look at it as more of a process and a paradigm than a destination. DeFi companies come into this world looking to get to a certain place. Usually we start out non-custodial, and it graduates to a place where everything is decentralized. And you can kind of think of it as decentralizing the micro level interactions that administrators have to do with the protocol, all the way up into the macro interactions where you're setting general policies, you're upgrading contracts, all of those kind of things. So we see DeFi as being, something that is in the process of evolving. And, a lot of people are, thinking about these different terms like open finance, or saying that, DeFi isn't really decentralized. But I think that's kind of like looking at things as a snapshot and not really appreciating the full picture as it's unraveling.
I think that's a great way to think about it. I'm also curious how you guys in your projects individually kind of think about competition. At the end of the day, we're kind of competing over the same users, right? The same liquidity. It's kind of a limited number of DeFi users, at least for now. We're here because we think it's going to grow and expand and disrupt traditional finance. But I'm curious to how you think about competition. Is it really just like we're all in this together, we're competing against traditional finance, or is it truly trying to scrape by and have success for your own project, or you're really trying to compete for the same user? Do you guys have any thoughts on that?
Yeah. I think that like most people's intuition about competition is that it's zero sum. Like if I'm going to win, my competitor needs to lose. But I think if you look at financial markets, if you look at financial history, what you see is that competitors succeed together. The Pepsi, if Pepsi stock goes up, it's likely that Coke stock is going to go up. Competitors in financial markets, their assets are very highly correlated with each other. So your success is going to be also your competitor's success, and everybody's executing on everything just in a slightly different way, putting their own spin on it. Some people prefer Pepsi, some people prefer Coke. If you make a product that's really great, people are going to use it and you'll be successful.
Yeah, I can go next on this. I mostly agree with your view. I would say perhaps my viewpoint is not quite as rosy. I think I see a lot of people in DeFi, depending on which company it is, as kind of like frenemies. I completely agree that the best thing for all of us is to grow the size of the market together. Like even if one DeFi product were to take over literally 100% of the current DeFi user base, that's like barely even one venture-backed company. So the really important thing is for all of us to grow the entire size of the market together. And we should really see, the real competitors are people or kind of centralized exchanges or people that are using centralized crypto infrastructure. And how do we start to get people that are using that infrastructure into using DeFi? And the other thing I would say is a lot of DeFi products, probably as it's pretty evident, are very cooperative and not necessarily competitive. So obviously most of us here rely on other projects, so things like MakerDAO's DAI or different exchanges like Kyber or 0x. So there are a lot of synergies between different things, and I think that makes the ecosystem better as a whole.
Yeah, I think that's right, kind of the characterization, Antonio, of frenemy. To some extent, I think the most important thing, like you mentioned, is growing the pie together. And the question is, how do we do that? And at the end of the day, it's about building things that are useful for people. And that's really what guides us in terms of like what we do and how we serve folks. At the end of the day, if we're able to build products that are better than that of the traditional financial world or in centralized or DeFi, then we should be able to get more users into this ecosystem. And this is really something where we all win together, where it requires improvements from the base layer, it requires dev infrastructure, it requires liquidity infrastructure, it requires really great composability between all the projects together. So I think when those things happen, then we're going to be able to build really great products that deliver a value proposition that is multiple times improvement than what currently exists. And how I currently see it is that it's really the innovator's dilemma, where you have existing financial products that are maybe this good, but DeFi today is only limited in certain assets. The scalability is this good, privacy isn't there, usability isn't there. But the idea is that we can all build together, and our improvement in kind of the value prop and the product will kind of improve exponentially. And at some point, we'll kind of hit parity with existing products and then just be a lot better. And I think that for people who are already in DeFi, they are experiencing that, the lack of friction to getting started and the ease of and transparency of using these products. But I think it's only limited to the 50 to 100,000 people who use it today. So I think our goal in general should be to how do we grow this to the next 10 million, 100 million, billion people? And that's a really long 10 to 20 year journey for all of us. But I think that's why we're doing what we're doing. And I think that's why, despite all these competitive kind of tensions, like, we're all working towards the same direction.
Yeah, that's
completely agree with Felix and Antonio, man. Actually, I just wanted to add something very quickly. I mean, I completely agree with the fact that the real competition is actually with centralized exchanges, and the fact that we are actually creating these financial primitives which are eventually going to compete with centralized exchanges is probably the real competition. Just to add a couple of things here, what we've realized is basically, as most of these protocols and platforms create their own versions, the other teams actually get to learn a bunch from the mistakes or the advantages of most of these protocols, that they actually have some sort of innovations, and they get to incorporate that in the next version of the protocol. So it's a very cyclical sort of a process, and it's very likely that everyone sort of gets to shine, and everyone will have their opportunity under the sun. It's just that whether you can use that opportunity and grow your platform is probably going to be the key. But that's been our learning essentially. And if you've seen in the last couple of years, 2018 was essentially all about Maker and how you were able to mint DAI. 2019 was about Compound and around lending and borrowing. I think 2020 is very likely to be about margin trading and derivatives, and basically the industry kind of moves in cycles, and basically everyone gets to shine eventually.
Yeah, that's great. I think we all agree that like there's like this certain period of disruption that's coming, but the reality of the situation as as leaders of these DeFi protocols, you have bills to pay and developer salaries to pay. So there's a limited runway, right? Whether it's from investors or from the community that's participated in a token sale. I'd be interested to hear like how you measure success in the short term. Are you really, does it come down to cash flow, or is it really just, okay, we're looking at the volume on our platform, we're looking at unique users or total value locked? I'd like to hear more about how you can kind of assess your trajectory or your growth at your project.
Okay, I'll start.
Sure, I can go first. Oh, sorry.
Oh, go ahead.
Okay, thanks, Felix. Yeah, so I can start on this one. So definitely, I think for us at DYDX, one of the really important things we did recently, about 2 months ago, was we started charging trading fees on the platform. So that was a pretty important watershed moment for us. So before this, we were very much in the grow users, grow trading volume, revenue will come later mode. And we're still very much in that mode. Our business doesn't make sense at a really large venture-backed scale unless we grow in a huge way. So our metric that we mostly look at every day is trading volume. And the reason we look at that metric above all the other ones, including like total value locked, number of users, other things like that, is because that's directly proportional to our revenue at DYDX. So very similar to a centralized exchange, we'll just charge taker fees on trades that people make on our platform. And this has been going quite well for us so far. So we just basically look at our revenue and are trying to grow that over time. And this is very similar to how any other venture-backed business will try to scale and try to convince investors that their company is worth something. You basically just take your revenue, take some multiple of that revenue based on the industry you're in and kind of your growth trajectory, and that you can kind of equate to the value of your company. It's a little bit different in DeFi, and I imagine some of my peers will bring up potentially other methods of capturing value, such as tokens or other things. That's something we think about at DYDX as something that could be interesting in the farther future. But our primary focus for now is just on building a product that's actually useful to people, capturing some value off of that. And the way we're currently doing that is with trading fees.
Yeah, to kind of echo what Antonio is saying, we also very much measure our success in terms of trading fees. We were a Kyber affiliate, and so that was bringing us actual revenue. So cash flow is very important, but we're also interested in what the future of our revenue is going to be as well. So if we see that our trading volume is increasing, but we're not gaining more users, that's not necessarily success for us. What we want to see is we want to see growth in trading volume driven by user retention and growth in users. So that's like primarily what we're looking at. We want to see how we're doing now, but also where we're heading.
Makes sense. So at SET, we primarily measure ourselves based on how useful our product is and how many users we end up touching. in a most abstract form. So the more number of users that are holding sets, the more number of traders who are using sets to implement their strategies, the number of venues you can get a set on. Those are things that we measure ultimately our success on and our impact on. But in terms of a business model, we're in a pretty interesting place, because in finance, to provide a little bit of context, in finance, there's really two types of business models. There's one, which is exchanges, which make money based on transaction volume. And then there's banks, which make money based on deposits and taking a percentage of that. Exchanges such as FTX, Coinbase, these derivative exchange products, they're mostly measured on volume. But then you have other products like compound lending products or asset management products that are more based on AUM, and you typically charge a percentage of that. So for SET, in the near term, we see ourselves more as an exchange, maybe something like an eToro, where we're taking a percentage of rebalance volume. But in the longer term, we see that there could be billions or trillions of dollars locked in these assets, don't necessarily rebalance that frequently, and we may become more of an AUM or kind of depository-based business. So asset management is a little bit tricky in that sense.
So
Gotcha.
For
us, actually, so basically one of the things that we have clearly seen, especially in the crypto space over the last, 5 to 7 years, is companies who are actually in crypto, it's actually, they're very profitable. Be it, Coinbase, or, you probably just heard about Cash App being, making tons of money with Bitcoin. So monetizing a crypto product and, making revenue and being profitable in a crypto sort of product is extremely easy, frankly, because it's basically money moving around. And, there are speculators and people who are, used to actually paying a certain amount of fee. So, at least the way we think about it is essentially we have to, grow users and grow AUM, at least in the short term. Our focus currently is essentially around how we can actually get to the first 100,000 or the first 200,000 users, and what essentially do the kind of innovation that you need in terms of the product, so that it can be as seamless as possible. It's almost like, you'd be using a Binance or a Coinbase, and how can we give that kind of an experience to users so that we can get those sort of users on board. And in general, what we've realized is, given our presence in India and essentially in Asia, majority of our users are essentially coming from there, and we want to be sort of the center pillar for DeFi when it comes to Asia, and how we can actually grow users in Asia. And that's the focus for us going forward.
Great. Yeah, that's really good. I'd love to hear a little bit more about the challenges of operating where most of your users are in India. It looks like you have some sunlight, so I can't imagine you're in India. Or is it really just good lighting in your situation, Varun?
It's just good lighting.
Really
yeah, absolutely. Yeah, so up pretty late, man. It's 11:30 here, still in India.
Oh, okay. Yeah, thanks. What time is it for you?
It's almost 12 o'clock, man.
Great. Well, we appreciate you staying up and joining us. I'd love to hear more about specifically India and the challenges that you're facing. I know that it feels like you're pretty plugged in, just based on following you on Twitter, that you're pretty plugged into not just the blockchain scene, but just like maybe the startup and software scene in India. Love to hear maybe a little bit more. From my perspective, it kind of feels like India is kind of softening or loosening their stance or their regulatory kind of view on crypto in general. Is that true?
Oh, definitely. So, I mean, we just like a few months back, we had a very landmark judgment from the Supreme Court here, wherein it actually, the bill which was sort of the circular which was passed by the central bank was kind of squashed down by the Supreme Court, and the on-ramps have kind of opened up. The new circular hasn't come from the central bank as to how these crypto companies and crypto exchanges can actually on-ramp, but things are looking pretty good over the next 3 to 6 months, and hopefully there's going to be a ton of volume which is going to come from India. Usually what happens specifically when it comes to India is that people you can expect a lot of users to come in, but not enough volume. So US or most of the developed markets is where majority of the volume comes in. But if you want your DAUs and MAUs to kind of skyrocket, that's when you actually look towards India to kind of grow that. So I mean, super excited about what's the potential of that going to be like, especially when it comes to DeFi. I think what's going to be very likely is that more and more people are going to be initially attracted to Bitcoin, and eventually transition to DeFi because the sort of sentiment around digital gold and that kind of narrative fits well into what the investment mindset of Indians is around gold in general. So I think that's likely to be the clear progression there.
Yeah, that's great to hear. That makes sense. Let's shift gears a little bit here. The way I see it, one of the core properties of DeFi is permissionless, right? As a user, I don't need anyone's permission to go to this protocol and lend my assets, right? On the other side of the coin, that there's just as much permissionlessness on the developer side and the product builder side. We're living in a time where anyone with an internet connection and a GitHub account can create open source software, deploy a contract, in no time begin pooling liquidity. And we've seen examples just in the past few months where brand new protocols, smart contracts, millions of dollars get rushed into these projects and these smart contracts before an audit has even taken place. I'd like to pose this question of how do we encourage this, right? How do we encourage innovation, risk taking, and development, trying things out, experimenting, but at the same time having the user experience and security and safety in mind? How do we encourage innovation but keep our users safe? Any thoughts? Kyle, you're kind of nodding. What do you think?
Oh, in terms of keeping our users safe, yeah, there's definitely quite a few projects where people have the capability and the capacity to build something that people actually care about, but the tech is sort of running in front of the traction from the community and the funding from the community, and you end up in situations where there's hundreds of thousands of dollars and you haven't had hundreds of thousands of dollars of audits already done on the contract. And that's a fundamental that's a financial barrier that a lot of projects are dealing with. I've heard ideas from I think it was the Ethereum Foundation about sponsoring audits for different protocols. I don't think as a community that it's a terrible idea to say, hey, if we have a product that's gaining a bunch of traction, it's getting a whole bunch of users and money made, and we don't feel like it's had all the audits that would make us as a community feel comfortable, I don't think it'd be a bad idea to start thinking about coordinating it, because in some sense, one project gets hurt, it affects all of DeFi, it affects all of Ethereum. So we all kind of have a stake in it in a way.
Interesting.
So I just thought of a new idea. Similar to how we have the notion of progressive decentralization, I think that there should be the notion also of progressive security, where the more funds you have locked, the more that you're on a mainnet environment, the higher the security requirement should be. For example, when you first develop some code and you deploy it onto Kovan, there's no real money that is being interacted with, and thus you can have bugs in your system and things will be okay. The intention is to just test the system out. And our next environment that we use is what we call staging mainnet, which is a test version of our smart contracts that's deployed on mainnet, and we test it. And that also isn't intended to have a lot of real money flow through it. So we can test quickly and iterate quickly using this environment. And then finally, we have kind of our mainnet environment, in which the smart contracts are holding tens of millions of dollars. And how we think about that is that that should be very secure. It should have had not only internal audits but external audits on the security side. But we also need to make strict validations about kind of the types of risks and third-party dependencies that we're using. And we think that the strictness of kind of the security needs needs to scale according to how much dollars are kind of flowing through your system. So if your system only has $1,000 or $10,000 or $100,000, it may not require like a full-on audit on day one. But if you're dealing with millions of dollars, then you might expect to have a more formalized audit. And then if you're maybe in the $50 million range, like some people might want you to have formally verified your contracts or built your contracts in a way where it can be formally verified. So in addition to that, I think that certain scales, like you might want to start employing economic audits, like what Compound did with Gauntlet. So I think, and I think the idea is that as you're able to get more users and get more traction, you should be able to raise additional resources from investors to kind of pay for these audits over time. But in the early days, you might want to do something, move quicker to find product market fit first, and then kind of double down on security afterwards.
Yeah, so I'm going to take a little bit of the other side of this debate, if you will. I think right now DeFi is in a very similar place to how centralized exchanges were, call it like 3 or 4 or 5 years ago, where a lot of the projects, or some of the projects in the space are currently getting hacked. Things like LendF, like where a lot of funds were lost, they eventually got it back through centralized mechanisms. But I think there really needs to be a consolidation towards some of the products that have proven themselves to be more secure. And I think that until users realize that security is a really big consideration that they need to take into account when they're choosing which product to use, that these attacks will continue to happen. It's not so. I think a lot of people in the space have take like lending as an example. I think a lot of projects in this space will promote like just various let's only compare lending products by the APRs that they're offering, but different products do not have the same risk parameters. Like DYDX, for example, has a lower collateralization ratio than Compound does, so probably lending is a little bit more risky for that reason. Or there may be certain security considerations to take into account when you're considering different products to use. And I think users really need to be aware of that. And there need to be more kind of, third-party rankings of what is the security of actually using this product before users are really able to make an informed decision on which ones they want to use.
Great. At the risk of shilling my own product, I would encourage everyone to check out the DeFi score, where we try to do some of that. It's really an open source project where we're trying to kind of crowdsource risk and do it in a decentralized way. It's kind of like a ratings agency on the blockchain. So great. I think those are all really, really cool ideas, and we're really like we said in the early days of building these products, let alone assessing risk. Varun, I'm being told that your chair swivel, the producers are telling me that your chair swivel is causing some squeaking on the audio. Oh. So mute yourself if you're not talking. Live conferencing in effect here. It's hard to police those things. If we say, okay, under a certain level, you need this kind of audit. Once you hit this level, get this kind of audit. It's really tough. I mean, it's almost like we don't want user growth at the moment, right? Until we get our stuff together. Where in the stack, like if you think about, a lot of you guys are building protocols, and then at the same time, it's also the user interface. Others of you have like a separate product that acts as the destination for the user, the interface. Like one last kind of chat on security, like who's responsible? Who in the stack is responsible for saying, hey, user, watch your funds, you will lose money? Is it really on the front end and saying, hey, this slippage is really bad? Or is it the whole point of this DeFi experiment to just let it run? Like who ultimately is responsible for educating the user regarding these risks?
Yeah, maybe I can go first on this so you guys can have a chance to respond. But just piggybacking off of what I said before, I think in a very similar way to how centralized exchanges evolved, I don't think any one person is responsible. I think basically how it will evolve is certain DeFi products will become more reputable. So a lot of it comes down to reputation. Like, this product, say like Compound, for example, has been live on the mainnet, and it has like, whatever it has, like $150 million locked, and like it hasn't lost any user funds. So that's like a really great sign. So because of that, I'm going to trust Compound with my money, because they have a great track record of building like secure smart contracts that don't get hacked. And I think right now we're in the process of, various DeFi products trying to build up that reputation for themselves. Sometimes, someone will have like an issue happen, like MakerDAO, when some of their CDPs became under collateralized due to an auction issue. Not to say that like destroyed their reputation, but certainly it impacted it. So now certain people are, they would take that into account when they're thinking about using DAI. So I think it's a lot of like reputation based, very similar to how the centralized exchanges work. So like Coinbase, as an example, has a great reputation for taking security extremely seriously, like always putting security first, never having lost any user funds or anything like that. So a lot of people will weight that as a reason why they might use Coinbase as an exchange. They don't know what like audits Coinbase has done or like other things like that. But they do trust that Coinbase has security in mind first, and that they've done all the best things and taken all the best practices to keep user funds safe. And I think a very similar thing has to happen for DeFi.
Yeah, I agree with Antonio. I think that reputation and ultimately brand like makes a big difference. And I think that's what's going to happen in practice in probably the short and medium term. In the long term, we're probably going to see similar things to kind of what we have in a traditional financial world, which is regulations. Like when bad things happen, the government starts stepping in and imposing new rules, which is why whenever you go on an exchange or you look at a financial product, there's a ton of disclaimers. It's a reason why you have to say, this is a disclaimer that I'm not giving investment advice whenever you're saying something on Twitter. So I think part of the answer is that we all need to be vigilant across the stack to kind of explain to the best of our ability what the risks are. And there's many, many, many different types of risks. And I think that we should create some sort of standard for communicating this risk, and and we should probably have some sort of central repository to kind of understand what these risks are. And that's why I really like what DeFi Score is doing, because it's attempting to do that. But I think that we have a long way to go across the stack to do that for everybody. And I mean, part of it is that we can, as an industry, police ourselves, or if we're unable to do that, then some sort of other regulatory body, whether it's some governance or some country, may decide to kind of impart certain regulations to force us to do these things in the future.
Great.
Yeah. To kind of piggyback off of what Felix was saying. So to piggyback off of what Felix was saying, I think, this whole question of reputation, reputation is really great when you have a low amount of information and you're not able to analyze the primary source. But I think the way the space is going to go is towards third parties vetting these different protocols and providing that kind of primary analysis. So I think things like DeFi Score are going to become invaluable and have a sort of dialectical relationship with reputation, where the underlying facts of the protocols and the security parameters get relayed to people and therefore come to inform their apprehension of the different protocols. And then more towards what you were originally asking about, whose responsibility is user funds and the safety of user funds. I think the answer to that question hinges a lot on what exactly is our purpose? What is our intention? What are we trying to achieve? And if we're trying to achieve mainstream adoption, if we're trying to get people widely using DeFi, then the answer to it has to be that it's us as the protocol. If there's any time that we could have done something that would have prevented user funds, we can't come out and say, hey, well, you should have known the risks. We need to come and say, hey, we can do X, Y, and Z to make this better and not happen in the future. And so I don't really fully understand where people are coming from or where they are trying to move the space when they try to heavily emphasize, hey, if you lost your money right here, you didn't understand the risk and that's your fault. And don't blame us. I don't understand where does that take us?
Definitely. I think one of the, what we'd probably add is, apart from just security, one of the big aspects around DeFi, which is probably less talked about because the entire focus is around decentralization, is basically around legality. And the two approaches that currently which are out there, which is essentially being a protocol so that you can focus on your security, you can be completely audited, you can secure user funds, but also try to wash away your hands from legality. And because you don't have control over your protocol, potentially you can't be be deemed a money lender or a sort of a payment service of sorts. And you let other folks build on top of you, who have the responsibility of getting themselves legalized in different jurisdictions. So this is essentially sort of a dilemma for DeFi in general, and that's why a lot of folks actually prefer to go the protocol approach, because legality is a very complicated aspect of it as well. We don't know whether you can actually have mainstream adoption when you are focusing on as a protocol on security and user funds, and expecting somebody else to figure out the tough part of actually acquiring users for you, and giving away all the liquidity to the protocol. So basically that pushes down the incentive for this sort of free layer to go and acquire customers if all the liquidity is going to the main protocol. So it's actually a tough thing, and I think that's probably one of the reasons why DeFi might not go mainstream anytime soon, unless and until someone comes and takes the responsibility of trying to be full stack and saying that we are going to acquire the user, we are going to be sort of we are going to go and do the dirty work of talking to regulators and see how this can be adopted in a mainstream way, and also take care of security. So I think that is a kind of approach that might be needed to take sort of DeFi mainstream. Probably not what is happening in terms of DeFi Legos.
Interesting. So I think, I get a sense that like we can, from the perspective of a protocol, we can make sure all of our contracts are audited. But it's almost like with all the composability, all it takes is just DAI breaking its peg and everyone's screwed, right? Like it almost feels like this is maker's world and we're all just living in it. Do you agree with that statement? What's going to happen with your protocol if, say, DAI falls to 60 cents or something like that? What do you guys think about that? Do you think about that?
Yeah, I guess there's two scenarios. Like if DAI just like has a security vulnerability, let's say as an example, and like all of it is gone and it like falls to zero in like a second, then like, okay, probably some of the lending protocols wouldn't be able to deal with that. But if it's kind of a more gradual thing where for some reason over time DAI is losing its peg, I think most, in my understanding, lending protocols would be able to handle that, and kind of their oracles would be able to adjust to that in a reasonable amount of time. But you're absolutely right. There is additional security risk which comes with composability. So I think it's not just like a free thing where, Money Legos is like amazing and it has led to a lot of really interesting things being built. And I think I'll just take probably the other side of this argument as well. This is why at DYDX we've chosen to build things in a more full stack way versus kind of integrating with other third-party solutions. As an example, like at DYDX, we used to integrate with 0x and Oasis X to do our trading. And recently we've kind of brought that in-house and have kind of built our own markets. And there are a couple of reasons we did this. One of them was for security, though that's honestly mostly a minor concern. But just one, you become a more mature product. You basically want to have more control over the things that you're building on. And we kind of have the bandwidth to be able to build, we built something similar to like 0x that integrates natively with our contracts. And we felt that that would enable us to have a better product experience, enable us to build more liquidity. And it actually has. So I think this is a really good example of how like over time, a lot of projects will start out with using these DeFi money Legos and having a lot of composability. But if they're seeing success, we'll start to bring some of these things in-house.
Awesome. Yeah, so we're short on time. I'd like to wrap with just quickly, short, one phrase or one sentence answer, maybe a bold prediction, whether that's total value locked next year, some kind of wild speculation. What's something that's kind of counterintuitive or half crazy that you predict in the next couple of years? We'll start with you, Felix, and then go around.
Well, some other people have said that SET will be the first $1 billion TVL protocol. I don't think that will be the case. I think some others may achieve that first. But from my perspective, I mean, in the next few years, maybe not crazy, but I think that DeFi will grow way faster than anybody thinks. Like we may hit $1 trillion in volume and assets locked in kind of the next 3 years or so.
Love that. Antonio, what do you think?
I'm going to shill a little bit, but I think most of you guys will agree with me given what you're building. I think DeFi margin trading and perpetuals will pretty quickly surpass the DeFi spot market. And the reason I think this is because we saw this happen with centralized cryptocurrency exchanges, where for the beginning, centralized spot markets were dominant, and now it's all centralized derivatives and margin markets. And I think the same thing will happen in DeFi.
Awesome. Kyle, your bold prediction.
I mean, I agree with Antonio's bold prediction. Let's up Felix's prediction. 2 trillion. All right, let's double.
Varun, what do you think?
I would probably take sort of the pessimistic side, at least in the short term. I'm not too confident that DeFi would be ready to go mainstream over the next couple of years. There are a lot of issues with regards to insurance and safety of user funds. So I think we would probably be stuck with speculators and traders and focus on TVL in the short term, and not so much on going mainstream at least.
Great. Well, thanks everybody. Appreciate your time. That's all the time we have today. Thanks for joining us. Take care.
Thank you.
Bye, everyone.
All right, looks like we have gotten started. I'm hearing an echo. Hopefully you guys don't hear that. I'll trust someone to text me or ping me on Discord if they do. So I'm gonna be talking to, actually give me 1 second here. All right, we'll get started. So this will just be a 10-minute presentation, and I'm going to be talking today about the history and future of price-linked savings. So price-linked savings are a really important and really big financial primitive, but they are something that I think a lot of people haven't heard of, or people who have heard of them just don't know much about the kind of economic and historical context for it. So this presentation is going to dive into 3 kind of main topics. What are price savings? give some of the history and the economic context for price savings, and then finally talk about why price savings on Ethereum are so much better than traditional price savings. And all that is going to kind of build towards my thesis for you today, which is that price savings are the best way for the majority of the world to start using blockchain technology. And I should have said at the outset, my name is Leighton Cusack. I'm coming to you live from New York City, where we all were originally kind of supposed to be before the pandemic kind of changed everything. But now I'm in my apartment. So that's what this presentation is going to be about. It's just going to be 10 minutes. We'll get through it pretty quick. And thank you for your time and joining. So let's jump in with what are price savings. So price savings are built on a very simple concept. And the basic idea is it's a savings account, but instead of earning any interest, you get a 0% APR. So instead of earning interest, you have a chance to win prizes. So for every dollar deposited, you're merited a chance to win a prize. So, a typical savings account, you would earn maybe 1 or 2% APR, but on a prize savings account, you get 0 APR, but you have a chance to win a prize. And this is possible because the prizes that you have a chance to win are funded by the interest that accrues on all of the accounts. So say there's $1 million, or let's be more realistic. Let's say there's $10 billion that are in the prize savings accounts. All of the interest that's generated would go to maybe 1 or 2 people, depending on how that prize savings account is structured. So that's the basic idea of what a prize savings account is. So to kind of make this tangible, this is from Wealthfront. I took the screenshot last night. I thought this was funny. It says cash account that works as hard as you, and it pays you 0.35% APR. So apparently you don't work very hard. So this would be a normal savings account, right? You deposit $100 at the end of the year, you'd have an extra 35 cents from that 0.35% APR. This is what a prize savings account would look like. You deposit $100 at the end of the year, you still have $100, but during that year, you would have had multiple chances to win hundreds, thousands, millions of dollars. Again, just depending on how that prize savings product is structured. So prize savings are not a new idea. I'm assuming this is kind of a crypto audience. They're not super well known in the crypto world, I would say, but it's not a new idea at all. Actually, according to the National Bureau of Economic Research here in the United States, the first prize savings program was started in 1694 in the United Kingdom. And this is just a partial list of countries that today have prize savings products. I actually, to zoom in on like one country, what prize savings looks like to get a feel for the market size of how big this is in the UK. So the current prize savings program in the UK, it's called premium bonds. If anyone's joining us right now from the UK, you may have been familiar with it. You may have had a grandma who gave you premium bonds, kind of common thing. So right now there's $100 billion just in the UK deposited into prize savings from 20 million unique account holders. And that in 2019 alone generated $1.35 billion in prizes that went to all of these people. So that's the scale just of the UK. Obviously, if we were calculating all the prize savings programs in the whole world, we'd be talking, over $1 trillion. I actually thought this was interesting just for more historical context. These are the posters that were used to promote prize savings when it was first introduced or reintroduced in the UK in 1956. The current program was reintroduced. And one thing particularly that's interesting about this, if you look at how they talked about them 60, 70 years ago, they said you can't lose and you may win. The language used to describe it is the exact same language we use to talk about prize savings protocols on Ethereum today. But just now we're doing it on Ethereum. Back then they were doing it on a poster they put around. So I just think that's kind of an interesting historical parallel. So why are prize savings so popular, right? I think we've hopefully established what prize savings are and that it is a popular thing. But what makes it so popular? And so I want to briefly talk about the economics of prize savings, because I think when most people look at prize savings, at first they kind of think that's interesting, that's cool, that's kind of like a fun idea, it's kind of like cute, but they don't think of it as like a serious economic primitive. And that's that's why I want to briefly look at the kind of the economics of it, because I do believe it is a serious economic primitive. This slide basically shows a very standard risk-return profile. So the golden rule of all investing is the more risk you take on, the more potential return you have. The less risk you take on, the less potential return you have. So at the top right there, you see your friend's startup. So you invest in your best friend's startup, you might be in the next Google, but you also most likely are going to lose all your money. You invest in Ethereum, you're a little bit lower. Maybe as time goes on, that improves. Stocks, you're lower on risk, lower return. Bonds, lower risk, etc. A savings account obviously is going to have the lowest return because the risk is essentially zero. Prize savings completely breaks this paradigm, right? It breaks the golden rule of investing, which is this kind of incredible thing. And it says you don't have to take on any risk outside of what you would have in a savings account. It's incredibly low risk, but it's also potential for incredibly high return. And that is why it's a completely differentiated product offering from any other consumer financial product. I think it's maybe easiest to explain in meme form. So usually a consumer has to choose, do I want to have safety or do I want to have reward with my capital? And prize savings says, why not both? Which everyone always prefers to have both, I think. So here's like one concrete example of how those economics can play out for an individual. So we're with the prize savings protocol built on Ethereum. Someone deposited $10 that they had deposited for 30 days. And in that 30 days, they won $1,659. So that's a 16,000% return in 30 days. And obviously, I'm cherry picking like one of the more fortunate, one of the most lucky people. But the point is no one else lost their money. So there's no other financial instrument like that, right? Like what could you put $10 into today and have an actual chance of having a 16,000% return on that in 30 days? There's nothing, right? You can't do that with stocks. You can't do that with a lottery ticket. You can't do that with even the craziest kind of crypto coins you can come up with. You could potentially have that return, but you wouldn't have the no risk on your principal, right? So you can't have, there's no other financial instrument that affords you a chance for 16,000% returns without needing to risk your principal. So I just share that because I think it's a tangible example of why prize savings are an incredibly important financial instrument, especially to people who don't have access to very much capital. Because if you only have $100 of savings, then 2% compounding even for 10 years is only going to get you, $20. So this is why I believe prize savings will onboard the majority of people to the blockchain for the first time, because it is most people don't have extra money to put into exotic financial products. They're not going to be longing and shorting ETH. They're not even going to be, getting leverage on Bitcoin. So they need a product that pairs financial security with an opportunity for outsized rewards. So far, I talked about what is prize savings, the history, the economics of it, and why that's so important as a financial primitive. Now I want to talk about why prize savings are so much better on Ethereum. And I'm going to go through just kind of a few examples of what makes it so much better than the existing alternatives. So first, global, right? So premium bonds, if I want to buy a premium bond, the UK prize savings program I mentioned, I would have to go to the UK. So traditionally, prize savings accounts require you to enter in a local currency, and participation is limited by national borders. On Ethereum, anyone in the world can enter using global digital currencies. Second big one, trust minimized. Right? So traditionally, prize savings require a lot of trust. You have to trust that the people who are running the program are actually fairly choosing winners, not choosing their friends. You have to trust that that the people who win actually get the money. On Ethereum, it can be administrated and verified in a trust minimized fashion. It does not require a third party to back it and to audit it, because anyone can audit it. Scalable. So traditionally, prize savings require a lot of overhead. They're overhead intensive. And if you're trying to derive prizes from interest, which interest on safe investments is not that high, then it matters a lot that you're capital efficient, right? So traditionally, prize savings require a lot of overhead. On Ethereum, there's zero incremental cost to add new users. So you can have every person in the globe in the prize savings account, and there's not going to be additional costs versus if there's just 10 people in that prize savings account. And so that leads to much higher efficiency, which ultimately leads to larger prizes. The fourth one here is programmable, right? So if I want to build something on top of the premium bonds that I mentioned from the UK, it's like, this is super popular product. And if I want to build something on top of it, I can't. It's impossible. There's no programming interface for it. On Ethereum, it's a prize savings protocol is extensible, and derivative products can easily be built on top of it. And then this last one is the most important, I think, which is distributed. And what I mean by distributed is the ownership of the protocol and the governance of the protocol. So traditionally, prize savings are owned and administrated by third-party institutions, but on Ethereum, you can have it owned and administrated by the people who are actually contributing value to the network, which would be the savers themselves, right? So it totally shifts that economic paradigm. So for all those reasons, I think prize savings on its own is already a very, very compelling financial product. And if you put it on Ethereum, it is so much better that I believe it is one of the killer apps for Ethereum, and I think makes the most sense to onboard the majority of the world into blockchain products. And of course, there'll be many others that they'll want to use, but I think this makes a lot of sense to get people started. So that's why I'm working on prize savings. Pool Together is a prize savings protocol for Ethereum that has launched, but is still very much actively being worked on and under development. And so if you're compelled by this idea of building prize savings accounts on Ethereum to onboard the next millions of people into blockchain, then contribute. Come and join us. These are a couple places you can get started, but Twitter, Discord. But if you go from there, you can obviously learn a lot, and you can contribute in many other ways. But this is just kind of quick touch points. So that's all I have for you today. Like I said, this would be pretty quick. Oh, sorry, forgot this slide. This is definitely an important slide. I just wanted to make sure. So, when I was talking about the economics of prize savings, I'm talking about no risk, right? And I'm talking about that in an economic paradigm of how you're evaluating the tool. Obviously, in the reality of the real world, like if you go to Pool Together and use the current instantiation of the prize savings protocol, there's risk associated with that. There's risk associated with using DAI, which it requires. There's risk associated with the contracts that it runs on. So I just want to make that super clear for people who aren't aware of that. We do a lot of risk disclosure on our website, but yeah, I just wanted to make sure I'm differentiating between when I'm talking about the economic paradigm versus when I'm talking about just the actual the current instantiation. So that is what I have for you today. Hope you enjoyed. Hope you're convinced about prize savings being a very important economic primitive. And I will figure out how to close this window and close out here. Thank you for joining.
Let's try something else. Hang on a second. Okay, how's that? Can you all hear me?
That's much better. Yep.
Yes, okay. Let's get one thumbs up that I can be heard. I just want to be sure. Yes? Excellent. Okay, welcome everybody to the State of Gaming on Ethereum. We have an awesome lineup for what is sure to be a very quick 30-minute panel on a super timely topic. We didn't know that we were going to be in this state when we pulled this together, and I think everybody will agree it's a phenomenal time to be talking about a super high growth area. We have 3 guests today from 3 established arenas, communities. I would love it if you could all take a moment to introduce yourselves, 90 seconds or less. I'll kick it off by saying I'm Cecily Mack. I work with Consensus, where I've been coming up on 2 years, and I've been working in disruptive tech and media, publishing, music, and now blockchain since I feel like I was a kid. Welcome. I'll pass it to you, Ben, and then if we could go to Peter and Jeff.
Thanks, Cecily. Hey everyone, I'm Ben. I'm the CTO for Blockade Games. We are known for making a game called Neon District. We've been formed about 2.5 years ago. We are a highly experimental company in that we love to build technology alongside all of our games. We started with a collection of puzzles called the Pineapple Arcade that launched about 2 years ago. Then we launched Plasma Bears, which was one of the first free-to-play, play-to-earn games available for blockchain gaming, and we are currently working on Neon District. Oh, and we are also about to launch a new game called MetaBoss in about 2 weeks.
Excellent. Peter.
Hey everyone. Yeah, my name is Peter Keltika, and I'm the CEO and Chief Architect at Horizon Blockchain Games. And similar to Ben and Blockade, we've been kind of at this very experimental and artistic journey for the last 2.5 years. We really wanted to, take virtual items in games and have them be open and available on a kind of a successor, digital asset platform like the blockchain. That was kind of our thing. And as we all kind of, I think, tapped into that insight. And the first game we started on is a game called Skyweaver, which is a multiplayer competitive trading card game where we have 500 unique cards and you can own them and trade them and battle with each other and have some cool mechanics in that. And then, similarly to Ben, as we all kind of are building on this thing, which is, it's very new technology. So we've had to build a lot of discover a lot of the right technological patterns. And we developed a stack called the Arcadium stack, and where we helped co-author the ERC 1155, which is a very nice token standard for virtual items. And we've, put it up on github.com/Arcadium. And we're really encouraged and excited about, providing a really easy stack for blockchain for people who want to incorporate blockchain into their video games in an open way, and that encourages a non-custodial design. And so really excited about Skyweaver. It's going very well. It's been on Rinkeby, since 2018, December of 2018, and it's we have a really great people are enjoying it, but got to get it to mainnet and got to make it awesome. And it's so far so good. But we're targeting people who are really. I'll just mention that 80% of our user base, we have 20,000 people in the game and waiting list around just over 140,000. And we're obviously kind of treading lightly to really take our time with it to get it right. But we're certainly not far. Welcome you to join our Discord. I just wanted to mention that what's interesting is that 80% of our user base are people who have never touched blockchain. They're just gamers who want to play the game. And so, Skyweaver cards would be their first type of crypto that they would be interacting with. So thank you for having me.
Awesome. Welcome. Jeff.
Hey, Ethereal. I'm Jeff Zerlin, growth lead at Sky Mavis, the creator of Axie Infinity. Axie is a Pokemon and Tamagotchi-inspired game built on top of Ethereum. We currently have a alpha application out where you can battle, collect, and earn tokens from projects such as MakerDAO, DAI in that case, and Kyber Network. We've generated over $1.5 million in collectible sales and have over 10,000 registered accounts. We're also very interested in bringing the benefits of blockchain to people outside of the kind of traditional crypto space. We've been very excited to see grandmas and children as young as 6 years old interacting with our alpha application.
Super cool. Thank you all. This came up in some of your intros, and among the 10 or so topics I would love to be able to cover in our very quick time is one which has to do specifically with regard to the benefit of some of these trends and products to the actual gamers. And I know when we did a little bit of a pre-sync session on this, Jeff, you had some thoughts. I'd love it if you shared a bit your perspective on this, and then maybe pass it to either Ben or Peter who have additional considerations. I have a couple hardcore gamers in my house. I'm always thinking about the whole myriad of things that could be beneficial to them, not only today, but with what technology and decentralization and blockchain could provide in the future. Do you mind sharing a little bit about what you see and what's in it for the gamer?
Definitely. I think as blockchain gaming projects, it's definitely very important to focus on the concrete benefits. So recently we've seen a big kind of move towards this term play to earn, where broadly defined players, gamers are able to earn, whether that be non-fungible tokens or ERC20s, fungible tokens, by simply interacting or playing a game. Projects such as Kyber Network and MakerDAO have expressed an interest to actually subsidize play to earn, for example, within the Axie application, because they're interested in using these games as distribution channels for their tokens to kind of broaden their token distribution. So that's definitely one benefit that seems to really resonate with users, at least in this early stage of the space. Another thing that's perhaps a little bit more abstract is the idea that with a blockchain gamers are they come into this space with digital property rights by default. So our players are able to basically run a digital collectibles business just straight out of their Ethereum wallet. So I was doing some research on the growth of Magic the Gathering, and one thing that I saw was that the game stores were actually acting as evangelists, hosting tournaments, creating content, and that actually that really kind of helped spur the growth of Magic the Gathering. But there are a lot of barriers to entry to being the owner of a game store, right? You need to have a physical location, you need to pay rent. Whereas with Ethereum, right, this idea of everyone being able to kind of have their own mini digital collectibles based business, and the only thing they need is internet and an Ethereum wallet. I think that's a very strong kind of benefit that I think will drive huge network effects over time.
Yeah, awesome. Ben or Peter, chime in on that, your own perspective.
Peter, did you want to chime in first, or do you want me to jump in?
You can go ahead. That's cool.
Okay, cool. So definitely the digital ownership is a huge one. The ability to transfer things anywhere in the world, and anyone can get those assets immediately, being able to sell them. Those are all really powerful things. The thing that I'm most excited about as a developer and a massive nerd is the notion that all of these assets essentially exist on a common API that everyone around the world can use and build on, and it's just available. So, for example, the game that we're putting out in 2 weeks from now, we have no asset that you need to play the game. It's anything that you already own. So you could own like hundreds of Axies, and you can bring them over to the game, and then all of a sudden have a huge pull in the game itself. So there's all of this meta layers that you can pull and play on. We have a lot of artists that are now minting their digital art, which is no longer just static images, but now fully animated, like interactive. And you can go and you can view them like in crypto voxels. You can put them on your wall. So there's so much potential here for taking things that already exist and building on top of them.
Mm-hmm. Awesome.
Mm-hmm.
Peter, thoughts?
Yeah, I agree. I think it's all really cool stuff. And where I want to go with that. I like that the MetaBoss thing sounds really neat. I'm excited to check that out. I think kind of like the neat thing about it, I guess, with blockchain gaming is it kind of changes the economics. It obviously has them they're more open and open ecosystems. And it kind of begins with, I guess, the most basic of things is it introduces secondary markets. Where typically there's only a primary issuer of any good, and by having a secondary market, there's a resale market, so there's more incentive. If I buy it, I can resell it, which is kind of cool. More likely that higher number of people to begin to purchase, to get involved in the purchase of these goods. There's obviously different economy designs that you can incorporate into a video game, such as a play to earn, and play to earn can be done many different ways. We have our own kind of spin on it as well inside Skyweaver, which we're really stoked about. Yeah, and I also agree. I think it's so all that stuff is really interesting, and it kind of definitely players only benefit from it because they have their ownership, and there's this even greater retention. It's also kind of cool if you think about perhaps a huge gaming studio that has multiple sequels of a video game. It can also drive greater retention for them because now you can kind of continue to have utility of those goods even in kind of the new version of the game. So that's why I know big studios are interested in that stuff. Yeah, and I also similarly think it's really interesting about blockchain to kind of create like a common format for virtual goods. Single language, a single representation that can have interoperability and really see all the things that we're introducing, but then how others really build on top. So yeah, those get me really stoked.
Awesome. So it's still a relatively tight market, right? So you have to have skilled gamers, then you also have to have a scale set that is familiar with or excited about, or at least able to use blockchain-powered, Ethereum-powered products. I'd love to talk a little bit about distribution channels and how blockchain games and specifically the products you're building are reaching audiences that you know are going to be engaged and kind of bang on your work and help you improve it over time. And I'll open it up to any of the three of you who want to talk a bit about how you're prioritizing distribution efforts, what you're seeing trend-wise, and anything you want to add on that topic generally with regard to distribution of your games.
I'll say a few words. I think, Jeffrey had a really cool story about the Magic the Gathering arena stores and then being kind of distributors and evangelists. I think there's a lot of evangelists in these different games and communities, so that's pretty cool. Marketplaces are also evangelists, of course, or sorry, distribution channels and evangelists. And obviously a lot of things happening on the web, and you can kind of leverage all the existing channels that exist as typical in distribution. But I'll agree also the wallets are a very powerful place that facilitate opportunities of commerce and access to information, and the common format should also be able to allow, like back to that example I gave with some video game that has you taking your items to another game, that the subsequent game would be distributed. The prior game is a distribution channel, or new game is the items are a distribution channel for the for the content, which is really cool. So the games are now distribution channels for a new set of items. Yeah, that's what I see.
Cool. And
yeah, there's a
Jeff,
really
I'm going to volley it to you. Oh, sorry. Go ahead,
sorry.
Dan. You were starting to speak
Didn't
up.
mean to interrupt. I'm just going to add on top of that, actually. So there's a really strong social and networking effect just by the essence that you have all these games that are building assets on top of the same platform. So either you can pull in assets that already exist, and now all of a sudden you have all these people that can benefit immediately, like getting a leg up in the game. But there's also the notion of tradability means that you can bring people in by giving them real things. And that's when we were kids, in order to get people to come in and play Magic the Gathering with us, we didn't have them go out and ask their mom for like $30 to go get a pack of cards. We gave them what we already had, and then we could play with them right then and there. We can do the exact same thing now. And the ability to give people things that you have doesn't diminish the work that you put in. You're now bringing in more people. There's a strong social effect now that did not exist, that doesn't really exist in a closed economy.
Yeah, very cool. Jeff, what about you? What
Yeah,
are your thoughts on
definitely.
distribution?
So I think first, I think that the most effective distribution channels for blockchain games will be non-obvious. I think a lot of the ones that have been tried so far, I haven't really seen anything too innovative, but I do think that people will kind of stumble upon through kind of iterative tests, find distribution channels that are kind of unexpected. That said, I do think that basically this user or player as a stakeholder model really lends itself well to referral or affiliate marketing, right? Because your users are already very fanatic and care about the product, so it's quite. I think it's a quite logical step to actually turn them into basically recruiters for your game, where you might have a Binance or Coinbase like referral system. I also think that any channel that kind of leverages the visual artistic appeal of the game. I also think that blockchain games have to be very visually striking. So I think that channels that kind of play into that basically kind of hook people with the art and get them wanting to learn more. You can then introduce the more complex blockchains and kind of crypto economics to them after they're already engaged and want to learn more, and ideally have kind of also fallen in love with the gameplay a little bit.
Awesome.
Now, I guess it just sparks another idea for me, is like the co-creators. There's a lot of co-creation going on. So the other people who are creating within the game, they can also distribute and evangelize. Yeah. And I agree with Ben. I remember the experience when I gave someone a Skyweaver card in their wallet, and they just got it, and they felt they had this experience of like, oh my God, this is awesome. And they were so stoked about it. So it's a real thing. It definitely pulls someone into that experience as well.
Yeah. It's great to see the type of connection and energy that you can spin up through that, even in this very touchless, digital, tech-driven way. And on that, I want to pick up a thread that you started to touch on a bit, Ben, which I know is a topic that's near and dear to your colleague Marguerite's heart, which is interoperability, and how important interoperability is in what you're building, how you're reaching your community, and ideally, what predictions do you have with regard to these trends or challenges as this whole field continues to evolve?
So I'd not be able to give an answer as eloquently as Marguerite can, but interoperability is at the core of our company, absolutely. It is one of the fundamental benefits of being able to use blockchain is being able to work with other people, work with other companies, work with other properties, and then build new ways to use them. So, for example, it'd be great for a Neon District character to be able to bring in like an Axie, or to bring in a character from Skyweaver, and then to have them as a character that goes along with that character in the game. And this sort of thing just cannot exist unless the companies are owned by a common parent, or there's some sort of really complicated business deal that has to make that happen. Here it's free, it's available. I think we're still playing around with the possibilities of what we can do with that, but it really feels to me like that's going to be one of the cornerstones of what turns blockchain gaming into the actual real metaverse.
So I think on my end, regarding interop, I think I'll be a little bit contrarian. So I think a lot of the games in the space, they're very interested in how they can interop with each other. I think that's awesome, and I think it's going to help us out a lot. But so far, the interop that I've seen that's moved the needle and helped us personally the most at Axie is interop with between gaming and some of these DeFi contracts out there. So for example, with our land sale that we held in early 2019, we were able to use Kyber network to kind of seamlessly accept many different tokens. So we accepted like BNB, and actually had CZ tweet about our NFT sale because we were accepting BNB, and accept all these other different ERC20s. Right now, we have a token that you can play by earning our game called the Love Potion, or Small Love Potion, and our players have a liquidity pool for that on Uniswap, and can sell it on Uniswap. So we have around I think around 10 to 20% of our user base interacting with Uniswap on a daily basis. So I think that's been a really kind of interesting example of interop for us, is kind of leveraging these other smart contracts that exist within the Ethereum ecosystem. I'm not just kind of porting our assets into different games. Although I find that also fascinating.
Super cool. So following up on that, maybe Peter, I'll volley to you on this next one. There's been some conversation in the market about certain channels being excessively advantageous or dominated by crypto whales in this space. How can we endeavor to diversify who has access to and who can really engage with and get some of the benefits of gaming on blockchain, particularly when we have notions like mining by gaming and other secondary market benefits that are coming up and are sure to be increasing in scale in coming years. How do we level the playing field?
Are you saying like the concern around like a pay to win where whales can have the best kind of power in a video game or something? Or
Yes,
something else?
or just or just price of access, like being able to come in and level up by having a lot to explicitly invest on your way in.
Yeah, I think it comes down to the game developers, and kind of like each game will have, you know, their own economy design, and they like some games will choose to have a booster pack or a loot box, and they'll say some percentage of them are super rare, which I think is a very poor design, is very just naive and very like just not a good idea of a design. I think there is in fact, like, I think when you start peeling into designing blockchain economies, the first thing you kind of eventually realize is you want to have a healthy economy, and you want to do well by the users and the players so that they love your game, they continue to spend time in it. And so there's this interesting kind of almost opposing force of having a good that is scarce and having that same, and like the scarce goods are the ones that are more powerful, because the scarce good, you typically think it's the more valuable one. So then if you have that association, suddenly the whales will buy those ones, there's fewer of them, and the game really effectively turns into a pay to win. And then over time it diminishes all like in kind of a net value. So I think it comes like, that is actually almost like a paradox in its design, in saying that these items have value. But in fact, it actually really hurts the game. So you have to, I think, be considerate of how to design for a spectrum of your economy and a spectrum of users, while still making it very fair and balanced. So one way to do it, like we've done in Skyweaver, and I think there's like a lot of options, although I think it is a real challenge, is like looking at the market from, you know, a skins market, you know. So in Skyweaver we have 500 unique cards, and there's base cards, which are actually like you can get for free, that are not tradable. In fact, they're not even on the blockchain. There's silver cards, which are $2 a fixed price. You can also get them on a secondary for less than $2, if, you know, as that would be available. You can always get them for $2 off the primary market. And then there's gold cards, which is actually a market it's like the reward economy. And you can only get a gold card by winning it on the leaderboard, and that has its own kind of, you know, price market. Now a gold, or like if you have a claw bear, that's a base silver or gold, they play the same way, they function differently. Perhaps they give you access to different things depending on how you want to layer them in. Certainly there's a different scarcity kind of grade, and they look different. It's very similar to, I would just kind of leave it off at like Dota, you know, or different MOBAs. They have a very similar, you might have a Juggernaut that's free, then you have like the one tier up is $50, and then a little bit more of a different, more unique look, it's actually $500 Juggernaut cosmetic skin. So I think that is kind of a good way to think about it. I don't think the money should give you greater power in the game. That is kind of my view on the design. Otherwise, like I said, these opposing forces.
Excellent.
Yeah, we hold the same opinion. So the way that Neon District is designed, for example, is kind of a blend. There are rarities. They do impact the gameplay, but they have a very subtle impact on the gameplay. So in the pay-to-win scheme, you typically have like a ladder, like a typical role-playing game. You have sword that's level 5, and then you have a sword that's level 10. That's clearly better because it can do more attack damage, or it has greater resilience, whatever. And then people climb that ladder until they get to the top. And that's fine as a single-player game. But when you have an entire world that can potentially play your game and trade and interact with each other, the economy breaks down. Because then everyone's going for the race to the top. People with money buy the top. They control everything. It's no longer fun. People can't climb anymore. So instead, what you really want is a progression like what we do is everyone starts off the same base level. And then it's like a tree. It branches out as you grow. So as you level up, you have all these options, all the decisions that you can make. It's very similar to a card game like Skyweaver, where there are checks and balances in place, where one card can be incredibly powerful against something else, but it's not as good compared to the third card, right? Rock, paper, scissors. So building the economy that way means that you can still have your whales play a part They can still collect the rare things, the skins, the incredibly hard to get items, but there's always going to be a metagame where things always change, where there's always an opportunity for someone who comes in with nothing to play their way to the top.
Okay, we're coming up on our time, so I'm going to ask one final question and give you a little bit of room for creativity here. What do you think is the most unexpected thing that's going to happen in this space in the next 24 months, 2 years? What do you think people are going to wish they knew was coming, looking back around this time in 2022? And I'll start with you, Jeff.
So I do think that even given the current growth rate, I think that there are no silver bullets, and I think people in crypto, they're often like, what is the silver bullet for mass adoption? I do think that the space is growing at a very healthy rate, and I think people will kind of be surprised by how that compound growth over the next 24 months kind of shows itself. So I think that when you look at the space kind of on a week-to-week basis or month-by-month basis, it might not seem like things are moving very quickly, but all of a sudden, I think we're going to see kind of certain, and basically like a chemical reaction or an activation energy accumulate. And I also think that the leveraging kind of different mainstream distribution channels such as app stores or Steam is something that we basically haven't really seen too much. I think that's going to move the needle in a major way.
Great. And you, Peter?
Yeah, I think it'll be cool to see the kinds of economy designs. Like I think the fundamentals we know are ownership and trade, and I just think to understand like these opposing forces or reward systems and experiences that we get to develop out of these things, and how the psychology and the incentives kind of build for how users interface with these things and how their experiences get reflected. I'm really excited to see that, and I think there'll be lots of cool creative things that people come up with. So I think for me it'll be like obviously go through your design. It's like, oh, someone comes up with a brilliant design, be like, oh, I wish I thought of that. I'm sure there'll be a lot of discovery in the path, and also discovery and learning from people's behavior.
Awesome.
I have no idea. I think there's going to be two different kinds of surprises. So there's going to be the surprise for the people who are involved in the space. So for us, it feels really slow. We've been doing this for 2+ years now. I think for us, within 2 years, we're going to be really surprised at how rapidly this grows and how successful a lot of these companies become. It doesn't feel like that now. It feels like we're crawling along, like just inching to get more support. And I think that's going to come in tandem with the outside world realizing there's an opportunity here to play to earn, to actually make money, to actually own your things. That's going to be a surprise to the vast majority of people, because we are a niche within a niche, right? So for us, we're going to be surprised that it's blowing up and we're seeing success, and these big gaming companies are going to start acquiring us, and they're going to start asking us, how do we build on this? And then we're going to have the outside world coming in like, oh my God, this person just sold this thing that they earned in a game for $10,000. I have to go do that. Then you have a flood of people going to play the game. They're probably going to go play Skyweaver. It's an awesome game. I'm addicted to it, Peter, just so you know.
Thanks, buddy.
Awesome. Excellent. Well, look, we're up on our time. You guys are fantastic. I earned major mom credit with my sons when I told them that I was speaking with you guys today. So thank you for your awesome engagement and doing what you do. And have a good rest of your Ethereal. And we'll see you and meet again. Thanks again. Thanks, everyone.
Thanks, Cecily. Bye.
Thank you.
Imagine if every dApp can run on its own Ethereum blockchain. No need to share resources with other dApps. And no gas fees, while staying fully connected to the Ethereum mainnet and ecosystem. Traditional blockchain networks are massively structured with thousands of nodes set up to solve exactly the same task in exactly the same way, processing all transactions in one queue. Scale is different. On Scale, each of the thousands of nodes can take on the parallel workload of multiple independent dApps, and each can be flexibly configured to support many fundamental features, which were impossible to combine in one decentralized environment before. This is possible thanks to the innovative application of containerization and virtualization technologies. On fully decentralized Scale network, each node can be dynamically containerized into up to 128 virtualized subnodes. All subnodes are BLS-secured containers that run the Ethereum virtual machine and can be customly configured to support file storage, machine learning, privacy, BLS rollups, and a rich set of ecosystem-wide integrations. This approach makes Scale an Ethereum as a service platform with full on-demand configurability. Virtualized subnodes form the building blocks for elastic blockchains. Each elastic blockchain is extraordinarily fast, cost-efficient, and can be customly configured to be fully dApp-specific in size, throughput, features, and can also scale up as the dApp user base grows. Each such blockchain gains security properties from the entire network, as thanks to the technology of random rotation incentive scaling, it never runs on the same easy-to-predict set of nodes. Scale Network can run thousands of such blockchains simultaneously, all being natively connected to the Ethereum mainnet. Scale's modular architecture creates a truly flexible, agile, and efficient elastic blockchain solution that is built to bring the power of Ethereum to 1 billion+ people.
This is Sam. Sam uses the internet just like the rest of us. Lots of apps she uses seem to be free, but they actually come at a cost. She knows the internet isn't very secure and strangers own her data. Credit cards are stolen, identities get hacked. She has to navigate a maze of ads just to surf the web, and she knows someone is always watching. But she's heard there's a better way. And then Sam sees it, the promise of a new internet powered by the Ethereum blockchain, an amazing combination of technologies the world is building together that are reinventing how we connect to one another, and it's just within her reach. But to access this new world, she needs the right tools. Meet MetaMask, your connection to the new web. MetaMask is the tool Sam needs to access this new world. It's a key that connects her to new types of applications. It's a wallet that keeps her data and valuables safe and sound. And it's a shield that protects her from hackers and data collectors. With MetaMask, Sam is ready to explore this new internet safely and securely. The possibilities are endless. Sam can use next-generation applications that give control back to the users and the community, own her data and move seamlessly between sites, and send money across the world at a fraction of the cost. Create new organizations with new currencies that bind her communities together. Crowdsource projects and art, or invest in other people's creations. Sound too good to be true? Well, with great freedom comes great responsibility. Sam controls her own identity on this new internet. No more new passwords for every site she visits. Just a secret phrase that controls her accounts. This phrase is her login, her password, and her proof of ownership all wrapped up in one.
So Sam has to keep it as safe as she possibly can.
Now that she's installed MetaMask, Sam's ready to explore the best version of the internet. Vote, crowdfund, buy stuff, publish writing, make art, hire freelancers. What will Sam do first? Whatever she wants. The internet is hers to explore. Welcome to a new kind of internet. Welcome to MetaMask.
You guys got dial-up?
I got that something. I got that something you want. So keep it coming. I got that brand new feeling, like the original. I got that brand new feeling, I got the steam to roll. You give me just one look and you know I'm good to go. You know I'm good to go. Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. You got that something I want.
Hi,
There we go.
everyone. There we go. Some technical difficulties, but everybody's been hanging on for this conversation right here. I know I have. It's a pleasure to be here. And thanks, everyone at Ethereal for joining us here. This has been a long time coming. If you think back to 2008, it really started with an idea, a reaction to a global event, and a white paper. And it really triggered a moment and a movement with the cypherpunks advocating for a technology-driven regime change. Fast forward to 2020, we are in a whole new world, a whole new ball game. And the question that we're really going to answer over the next 40 minutes with Joe Lubin right there and Mike Novogratz is, are legacy systems and traditional industries about to co-opt, or are they going to fall away for a redefinition of a brand new world? It's going to be my pleasure indeed. And over the course of this conversation, we're going to be exploring that. We're going to be asking, is this an inflection moment, really, that has been triggered by COVID-19? Are we going to see a true transition from legacy to decentralization? And are we going to enter a brave new decentralized world? And what does that really look like? I'm Angie Lau, Editor-in-Chief of Forecast News, and it's a pleasure. And our two fireside chat panelists need no introduction, but I will anyway. It's great to see you, Joe. It's great to see you, Mike. So Joe is co-founder, as you all know, of Ethereum, founder and CEO of Consensus. Of course, the blockchain venture studio based in New York right there, and really designed to drive adoption by governments and enterprises by Ethereum. Mike is founder and CEO of Galaxy Digital, as you know, a former Goldman Sachs partner who founded the company in January 2018, leading a $325 million fund that's developing for the EOS-based ecosystem. Also have some significant Bitcoin funds for accredited and institutional investors. And so talking about a little bit that there, and both are Princeton alums, both are leaders in the industry, both are futurists who are paving the way to more decentralized worlds post-COVID. Hi, guys.
How are you? Andrew, how's it going? Hey, Mike. At first, I have to say that, Mike, that quarantine stash is an inflection point in its own way. It's impressive.
I started on the day of the quarantine, and I have to admit, I had a diet because it was too great.
Outstanding.
I'm waiting for the handlebar mustache.
At the 12-month mark of quarantine, we'll turn it up.
Oh, my God.
Oh, yeah.
Well, let's talk about, as everybody's really shelter in place, this is truly a universal experience. Across the board, there is not one person who isn't touched by this crisis. And certainly as participants in the global economy, and really as individuals either sheltering in place in our own homes, or for those of us who still are considered essential workers and going out and making sure that at least the levers of basic day-to-day is still functional. Where are we right now, Joe, Mike, in your view, as you've been reflecting where you are, how we've evolved in this space in a very short amount of time as a result of COVID? Joe, I'll start with you.
Well, we started thinking about this discussion in terms of the different narratives that have been in play since the advent of Bitcoin. So I'll leave some of the Bitcoin narratives to Mike, and Mike's personal financial trading economic history is really remarkable, and I expect that he'll jump into that as he helps us understand how crises are dealt with and his approach to all of that. I guess, yeah, you're back on, Mike. So essentially all of this started as a reaction to the fact that we on the Ethereum project all love Bitcoin. We were Bitcoiners, and we wanted to do so much more. We wanted to take this brand new invention, digital scarcity, and enable the world to build all of its systems on it, essentially. And so it basically initially manifested itself with Vitalik trying to bring an easier way of building your own cryptocurrency into the world. It used to take weeks and months to stand up a new system and create your own crypto. And a few months into it, we were able to do that in a few lines of code on Ethereum. And so it evolved from there to bigger narratives. It went from the write your own crypto to build your own Dropbox and build your own decentralized, uncensorable Twitter. And that was really the world computer narrative. And the world computer narrative is a bigger narrative. It's really a decentralized internet or increasingly decentralized web narrative where you have protocols like Bitcoin and Ether. Hey, Mike, can you hear us?
Yeah, I'm good.
Okay.
Sorry
good.
about that. I'll keep coming in and out.
Yeah, no worries. So you have these different protocols for trusted transactions, automated execution of agreements, decentralized storage, decentralized bandwidth, decentralized ID, and that's the decentralized World Wide Web narrative. And that's roughly where we are in terms of the Ethereum narrative. So back at the first Ethereal, I was hoping that in my speech, I was hoping that central bankers could kick the can down the road for another 5 years or 10 years and enable us to build more. And I'm not sure we're going to have that luxury now with COVID and the crisis. And it's not just a biological virus crisis, it's a global economic crisis. And so I think Mike can weigh in on this. I think we're looking at the Japanification of the planet, where growth is going to be very, very difficult as bubble after bubble gets blown. And I think we're in the last bubble, the government debt bubble. And so I think we're going to have this sort of steady state where we walk around in a bit of a daze, or with respect to the legacy economy, it walks around in a daze like zombies. But maybe that's not so bad. Maybe COVID is going to enable the builders of the new financial, social, economic, political infrastructure on decentralized protocols can take, I guess, all this new money that grows on trees and drops from the sky and potentially build new foundations. So first the new trust foundation, and then a decentralized financial plumbing infrastructure, and start bringing new industries into that kind of infrastructure. So fingers crossed, it is a positive inflection point where instead of previous inflection points where at the end of 70-year debt super cycles would end in violent conflict, maybe this one will be different, where it's all happening to us globally at the same time. It's we're all in this, and we can all take time and reflect and build together.
It's still tied very much to markets, Mike, as you know. We can think about the future, but how do we capitalize towards that future when we are seeing the volatility in the markets, not only in equity markets, but obviously in Bitcoin as well, and startups and funds around the world are impacted.
Sure. So, I'm a storyteller. I think for my whole life I've been a storyteller, and what appealed so much to crypto was the narratives, right? The first, FU to the man narrative that came out of the 2008 Satoshi paper. We're going to change the world. When I first went into Consensus's office, I said this bit many times. They were like plotting this revolution on, building the new world infrastructure, and I was like, that's such a powerful story. And there is this ferocity of desire for these rebels to kind of rebuild things, and that's infectious. And we had this wonderful crypto narrative through 17. I remember the first Ethereum, I can't believe it was only 3 years ago, which created this bubble that we saw in 17. It was a bubble because the story was so powerful, and usually bubbles happen around things that actually do change the world, right? There was an internet bubble that changed the world. There was a railroad bubble that changed the world. I think the blockchain, Bitcoin, Ethereum bubble is going to change the world. And so where are we today? I mean, today's a special day in some ways. I'll get to it. COVID has unleashed a fiscal and monetary response like we've never seen in the world. So we've never seen as big of a collapse in economic activity, literally in the history of, at least modern economics. And we've never seen as big of a response. The fiscal response from the US. Remember, we were running a 5% fiscal deficit before the crises happened. That was crazy in what Trump would say was the best economy of all time. Right? When I worked at the White House in 1984, tells you how old I am, 5% was considered, that was the Reagan era twin deficit, was a crisis.
Uh-oh.
It was a
We'll be back.
crisis. I think the desensitization, I guess we've all been desensitized to all of the debt rates, Joe, as we wait for Mike to come back. You talk about that global debt crisis that is absolutely being triggered now. And, you take a look at the headlines right now where corporate America bankruptcies are really at the starting point. I'm gonna bring in what Larry Fink, CEO of BlackRock, said. He's always been candid anytime I interviewed him, and he was no less candid in his stark assessment of the global economy. He said that corporate America bankruptcies are only beginning right now, that corporate tax rates are going to have to do the kind of heavy lifting that the stimulus dollars are giving to the American public. Whether or not we're going to see individual tax rates rise, we're definitely going to see corporate tax rates rise. And at a time when another 33 million Americans have been added to the jobless claims line. These are changing narratives as well as we counteract really what the promise of cryptocurrency and blockchain is. As you said, Joe, Mike, thank you for coming back on. We were just referencing, as you said, it's fine. It's that I think we've become all desensitized to that 5%, right, ratio. And right now we're seeing at the precipice where Neiman Marcus today filed for bankruptcy protection. Following on, I mean, they're not the first. They're not going to be. They're definitely not the first. They're definitely not going to be the last. And we're likely going to see corporate tax rates rise along with individual tax responsibilities. So where does cryptocurrency live on this spectrum? And these realities that we're going to have to be faced with. In your view, how does
I got cut off. No idea why the technology broke. But I'm going to blame somebody. Listen, I was given the story that people have heard that we have this fiscal orgy going on, and it's being monetized by central banks. I.e., my mother said money doesn't grow on trees. Money is growing on trees. And so you are seeing investors look for hard assets, look for scarcity value. Something that happened today, which I think is phenomenally significant for crypto, for Bitcoin specifically, but for all of crypto, was that Paul Tudor Jones, who's a legendary investor, a good friend of mine, put out a letter, and he actually bought Bitcoin in his fund. And so, we're making these steps. This is a big step. He is one of the most prominent hedge fund investors. He's the first one that bought crypto as a macro asset, right? It's an inflation hedge for him. And I think you're going to see more and more of that. And so we're seeing an acceleration in adoption of, first, the story of Bitcoin as a scarce asset. And I think we're just starting. And I can tell you from my own business, the amount of incoming we're getting is up limit from where we were a month ago, 2 months ago. And remember, the price is only where we were in January. And so like the rally hasn't finished. It really is just starting. But overall, besides Bitcoin, each crypto ecosystem has its own community, its own narrative, right? And those are being accelerated. We're going to see the digitalization of everything accelerated. The CEO of Microsoft said, we did in 2 months what it thought it would take 2 years to do. And so you see the growth of stable coins. I think one of the powerful things for the Ethereum narrative is valuing the Ethereum network kind of like we do Facebook. And so the more network effects you get. And so having Tether move all now 9 billion, 8.5 billion to run on the Ethereum network brings people that are using that network. And so you look at DeFi and stable coins, just that alone, it's bringing more prominence and network effect to Ethereum, because all of these, other than Bitcoin, I really believe, all the other cryptos, Ethereum the most important, need over time to provide real use case. So they do get that network effect. So that community is built on something more than just store of value. It will be store of value plus something. I think Bitcoin gets lucky. It can be just store of value because it started first and it's kind of mysterious and it has the brand. The rest of cryptos can also do very well, but that's why the progress that Consensus is trying to make and going from ETH1 to ETH2, that story and that growth is wildly important, but it's all going to be accelerated.
Yeah. I see two narratives that are very distinct and yet they converge. One is obviously as a store of value, Bitcoin. It's kind of broken out on its own. You can describe it as digital gold. You could describe it as a hedge play, as a countermeasure to current Federal Reserve and other central banks around the world printing endless seams of money. And then on the other hand, other cryptocurrencies value, which will be driven from more of a utility base. Right, so one's a hedge, one's a utility base, and yet at the same time, one will evolve to being valued just like the other. Joe, what do you think of that?
Well, yes and no. I literally think we value gold very differently than we value Facebook, right? Gold's interesting. It's a $9 trillion market cap. It's a 25 or 22 meter cube. If you've melted all the gold in the history of the universe. Think about that, like as a sculpture in Central Park worth $9 trillion, where we value Facebook, not really on its ad revenue, we value Facebook on the network effect that it's created, how many things can be built on it, how many things can be monetized on it. I think Ethereum will be valued very similarly at one point. And so to me, you'll see the growth of Ethereum with the growth of the network. It's why I said I thought it was so important that stable coins are being built on top of it. That DeFi is being birthed on top of it. I'm sure Joe can tell you the 4-year track record. Now, listen, I think Ethereum's got its hands, it's got a lot of work on its hands. You know, this transition from ETH1 to ETH2 and being able to create the narrative around that is understandable to the common investor. I always like to see myself as a very simple guy. So I need to be able to understand it, because if I can't, the next guy, you know, I mean, the smart guys can, but like I got to be able to sell that story. And so, but I think that's where the valuation differences will be different. And even there are plenty of other cryptos that are going to try to make their run. They have to have their own narrative and they have to have their own utility.
Yeah, so I think the term cryptocurrency is a little bit unfortunate. Essentially what's going on here is a massive paradigm shift. We're building out a new kind of economy that's going to take decades to unfold and will last for many, many decades. And we started with the term cryptocurrency, and that applied initially to Bitcoin. But Bitcoin is sort of much more of a gold 2.0, a store of value, than something that I would ever want to use to buy a cup of coffee with. Ether and others started out being called cryptocurrency, and some of us felt like, yeah, we had to run with that, but it wasn't really what we thought it would. We thought of it as a crypto asset or a crypto commodity. So the general term crypto asset is, I think, going to become increasingly important. I don't expect Bitcoin or Ether to be used in day-to-day transactions, just like I don't expect electricity or gold or oil to be used in day-to-day transactions. And what we're really talking about is building the foundational layers of a new kind of economy, and cryptocurrencies will be things like DAI and Tether, etc. So those are the pieces that we will, and state-issued cryptocurrencies, central bank digital currencies. Those will certainly have a big role. So we'll see.
That's coming fast. And I
Yeah,
think
it is
one of
coming
the things COVID has done is accelerating this idea that we are going to get a host of both state-backed stable coins and other stable coins. Maybe you should call Ether crypto infrastructure.
Yeah, it pretty much is.
Well, that's a great point. That's a great point, Mike, because are we seeing legacy systems, right? If this was supposed to be a movement, as you said, let's build something that's better. After 2008, that is really what we're talking about here. A financial system that serves the people rather than the centralized infrastructure that currently exists today. Now, COVID seems to be the brush fire that is making way for the green shoots to come up. Now, Bitcoin, Ethereum, cryptocurrency, blockchain, crypto assets, digital assets, all of this is part of the green shoot effect that we've seen over the past 10 years. Question is this, are they ready for prime time? Is this industry ready for prime time? Or is there a danger, as you've said, with the central bank coming in with central bank-backed digital currency, like what we're expecting to see out of China, likely in the next month or so. And certainly this conversation about digital dollar, whether or not it's actually a digital dollar coming out of Congress. Is there a danger that centralized systems are co-opting the technology and seizing that narrative? Your thoughts, Joe?
Listen, I think it's going to be both. Facebook is going to come out with Libra. They are going to have a semi-decentralized blockchain. When you really think through that, they would have been better off doing their stablecoin on Ethereum. It's very costly. They've got to run it. It's not as decentralized. Part of that is the growth of these networks and everyone's rushing. And so I don't think the final solutions are there yet, and it'll have tension both ways. I would say, I think why the excitement around Bitcoin is there, because Bitcoin's kind of a finished product if it's digital gold. We've got to also be cognizant that the rest of the space is, and Joe is better probably at telling you this than me, it's not ready next month, it's not ready next year. There's going to be big accelerations, but we're 2, 3, 4, 5, 6 years away from the real transformation. And so what's wonderful about this is it's accelerating, it's putting juice back and energy back into the space. But, for DeFi to go from $1 billion, our global economy is 80 trillion. And so we're going to accelerate that pace. And so I think you got to keep focused on each lane in the growth in that lane and how it's doing. And I'm, the one thing I'm sure of, like in markets, when I was in 1997 in Asia when the world blew up, and then 2008. And when paradigms change, stuff happens that you can't believe, from before, like oil trading at -$40 or swap spreads. In 2008, no one thought swap spreads could not get negative, and they went to -80. Nobody thinks the dollar is going to really lose its reserve status. It could, and it could faster than we think. It's not my base case. My base case is the biggest used stablecoin in the world in 4 years will be a dollar-based stablecoin. But there's a growing probability that that could be wrong. And so crypto, even as a hedge, as an option to the change in the near term until the Vitaliks and scientists will can build out the infrastructure so the new world can actually operate on a decentralized way, because we're not there yet. We couldn't, if we said we're switching the lights tomorrow to be decentralized, the system would break.
Mm-hmm. Yeah,
Joe, maybe you could give a little bit of a time path.
I will attempt to expand on that. So is the technology ready for prime time? I wanted a lot more time to build, to mature the technology, and I'm not sure we have a lot more time. I think we have to get busy now. Fortunately, we've been busy for a number of years, and it is ready for prime time. But it's not prime time everywhere, and it really depends who you are. So if you're a consortium, a commodity trade finance consortium, it is absolutely ready for prime time because it enables you to collaborate with organizations that you previously only competed with and couldn't build shared, trustworthy protocol-based infrastructure with. It is absolutely ready for prime time for the getting to be close to 1 million developers in the broad blockchain ecosystem who are essentially understanding the technology, diving in, living and breathing it, and essentially now charged, given the tools and charged with the mission of bringing the wisdom down the mountain to the people. You take this new paradigm, this new way of building things, and you have a specific domain, whether it's DeFi or gaming or a variety of other things, and we need the expertise of passionate entrepreneurs and technologists to be building the applications, and that's happening in a very big way right now.
You know what they say? They say first impressions count. When it comes to DeFi, it started out really strong in the gate, but recently hit by hacking and questioning whether or not it is ready for prime time. To your point, Joe, some of these projects are ready for prime time and some are not. And as we've seen throughout this changing narrative since 2008, where it went from the wild, wild west to ICOs, certainly not a good part of the narrative, to regulators coming in, more enterprise grade solutions coming in. You're even seeing, the change of wardrobes at conferences. We went from studded trucker hats to suit, ties, and heels. Is that a good evolution in this space? As we get to really ensuring the next first impression of the next phase of the narrative.
I love that you mentioned the wild, wild west. I don't think banking technology is really going to catch on. We have all these cages and safes and stagecoaches, and they're all getting hacked, and vaults are getting broken into. And so essentially, humans are all about progress, and progress is all about builders building and breakers breaking, and the breakers are the people who help the builders to build better. And so decentralized finance is still very, very young. But the incredible thing about decentralized finance and all of this stuff is that it moves us from a centralized world of subjective trust to a world of decentralized, automated, objective trust. And what that means is that we're all going to be collaborating on open, shared protocols. We're all going to be able to inspect those protocols, use those protocols, build on those protocols, fork those protocols if we have a philosophical issue with those protocols. And unlike a world where the priests are essentially the ones who mediate our interaction with the new money gods, or the priests are the ones who mediate our interaction with governance of nation states, we won't really need priests anymore. We'll certainly need people and tools to help us understand the technology, but the world of magic internet money Legos is basically a whole bunch of protocols for lending, borrowing, savings, exchange, trading, insurance, etc. And it's all accessible to everybody. You can be your own bank. You can take your own bank and wire it up to the insurance project that your daughter just put together. And so it's a brave new world, and we're all going to be able to operate it ourselves.
A lot of courage. Go ahead.
There's this middle step that happens, and you try to predict the future when you're in the investing business. But like what I see, I think of Calibra, the Facebook wallet, or all of these Silicon Valley, messaging systems, Telegram, who's been shot down with their ICO by the SEC. But what they're trying to build is really a wallet that creates your bank Why the banks are so nervous is because it's banking, it's insurance, and they're going to have, the Calibra wallet will have the ability to buy Bitcoin and Ethereum on it, and it'll have stable coins. And so you might not have a guy who does everything in a decentralized world. It might be some hybrid, but we're moving to that digital world where blockchains and cryptocurrencies are going to become a much bigger part of it. There's an inevitability towards that. And so it's one reason I laugh all the time. Jack Dorsey, who's got Square, and the Square app is their biggest thing, is buying Bitcoin these days, and he's got Twitter, and they're decentralizing that, or at least experimenting with that. His profile on Twitter says Bitcoin. The West Coast guys are all bought into this shift. And Paul Jones, being one of the first prominent East Coast guys or finance guys, are starting to say, well, maybe, right? I'll buy it as an option. And so we have this convergence, I think. And the story isn't finished, right? And what 10 years looks like. But I know it's not going to look like what it looks like now.
Well, Mike, to your point, I talked to one of the Silicon Valley guys, one of the originals, Tim Draper, yesterday, upcoming Forecast podcast. And he's obviously famously known for buying the Silk Road 30,000 Bitcoins at auction from U.S. Marshals after they seized that group of Bitcoins.
$500 or something like that?
It was 19 million. So it turned out, I did the math, it was $640 per. And 40? Obviously now he's made $250 million as a result of that purchase. But look, he's made a bet on not only blockchain and Bitcoin, but also in his thesis, it's going after high cost, whatever anything that's high cost but bad service, right? Right now, COVID is getting rid, on a corporate level at least, the high costs, bad service, that's going away, right? The companies that are so highly leveraged, that doesn't have a cash pile or an asset pile to depend on, that's going away. A lot of these zombie or industries, that's going away. And now the next layer is, what else is high cost, bad service? One of the industries obviously is GovTech. But with COVID and in this disruption, are people going to wake up to the fact that we could do things differently that traditional legacy companies or structure has done? Is that moment coming soon, or will there be other forces at play, like the regulators, like?
Listen, regulators aren't going away. Governments aren't going away, right? Anytime soon. And so there's going to be fits and starts. Bad businesses in the legacy world are going out, and the guys with lots of resources and capital and scale are doing well. Listen, I think in the crypto space, there are 15 wannabe blockchains that compete with Ethereum that really either need to find their own space or be interoperable. Some will succeed, some won't. I, just as an outsider, don't think we need as many blockchains as everyone's trying. For Telegram to create their own blockchain, in some ways, they could do just as much using the Telegram system as a wallet, messaging system, and be able to transmit Bitcoin or Ethereum or whatever else they want. And so we'll see how it all plays out. I don't think I think this is a significant moment in the acceleration. There's nothing that says we're going to kind of go from 0 to 1, right? It's going to be the hard work of building networks and building things that people want to use. And, even privacy. Privacies are really complicated. Like, one of the great reasons I love the blockchain space is privacy. And what we found is, so far, people don't care as much about their privacy as I do, or at least I think they should. And so will that change or not? It hasn't yet. And so I think this is all going to unfold, and we'll see.
So from day one, consensus was about convergence. It was about building out this brave new world, the revolutionaries, and holding the hands of the evolutionaries and enabling them to use the new technology to build better systems and transform their own businesses and lives. We are very friendly with government and regulators and major institutions, and will continue to work really closely with them. But I do think things are going to change. I do think that as governments maybe have less control of monetary systems, as people have greater control of creating different kinds of assets in an unintermediated way and trading those assets. As those assets get married to collaboration networks, and we build groupings that run according to protocols that everybody on those systems can trust, then those kinds of groupings, whether they're businesses or social networks or they form themselves to bring a cure to a particular disease, they can define their own philosophies, they can define their own objectives, they can raise their own money, and they can execute solutions to the problems that they identify. And so there's going to be a lot more power, a lot more economic and political agency in the hands of people and small organizations. And I think that's going to be a great thing, because nation states that are governed by two parties or worse, one party, have about 98% of the people not well represented.
Listen, and the governments aren't all anti this space. They're not all anti-blockchain. They're not all anti-crypto. I mean, listen, China said we're going all in on blockchain. But even in the U.S., I got a call early on in the crisis when people were very worried about the fraud in the PPE sales and front running and price gouging. And the government was putting the task force together, and they wanted kind of a blockchain expert to help them figure out how you could use a blockchain. It really wasn't my bailiwick to be that expert. And so, and things were moving maybe too fast to get that set up. But that was their first thought, like, how do we do this? I thought that today I tweeted, this PPP program where, some people took $2 million. And, Justin's son, from Tron was called out today. I don't know if it's true or not, but he looked kind of silly if he's a billionaire, tech guy taking $2 million from the government. Again, I don't want to accuse him of that. It was on Twitter all over. And I was like, shit, that whole thing should have been on the blockchain for public to see. You're going to take federal assistance in that time. We should see who gets it, instead of some people being shamed and other people's being not shamed. And I don't think anyone in government would disagree with that. And so part of that is getting enough people that understand how to use it and how to build it, and having enough companies that can come in and help them get there fast enough. And we're not there yet, but we're moving there really fast.
Yeah.
From our vantage point, I think there are very many people in government who would disagree with that position, Mike. And we're actually in discussions.
Oh, I'm not saying, I didn't say it was the majority by any stretch, but I said they're not all opposed.
Yeah, we're actually in discussions with a nation state, and it looks like we pretty much have the contract to build blockchain-based procurement systems so that people know what's being paid for and who's getting the money.
And it will be those nation states. And you bring up a good point, Mike. China is almost leading the pack at the moment because of its centralized, very top-down, and very dominating relationship that it has with its own private sector. And so if it's championing blockchain and not cryptocurrency, but its own version of DCEP or central bank-backed digital currency, that initiative is actually really what we're observing. I want to ask you to comment on what we've recently written on at Forecast, that the PBOC has partnered up with AI giant unicorn SenseTime to develop fintech innovations for the country. That would be the equivalent of the Federal Reserve hooking up with Google to help out Wall Street. That seems, but what that stresses is two very separate systems. One is going this way, very centralized efforts using specific technology to create its own ecosystem, technology-backed ecosystem, versus the West, where it's very ground up and ground swelled and privately funded.
You know, I said we haven't been so worried about our privacy in the US, things like Facebook. You know, it flares up, but no one's willing to pay at this point. I mean, China is the extreme example of a culture that is used to sacrificing some privacy for social good. And all of a sudden, you've got a government with this accelerating technology that now has really scary state operations that can monitor, spot, facially recognize, socially score people's behavior. I am petrified of a centralized cryptocurrency in China where they say, yeah, we don't like gay people anymore, and let's just freeze their money. And they know exactly who's gay by their shopping patterns and their search histories. And so it's a dystopian world. It could become a dystopian world with centralized data collection. But one reason China's so good at AI is they have better databases because they collect it all. And so I think we could have two worlds, you know, the behind the China curtain and the rest of us who want to preserve some privacy. And that debate has to happen in the public square of where that line is between what governments are allowed and what they're not allowed. And I think there's a healthy debate there. You know, the most radicals say nothing, right? And I think there's a more practical answer, probably somewhere in between. But that has to continue to mature.
Yeah, unfortunately, unfortunately, I agree that we're seeing a pretty serious bifurcation of the planet. The story that you're pointing out is just another data point in the long narrative of government control. They will be incredibly good at it. They don't need a central bank digital currency to get even better at, well, maybe it'll make them a little bit better at it. It's a pretty scary future that we're facing potentially. We don't get a lot of economic data truth out of mainland China. Apparently, we didn't get a lot of warning and truth with respect to the current crisis. Mike was talking about essentially discriminating against certain segments of the population with a powerful system like that. That is happening if the stories of the Uyghur population is true and transplant tourism. There's potentially scary stuff going on. And I'm excited about the implications of blockchain technology in how it can create a shared reference frame, a shared source of truth, a shared trust foundation. So even if our nation states are having issues, trade disputes, etc., we can still potentially build supply chain networks that can interoperate with one another and trust each other. It's going to be necessary to instrument all the way to the sensor level. You're going to have sensors with signatures and calibration systems so that there isn't garbage into the system. Once you get good data into the system, I think we can trust with these blockchain networks that they will stay clean. And interestingly, we're hearing from different organizations that they want to interface with these new Chinese blockchain networks, these business networks, but they're concerned that unlike what blockchain was intended for, they're not really going to be able to trust that technology. And so what we're hearing is an interest in building bridges between blockchain systems that Western companies can trust and blockchain systems that are part of the infrastructure in mainland China. And so once you build those systems, you know at least the data that's coming out of one system is trusted. And so I think building those kinds of bridges is going to be really interesting. And mostly I'm really excited about a different kind of virus, and it's an intellectual virus. It's this notion that if you build shared trust foundations, if you build decentralized systems, that they're actually really good and potentially better at building infrastructure on it. And that's the kind of virus that I think could be hard to suppress, because once engineers throughout the nation start seeing that they can build better systems and interface with Bitcoin and interface with Ethereum, they're just going to see that there's a new paradigm that looks like it's stronger and may eventually win out.
There's a new common denominator we're living at right now. There's no doubt that that's going to be a floor to these future conversations. Before I let you guys go, two critical things happening, and in the context of COVID and a post-COVID world as you look into the future. We've got Bitcoin halving, and then we have the launch of ETH. How has the narrative there changed for you both?
I'll go quick and I'll let. Oh, you want to go first? You go first.
No. I said you start.
Oh, so listen, the halving in some ways was so perfectly timed because forget the technical aspect of it. Okay, the miners are going to have less to sell. The rest of the world is doing quantitative easing, and the halving is quantitative tightening. And so it just highlights that there can be digital scarcity or a scarce asset, right? We go from a 3.4% inflation rate to a 1.7% inflation rate on our way to 0.8 and lower. And so it's almost wonderfully timed with this new surge of macro enthusiasm around the problems that the money printing is causing. And then on ETH2, I think there's work to do by the community in what that narrative becomes. It finally shows we got progress and we're getting something done. And, listen, I'm not a computer scientist. These are Herculean technical feats that are being pulled off. And 3 years ago, people were like, well, it's coming. This has taken longer because it's really complicated. And Joe probably can talk to that. I do think, what needs some clarity is, what an ETH becomes if you got an ETH2 and an ETH1 and there's the same ETH, and how that whole process works over the 2 to 3 years it takes to migrate really to ETH2 for, fully as opposed to a test net. And so, again, I'm not an expert on the technical side, but I think that narrative is important. What I think is just as important, though, for the Ether community and for the price of ETH and for the activity is that more and more things get built, even on the original ETH, that more and more, that network, right? You've got, hundreds of thousands of developers. You've got, projects. All of that growing will, lead the way for the price of Ethereum to rise, and good things happen when it goes higher, right? It just, so it's almost essential. It doesn't have to rocket, but it's got to keep going higher to bring the excitement in.
Yeah. So Ethereum 2 is indeed big and complicated, and it'll get phased in via multiple phases. But the important thing is that it is Ethereum, and it's going to be really useful virtually immediately, despite what people think. So it'll be a useful sort of theoretically in that it lands a proof of stake system, a massive proof of stake system, and shows the world that something that big and that valuable can operate at virtually zero electricity cost. So that's going to be pretty powerful. Ethereum 1 is effectively merging into Ethereum 2. Ethereum 2 is realized in 3 major phases. The first is the beacon chain, the heartbeat proof of stake. There's a test net running right now with 3 of the major clients on it, and another client that's connecting to it intermittently. So it's really on the precipice of launch. Once that chain the Beacon chain launches, and it's launching from Ethereum 1. So staking is happening from Ethereum 1 into Ethereum 2. One-way connectivity. It's basically birthing Ethereum 2, and it's birthing a brand new technology. So it's not held back by the previous architecture. It's building this much more scalable, much more powerful architecture. Once the Beacon chain is operating, we can then reach back and create bi-directional connectivity, and we can use the new chain to finalize blocks faster on the old chain, reducing issuance. We're going to be reducing issuance anyway, and so issuance of the Ether token is going to drop pretty drastically over the next year and two. The second major element is that when we add shards of data to this system, we will make a lot more data available to all the scalability systems that are going live right now on Ethereum 1. So Ethereum 1 almost doesn't need Ethereum 2 for scalability because we're bringing thousands and tens of thousands of transactions via optimistic rollups and zero knowledge rollups and state channels to Ethereum 1. All of those have the need for available data, and a lot of that will be able to be sourced from Ethereum 2. Finally, when we have execution environments, and one called the Ethereum Virtual Machine will be launched on Ethereum 2 first, we're going to be able to take a snapshot of Ethereum 1, and essentially turn it into a shard of Ethereum 2. And so activity will proceed as normal, exponentially grow on Ethereum 1 until it basically finds itself wrapped in the arms of Ethereum 2. So Apple Computer affected a very smooth transition between OS 9 to OS 10, a massively more powerful technology, and they focused on making it seamless for the end user. And so that's exactly what's going to happen on Ethereum.
Well, this is all happening against the backdrop of COVID-19. And if we go back to where we started with this conversation, the changing crypto narrative started in 2008 with the cypherpunk movement. And I would say that we all kind of resemble that personality at the moment as we really dig deep and take a look at societally how much we need to change, and structurally how much we need to do still. I want to thank Joe Lubin. I want to thank Mike Novogratz. And thank you so much to everyone for joining us in this conversation. And do stay tuned for the rest of Ethereal Conference. I'm Angie Lau, Editor-in-Chief Forecast News, and we'll see you there. Bye, guys. Thanks a lot.
Thanks, Angie. Thanks, Joe.
Hi, I think I'm on. My name is Randy Saff. Consumer-facing games company. We specialize in crypto gaming built on the Ethereum network. We've been around since 2015. of the first 100 free iPhone games. And that became a very large ad network called Ad Colony. So we've always been very interested in emerging games. All right. So Lucid Sight is, as I said, specialized in play-to-own gaming. It's good now. All right. So there's a lot of people have been mentioning Magic the Gathering as a game that people have had before that own the cards, and people like to use this as a good metaphor for crypto gaming because all right. Video because the presentation seems to be kind of going a little wonky. So the idea of a metagame is that it changes the rules of the game.
Welcome to the internet.
don't need no permission. Robots, programmers, hacking, and unicorns. Together, part of something, even if it's apart, even if it's apart.
I think we're live now. Hi, everyone. I hope your Ethereum is going great so far. I'm Min Teo, and I'm the investment partner of Consensus Labs, leading the venture investments team at Consensus. It's my pleasure to be hosting this panel with some of the investors that I really respect and admire. And we'll be discussing how we assess growth and adoption on decentralized protocols. But first, let's kick off with some brief intros with our awesome panelists. Michael, do you want to get us started?
Sure. Yeah. Thanks, Ben. My name is Michael Anderson, co-founder here at Framework Ventures. Previously worked in traditional technology companies, building product at Dropbox and then Snapchat. Started a tech company, startup in the digital collectible space, and are now focused on the DeFi ecosystem with Framework.
Great to have you, Michael. Ash, do you want to go?
Ash, are you on mute?
Can you guys hear me?
Now we can hear you. Great.
Can hear you now. Ash Egan, partner at Accomplice. We're early stage funds, often the first check into companies. I focus entirely on crypto at Accomplice. And before Accomplice, I was at Consensus. So I had the pleasure to work with Andrew and Min.
Thanks, Ash. Spencer?
Cool. Hope everyone can hear me. I'm Spencer Noon, head of crypto investments at DTC Capital. We're a crypto native fund based in the Miami area. I'm also the creator of Our Network, which is a weekly newsletter that tracks the network health of crypto projects in the space and using on-chain metrics and analytics. So thanks for having me.
Thank you, Spencer. And last but finally, and definitely not least, Andrew Keys.
Hi, everyone. We're slightly different. Dharma Capital, Digital Asset Risk Management Advisors, is a commodity pool operator and a commodity trade advisor that's registered with the CFTC. Our goal is to achieve quantitative systematic alpha on Web3 protocols such as Ethereum. And prior to this, I helped build a little company called Consensus.
Yeah, we like to keep in the family here, don't we? Great, cool. So, starting with Ethereum, we're quickly approaching the 5th anniversary of the launch of Ethereum. We've got a vibrant ecosystem. Seems like there's a new project popping up every other day. Kind of like looking back to where we were and where we are today. Are we where you thought we would be? Are we where we should be? And more importantly, how do you sort of measure growth and adoption in that regard? What are some metrics that you rely on to see how we're doing on that front? Spencer, you want to take a go?
Yeah, sure, happy. So are we where I thought we would be? No, I think it's really hard to project this stuff, right? I think, that or rewind back to 2017, early 2018, Ether is trading at, what is it, $1,400. And I think we all thought the future would look a lot brighter, right? It traded at many more multiples of that. And it hasn't. We're around $200 today. But does that mean that the kind of progress in the ecosystem has lagged too? No, I've been totally surprised with where we're at. I think you can look at things from a user perspective, the platform, the community really coming together. It's all been, I think, really encouraging. And I'd say the biggest thing that I underestimated was how quickly DeFi would come together. In December 2017, I think we had maybe less than $10 million of assets locked in DeFi protocols. And today we're at 800 and something million. We've already crossed $1 billion at, a month or so ago. So that's just explosive growth, right? And the user growth is really promising as well.
So I would agree.
Go ahead, Andrew.
Go ahead, Mike. Mike, after you.
I was going to add one thing I would say about overestimating and underestimating is back in 2017, 2018, the use cases of digital collectibles or games, content and commerce being other potential application categories, expecting that those would happen simultaneously with DeFi or even before that, just given the consumer appeal. So underestimated how quickly DeFi would come out, but definitely overestimated how quickly it would take or how long it would take for other application categories to come out.
So I underestimated the developer community. I think it's the most vibrant developer community in the world, and I overestimated the speed to actually build the plane while flying. Obviously, these are very difficult distributed systems technologies that are being built, and obviously Ethereum 2.0 is taking a little bit longer, but I think it will be worthwhile. With respect to what we look for in terms of data points, I would bifurcate it into kind of quantitative and qualitative. On a monthly basis, we're looking at kind of unique addresses, network utilization, hash rate, gas usage, assets in DeFi. And then more of a kind of a qualitative metric, we look at kind of the sophistication of smart contracts. They're getting definitely more complicated. You can check on the GitHub repositories and see things like the various clients that are building on the test nets for ETH2. So I think we kind of there's a little bit of an art and a little bit of a science to looking at this.
Yeah, and just to add, I think some really good points. I think the goal here, whether it's DeFi or other categories, is to have venture scale type businesses being built on chain, and we're seeing that. I'm not saying do they have to be venture backed, but more venture scale, and we're seeing that happen at a super rapid pace. Some really cool stuff, obviously, happening in DeFi today.
And that's all without having a quote next generation smart contract platform, right? I think you look at a lot of the narratives that were happening in the space, especially in 2017, it was, we need this big, fast blockchain to be able to process this many transactions per second. Otherwise, this whole space is for naught. And I think what we saw was that scalability actually happens on a number of vectors. And yes, transactions per second is big, but so is collateral, right? Ethereum has $20 billion of collateral that it can use in other applications. It can suck in different assets like fiat-backed stablecoins and real estate, and the list goes on. And no other smart contract platform currently comes close to doing that. And so I think, you know, there's been a lot of different ways that I've looked at it, and I too, kind of like Ash, have been surprised at how fast it's going.
Yeah, and just to pull on that a little bit more, Spencer, you know, in terms of adoption, it seems as if all roads lead to DeFi. Do you think that sort of Ethereum's, I don't like this phrase, but, you know, killer use case, like being the value settlement layer, and how does that overlay with other Web3 applications that we're also excited about? Are there is there anything else that you're excited about in the near term, or do you think it's mainly going to be DeFi?
Yeah, no. So when I was thinking about, like, as I think about this question, it reminds me of this Jeff Bezos video from way back when he was just building Amazon, and someone like gets him on the street and they say, Jeff, tell us about Amazon. Why are you building it? And he goes, well, bookstores for the internet are actually the first best use case. And I think that's pretty similar to how I think about DeFi for Ethereum. Finance is the first best use case for Ethereum. And I think with all the financialization and infrastructure that we've seen over the years, we're now able to kind of leverage permissionless protocols and other primitives in really cool ways. And so I think the other types of applications will slowly emerge, and it'll probably start by kind of bringing those financial tools to other asset classes. So like art or gaming, right? You can now bring Uniswap or some other DeFi infrastructure to it, and then we'll slowly surpass it afterwards. That's at least my mental model for it. I'm not interested in what happens kind of outside of DeFi, but I think for the here and now, especially over the next few years, that's where it's at.
Anyone else have any thoughts on that?
So I put devil's advocate.
Okay, maybe let's go with Ash first, and then we can. Or go ahead, Andrew.
So I could just.
We want to hear the devil's advocate.
From kind of the institutional and investor perspective, I fear that we have a bit of a chicken and the egg. I think, you know, if we can talk about, you know, DeFi coming to the institutional investor, you know, I think probably the closest we're going to get in the near term, and I would say near term meaning the next year or two, is someone like Paul Tudor Jones buying regulated CME Bitcoin futures, not actually custodying the Bitcoin himself, and to now get from there to actual decentralized financial protocols. There are a few kind of non-starters, unfortunately, at this point. You know, one of the main ones is striking NAV. Being able to, you know, what I personally use InstaDApp, and I refinanced from a maker interest rate that was at X to a compound interest rate that was 80% of X. And that process was seamless on InstaDApp. I thought it was excellent. It worked very well for me personally, but trying to extract that information and giving it to a fund administrator or an auditor is next to impossible. And I think that while you've got $1 billion worth of assets locked in DeFi, I think we've got $80 trillion in assets in the global economy. And we've got a long way to go before onboarding that and really being able to issue credit from kind of an institutional perspective. So I think that this is amazing, wonderful work. We are in the first pitch of the first out of the first inning still, and there's a long way to go.
Definitely, Andrew. And
really
hold
good
on to
points
that
there.
thought, because I want to come back to it after. But Ash, please go ahead.
So I think things beyond finance will live on chain in the long run. So I don't think it's just DeFi, whether it's Ethereum, these other layer ones, I think is going to be fascinating to watch over these next few years. And DeFi is getting easier to use. There are teams working on abstraction. There's new offerings that are coming out. So I think that's great. I think what I've thought through a lot is, the DeFi activities today, is this the participants from 2017? Is this just the same group of people, 3 years later? I tend to think it's probably just, hearing from friends on Wall Street, asking about MKR or, these other assets. I tend to think it's grown a little bit, but, I think as a industry, we always have to think around, how do we welcome new participants? Is it better offerings? And, I think when I say DeFi, or when we all say DeFi, what does that actually mean? I think ultimately, we're trying to build sustainable on-chain businesses here. And whether they're completely decentralized, quasi-decentralized, I think some folks are more focused on the decentralization piece. I'm more focused on, can we build incredible businesses and protocols on chain?
And maybe I'll just step in for a second. Fully agreeing with most of what has been said. The only additional point that I would add is I kind of get stuck on this concept of when are the institutions coming, where are they coming from, and how much money are they bringing with them. I think if we're really successful in building a decentralized ecosystem that Ethereum could potentially become, with a diversity of application categories like DeFi, content, commerce, what have you, it's not going to be the traditional players that are going to be the ones that are acting the same way as they have been in Web 2 and in previous iterations of the internet. It's going to be new things built from the ground up, purpose-built for this industry, for this technology. So the concept of a bank might not exist in the same way that we know it is today. And it's not maybe a huge deal for that bank to come on board to the Ethereum ecosystem because we're in the process of building it already.
Yeah, I would piggyback on that just quickly. There was an article that came out, I think, recently somewhere in the community where they were talking about kind of Eurodollars and this Eurodollar ecosystem that's billions of dollars. And we're starting to see kind of the early signs of fiat-backed stablecoins being a way for like a liquidity source in this like Eurodollar industry. And so that's different than, what JPM and Goldman Sachs are doing in New York City. And, I think it just kind of shows that this might not play out the way that we think it is, with like us showing up at the doorstep of Wall Street and them kind of like collecting us with open arms.
Definitely. I think we all have a love-hate relationship with our bank. So I certainly hope you guys are right in that regard. I think as I look back on the last several months, I think there have been a few events that highlighted some vulnerabilities of DeFi protocols, events of Black Thursday, several hacks and arbitrages. How do we strike a balance between rapid product iteration and security? I think back to a conversation I had with someone who's been in the space for a long time, and he was like, yeah, I've never put any money into any of these DeFi protocols. I don't intend to, I don't trust it. It's like safely tucked away. And if you put yourself in the shoes of an early stage founder who's trying to get something off the ground in DeFi, what advice would you give them in terms of how they sort of balance security and product iteration and getting user adoption that way?
Use Mythex and consensus diligence. These things have to be audited. They custody real people's real assets, and it's a tremendous responsibility. I think you raise a great point on the tension between move fast and break things, and now the fact that we're not just transferring communication. We're actually transferring value, and I think the delicate nature of that asset. I think that you could almost. I think that there could almost be milestones where you can go proof of concept with $100,000 and kind of milestone it out and say that this has been formally verified or certain amounts of audits and then kind of milestone out the progress. I think that there are lots of the iterations of these DeFi protocols have phase zeros that are not on that are not getting attacked or in a Byzantine environment before they go live, and they are kind of hacked after. So I think that if we could figure out some type of milestoning and some type of gating function where we don't have too much and definitely not copy pasting like what dForce did. I think that should be almost mocked in the industry.
So I'll piggyback there. I think the other aspect here isn't necessarily just around security or the amount of dollars or value that's tied into these ecosystems and the level of security with which they have been audited, checked, controlled, what have you. The other way that I think about this question, and maybe not as it is to a hack or a vulnerability, but just general system design, there is rapid iteration of development, of product development, and full decentralization of decision-making are fundamentally at odds with each other. You lose the ability to act quickly and make decisions as a core protocol team the second that you start moving to a maker governance model, voting on decisions, protocol upgrades, and that just slows down iterations and slows down progress. So one thing that we advise a lot of the core teams that we invest in is what is that right balance to strike? When is it time for you to say, okay, I'm ready to throw over the reins of this protocol and hand it off to the community, and here's the governance model, and here's how the whole thing works. Like, here are the keys to the kingdom. Obviously, that shouldn't happen very rapidly, but there needs to be a gradual process, and that needs to be something that the team decides with the community, with a governance model that makes sense for the product and the market. And it's something that the best are trying to figure out this exact problem now, and we don't have a one-size-fits-all solution, but it's another aspect of this question that I think about a lot.
I think you also have
Michael,
to look at it with layered.
Go ahead, Ash.
Yes. So another way of looking at this is you look at sort of what's happening within DeFi from a layered approach, sort of like building a house. At the smart contract layer, I don't think you want to be innovating too much, right? You want audits. Like, there's just table stakes to actually have something that's going to be performant. I think though the move fast and break things mantra can be applied though to the UX UI sort of higher in the stack. So I think it really depends on, like, we should be pushing, new products, new offerings, all these things, but I think they're table stakes to ensure security and definitely some emerging best practices and things you just don't want to do.
Yeah, I think everyone's had some really good points here. Like, this is something that we're obviously just going to have to continue to get better at as an industry. We're clearly not good at it today. I think every single week over the past months have had some type of DeFi security incident, and so that's obviously got to change. I think one thing that resonates with me. I was watching an earlier panel in Ethereal, and Felix from Set Protocol had this idea basically called progressive security. And the idea is that when you kind of launch your application, you don't need to be as crazy with respect to economic audits, security audits, technical audits, informing your users, things like that. But as you scale AUM, as you get product market fit, it's up to you to continue to invest in like your user safety. So I think it depends on where you are in the life, like kind of cycle of your company. But one thing I think a lot about too is just the absolute early stage. You don't need money to inform your users that they're using something that's experimental. You don't need money to put a huge modal on your screen like My Crypto did back in the day that made you click through every single warning before you got to use their product. We can do these things today, and we can do a better job of them. So yeah, it's a really tough question, but I think there's ways to address it now.
Yeah, I think those are all great points, Spencer. It really reminds me of, Robert Leshner of Compound and how he talked about how they had, a Compound V0 and having that DNA in the team of like constant monitoring and constantly thinking about security and, customer funds since the beginning. In a lot of ways, it feels like it's more of like a mentality as opposed to like, just getting certain, check marks on the roadmap. So can't agree with you more here. I think, thinking about where we are today, usually, I have the pleasure of seeing you guys all at conferences and catching up there. But instead, we're sort of in a Zoom room, jamming in front of like, a couple hundred people who are watching us. But, with the global pandemic, economic crisis unfolding, insert your favorite sort of money printer, go brewer meme over here. Like, how do you think that impacts, the adoption of crypto generally? Do you think, it'll help it 10x, 100x? Do you think, the world has too many problems to care about crypto? What are your thoughts here? Andrew, do you have anything to share?
Sure, I absolutely think we're at an inflection point. The money printer go burr is absolutely right. I think we're right now in a fog of war, and a lot of people are responding to their own familial and kind of, let's say, one generation crisis rather than kind of the proactive steps that we're going to be taking in kind of ameliorating and solving these problems. That said, I think this will absolutely expedite the need for digital currency. So that's fiat-backed stable coins, central bank digital coins. I think that this is going to expedite that as we don't want to handle menus in a restaurant and dirty paper dollars. I think that one's easy, and I think that for years now we've understood the fragility of I would say and the subjective nature of centralized database systems, and I think that this is just going to accelerate the need for decentralized and resilient systems. That said, and I do agree with, I think Michael and Spencer both kind of touched on the points that you don't necessarily have to go to the enterprises to get this change. You can build this from the bottom up. But I do think that there is a certain need to communicate with the pre-existing world. And I think the Procters and Gambles of the world that run the largest supply chains, for example, are going to need these systems. But right now, they're going to be putting out their own fires. And I think that in that respect, you're going to see that the corporate development budgets are going to be less because they're just going through their own internal crises at the enterprise level. So I think that there'll be a tension in that part where you probably won't see as much development from the larger institutions that were just starting to get comfortable with these technologies. Paul Brody today was talking about if he had $1 for every enterprise that could come out of the closet that they want to use public permissionless mainnet as soon as we get things like ZK Snarks ready and rocking. And so I think that we're going to see a slight delay in that regard.
I thought it was fascinating to see the Udemy announcement around, from the prior month, there's 5x the amount of folks that were interested in crypto-oriented classes. I think right now people are at home thinking about, can they go back to their prior jobs? Do they need to retrain themselves? And I think crypto is a industry or category that people are looking at, and has a very exciting future ahead. And so, we're not going to convert all of those individuals, but I think that this is a time where a lot of people are thinking about, taxes, money, just in general, like, the idea of it, and even, their prior careers. Is this the time to refocus? I think, crypto's well positioned for a variety of reasons.
Definitely hope so. I think we're nearing the end of our panel, so I have one last question. There are obviously some other base layer protocols up and coming, and how do you sort of see DeFi adoption playing out on some of these other chains? Will Ethereum continue to fend off these ambitious newcomers? Spencer, Michael, you're smiling. Yeah. Anything?
Yeah, I can take it to start. So I think this one is pretty interesting. It's a great question. Like, I was just on another panel with a bunch of investors, and I was surprised because the consensus on that panel was that they really didn't think that DeFi was leaving Ethereum, and that was just such a marked difference from the last year. Like a year or two ago, I think most people thought it was kind of up for grabs. And I think we're seeing the network effects and defensibility of Ethereum's DeFi ecosystem. They're just super strong. And so, we're seeing now a lot of two-way bridges being built with these other next-gen smart contract platforms where they want to be able to send their assets to Ethereum. And then obviously it comes back the other way, but who knows how much it's going to get used that way. I think they'll have to really develop their own kind of competencies and niches. And that could come with scalability, right? Ethereum 1.0 can only do so many transactions per second. There's a fee market there. It costs money to do computation more than it does on some of these other blockchains that have had their block space subsidized by venture capitalists, right? So I think we could see a future in which you have the finance kind of decoupled from the computation. So we'll have to see, but I do believe we'll have a future in which, like, people won't know exactly what smart contract platform they're interacting with at the end of the day. It could be a mixture of many.
Fully agree there. The only things that I would add, and we've looked at DeFi across different chains, Polkadot, Cosmos. It's definitely something of interest for us. A few days ago, Synthetics launched their layer 2 demo using the Optimistic virtual machine. I don't know if anybody's been using it or playing around with it. I'm currently in a competition with Vitalik for top trading rank. It is like it's the best example of a consumer application on Ethereum that I've seen yet. It's less than 250 millisecond speed transaction times. It feels like I'm using Binance or any other of the centralized comparables. That gives me hope that it basically negates most of the reason why anyone would want to go through a high throughput blockchain in lieu of Ethereum for DeFi. More innovations like that are just going to continue to build this network effect, as Spencer talked about. It's just going to get stronger and stronger over time.
I think the last thing I'll add is I think you have new sandboxes. We are large investors in Near, Coda, and Flow, and all three of those teams have very different approaches in terms of what will be built on chain. The longer term, it's tough to see how all of these, how it's all going to play out. Is it one chain? Is it sort of five? Is it geographically broken down? Obviously very curious how it all pans out. But I think over the next 2 years or so, it's going to be very complementary. You're going to have new experiences, offerings, products, dApps built on some of these new layer ones, Ethereum will continue to grow, DeFi will continue to grow. So I look at it as a positive sign.
Agreed. I think that Ethereum will continue to grow. I think other protocols will grow. I think it's way too early to talk about any of them because none of them have shipped in a meaningful way, aside from proof of authority networks, which is really, I don't think counts. And so we're in the first pitch of the first inning.
Awesome. Some great points here. Well, I hope everyone stays safe and healthy throughout this lockdown. Michael, we're rooting for you with this competition. And hopefully we can all reconvene in a year and talk about, how we have like 20 billion or 50 billion locked in DeFi then. But thanks everyone for your time. This is great. Bye.
Thank you.
Thanks, man.
Thank
you,
Bye-bye.
everyone.
Hello, everyone. It's a pleasure to be back at Ethereal, albeit in a slightly different way than the previous time. And I'm gonna talk a bit about my usual theme of decentralized AI and why it's so important. But I want to give it I seem to have lost connection for a moment. I'm back now? Okay. I'm going to talk about my usual theme of decentralized AI and why it's so powerful and so important. But I'm gonna give the theme a bit of a contemporary flair this time and talk a bit about what we can learn from the COVID-19 situation about the need for decentralized AI and what decentralized AI can do to help us cope with COVID-19 better. I mean, of course, AI applies to every area of human endeavor and across every vertical market, and every area as it applies to AI should be using blockchain and allied decentralized technologies to deploy its AI. So I mean, I could pick fintech, I could pick cancer therapy. I mean, I could pick Internet of Things or space travel, and there's really nothing in the modern tech world to which decentralized AI cannot have a transformative impact. But COVID-19 obviously is it's disrupting all of our lives right now, including this conference, and it's something that decentralized AI can play a big role in resolving and helping with. And also, it's important to look forward to future pandemics and global crises, and be sure that we have a blockchain infrastructure and a decentralized AI infrastructure that can be even more helpful from the beginning in dealing with any future crises. So first of all, let's look at AI and what we can do with AI to help with COVID-19, and then I'll verge from that into the decentralized and blockchain aspect and talk about why that is so incredibly important. So there's a long list of ways that AI can help with the COVID-19 or any pandemic or severe medical situation. I'm going to focus on two here: precision medicine and then agent-based modeling of epidemic spread. So regarding precision medicine, rather, I mean, it's well known and shown time and time again that the best way to cure most diseases is not a one size fits all approach. Rather, it's to learn more about the patient's body and then use that to figure out which therapy will work best for that particular patient. And in the COVID context, that takes a number of forms. I mean, now within SingularityNet, because we have a bunch of people in our SingularityNet decentralized AI project who are knowledgeable in the intersection of AI with clinical medicine and bioinformatics. I mean, we're working with a couple parties doing clinical trials of COVID therapies and combinations of COVID therapies. And what we're looking at there is, gathering gene expression data and various clinical biomarkers from the individuals in the clinical trials for COVID therapies. So machine learning and machine reasoning running within the SingularityNet decentralized AI platform can then look at the data from the bodies of the individuals undergoing the COVID clinical trials and help figure out, based on a certain individual's DNA and what's in their blood, their clinical biomarkers, we can figure out which combination of therapies is going to be best for them. And then additionally, through a spin-off from SingularityNet called Rejuve, which you could find out by looking at rejuve.io. So Rejuve originally, it's mainly focused on longevity biology, like how can you use AI to help figure out how you can optimize your lifestyle, your diet, the supplements you take to maximize your lifespan if you want to live a really, really long time, and maybe live long enough that AI eventually figures out how to make you never die at all. But we've been reorienting some of the Rejuve tools toward helping you not die right now from COVID-19. So we're working on a Rejuve app, which will launch fairly soon. And the app looks at the input to your smartphone from medical peripherals, like a Fitbit, a pulse oximeter, a spirometer that measures the breath. And by looking at the input from the medical peripherals attached to your smartphone, then this Rejuve app can tell you, A, if you may be getting an infection even before you feel sick or show any symptoms, and B, if you do get an infection like COVID-19, how likely are you to suffer really severely? Like how robust is your body? So these are examples of things AI can do to help with COVID-19 or other medical problems. And another important example is agent-based modeling, and this has to do with using AI to simulate the spread of an epidemic and using AI to better model the possible impact of social policies, like, let's say making everyone stay at home in their houses or shutting down all restaurants or schools. And these policy decisions that we're all living under right now, which are costing tens of trillions of dollars in economic impact and massively disrupting everyone's quality of life, these policy decisions have been made really without much scientific analysis. They've been made on the basis of extremely simple simulation models and on the basis of the gut feel of politicians, and in many cases just pure political posturing. But there's a discipline of agent-based simulation modeling which is sort of like Sim City with more intelligent agents. Like you simulate intelligent agents going about in a world similar to the actual world, and then you see what happens. How does the epidemic spread in this detailed agent-based simulation of the world, and how does the simulation world change if you say shut down schools or make everyone stay at home or just make old people stay at home or whatever. And if you're curious about that, we actually did an online conference on this topic just like last week. It was the COVID-19 Simulation Summit, and you can find the talks from that on YouTube. But I think, it's really very, very strange that advanced AI-driven simulation modeling methods like this are not having billions of dollars spent on them right now, since the consequence of the crudely configured policies under which we are all living, I mean, the consequence is costing tens of trillions of dollars, right? So these are two areas where AI can help with COVID-19. But now let's see, how does decentralization play in? Well, it's going to be obvious to everyone in this audience, right? So say you have apps like the Rejuve app, or say the contact tracing apps that Google and Apple are about to roll out, or that the Korean government has rolled out for the Korean people. You have these apps that are measuring the state of everybody's body, and for their own good, because I want to know if I'm about to get sick, and I want to know if the person coming over to my house is going to get me sick or has just gotten me sick, right? All this medical data that we're gathering and analyzing using AI and statistics and so forth. Well, who owns that data? Well, we should own the data. It came from our bodies. But who controls that data? Well, whoever sucked the data in and put it in their database, right? So clearly, data sovereignty and appropriate data privacy, encrypted data management, all this is incredibly important here. And it's just so easy to lose track of that when people's lives are at stake. And agent-based modeling, same thing. I mean, you're building complex simulation models of the whole society to predict who's going to go where, when. And, this is sensible. It's intelligent. It's society knowing itself. It is what we need to do and should be doing to preserve people's lives. On the other hand, who should own all this data going into the simulation model? I mean, if you have a few centralized entities that are gathering all the data from everyone's body and everyone's movements, and are then using this data to make predictions of what's going to happen in society and to forecast the outcomes of various policies. I mean, this is not something that should be in the hands of the few, of the elite. This should be, in a democratic and participatory way, in the hands of the people whose data is being used to fuel the simulation models and who are living under the policies decided by the simulations, be they crude or sophisticated. So what's pathetic and disturbing to me, as someone who's passionate about the blockchain world and the decentralized software world, is that, right now, decentralized software is just, frankly, it's crap compared to centralized software, right? So I mean, if you want to make a contact tracing application, is it easier to wire it into Google and Apple's phones and phone OSs, or is it easier to put it out there on current blockchains? I mean, of course, you can make something much higher quality, faster, and simpler using centralized tools, right? And that's a shame, because in a situation where everyone's life is at stake, of course, people are going to want to do the easiest, most reliable, and most effective thing, even if it has the indirect consequence of moving us closer toward a biometrics-powered 1984 type scenario. So we're doing what we can now in SingularityNet, in our partnership with Ocean Protocol and Decentralized AI Alliance. We organized a hackathon called the COVIDathon, Decentralized AI Hackathon Against COVID, which you can find on DevPost now. We're doing what we can now to pull together blockchain developers and AI developers to develop decentralized AI tools to help with everything about COVID. I think we can contribute some value in areas like agent-based modeling, secure tracking and tracing applications, precision medicine, which respects data sovereignty. But of course, to a large extent, the COVID pandemic is going to be dealt with centralized tools, because that's what's mainstream now, and in many cases works more effectively. But this is not going to be the last global crisis. And so the main message I want to get out to everyone listening, if you don't like the idea of big tech and big government making a sort of biometrics and AI powered 1984 scenario, there's going to be another pandemic after COVID is cured. There are going to be other global crises after COVID is conquered. Wouldn't it be nice if there was a really, really effective, democratic, decentralized, participatory infrastructure in place that actually worked at high speed and low cost with reasonable user traction, so that when the next crisis comes around, the way it's addressed is with this decentralized infrastructure. Otherwise, each crisis that occurs will simply serve to concentrate wealth and to concentrate data and concentrate AI power more and more within a small elite of corporations, government agencies. And it's bad for all of us in our lives, and it's also bad in a grander sense, because the general intelligence that's going to emerge out of the AIs we're building now, that's going to emerge either out of this centralized system or out of a decentralized AI network, like what I'm saying we need to build. So anyway, that's decentralized AI through the lens of COVID-19, everyone, and thanks for listening.
Hi, hi everyone, and hi Robert. Great to chat. Okay, so I'll introduce both of us. So I'm Camila Russo. I'm the author of The Infinite Machine, a book on the history of Ethereum, which you can pre-order right now on Amazon. I'm also the founder of The Defiant, a content platform focusing on decentralized finance. And Robert Leshner is the founder of Compound Finance. Compound Finance is a lending protocol based on Ethereum, and it's the second biggest lending protocol in DeFi. So Robert, I wanted to start with talking about the state of the DeFi market and then diving into Compound itself, if that sounds good.
That sounds great. Excited to be here with you at Ethereal, and let's dive right in.
Cool. Yeah, okay, so you obviously have a privileged position leading Compound, like I said, one of the biggest DeFi projects out there. And so what are you seeing in the platform with how people are using it? We're obviously we've picked up from the really low lows of March. Value locked has slowly but steadily been increasing again. So are you seeing people going long ETH? Are you seeing maybe people borrowing tokens to short? Maybe people are thinking things have already been gone overvalued? What are you seeing?
Yeah, so we're seeing 4 things in aggregate, and I'll walk you through each of them. The first is that Compound, along with most of DeFi, is still in an extremely early stage. When we look at where it's come from over the past 2 years to where we're at today, it's still extremely small and it's still extremely early. So that's the first piece. The second is that Ether is still the dominant form of collateral. Whether you look at Compound or you look at MakerDAO or you look at other platforms, Ether is still by far the most dominant backbone of the DeFi ecosystem right now, both in terms of DEX trading volume as well as collateral used in Compound and other protocols. Third, we've seen interest rates mirror that of the traditional financial system in their decline over the last couple of weeks and months.
Right.
So right now, interest rates in DeFi are at essentially an all-time low. And in some ways, that's lagging behind what's happening in other financial markets. And lastly, what we're seeing is this new excitement and this new spring and this new activity sort of returning to DeFi coming from a lot of different places. One, it's coming from the decentralization of Compound and the handover to the community of control of the protocol. Two, it's coming from the launch of new DeFi applications. We're sort of entering this magical moment where there's a huge number of applications launching all around the same time. And lastly, it's coming from the return of asset prices. We're seeing this in Bitcoin today, we're seeing this in Ether, and we're seeing this in the asset prices of crypto in general. And all of that's coming together to create a really large tailwind for DeFi right now.
Nice. Okay, so I want to dig a little deeper in that. So I agree that DeFi is definitely growing. It's encouraging. Value lock doubled last year. And like I said, it's picking up, but it hasn't been like a huge rally into DeFi, even as all these things are converging. Why do you think that is? I mean, this is a really nascent space. It's super fascinating. It's achieving unprecedented things in finance. It's open to everyone. So I don't know, you would expect faster growth, like sort of more exponential growth, but we haven't really seen that. Why do you think that's happening? Maybe rates are too low and it just isn't bringing people in right now?
Well, that's absolutely one component of it. I think the other thing to look at is the total number of users of DeFi in the aggregate. And that's not growing rapidly. And it's because there's still a lot of frictions for what I would call a widespread normal user to be able to come into DeFi. It still requires a pretty high level of technical sophistication. And it requires you to essentially still get your hands pretty dirty. We've seen roughly a total number of users in DeFi growing, but not growing extremely quickly. So I think the biggest hurdle is making it as an entire industry more accessible to a much larger audience, which means building better on and off ramps. It means building easier tools, better UXs, simpler experiences in order to really grow the total number of individuals interacting with it. And so I think when that happens, we're going to see significantly more volume. Right now, it's still dominated in a lot of ways by the early adopters, by the whales, by the most sophisticated users. And so when we can open up DeFi to a much larger audience, we're going to see significantly more usage.
Yeah, absolutely. I think that's necessary to bring in more people, maybe easier on and off ramps with fiat are key. It's just really hard still to get just into the door and using these applications. By total number of users, which estimates are you looking at? What would you say is the total DeFi market right now?
Yeah, so it's easiest to look at Compound as a system. I've seen other numbers for Uniswap, for Kyber, for Maker. These are all sort of the largest projects. There's a couple ways to look at it. One is active users, so who's using the protocol actively, as opposed to a historical aggregate, as well as what are the total volumes moving into these protocols. I actually prefer to look at users as opposed to volumes because at the end of the day, we need to move away from an ecosystem in which it's dominated by early adopters. And so, users of all of these are growing to unique users. In terms of active users, a lot of them are flat to up. At Compound, we have about 20,000 active users right now, versus a lot more than that historically. But that's still within DeFi, puts us in the top 4 places.
Right. Okay. And going back to the point about rates, so there have been times in DeFi when rates are close to 10%, and that's kind of been the battle cry to get new users in. But do you think that's going to be kind of the main thing driving people in? And if that's the case, how can the DeFi continue to compete when there's more liquidity and yields are increasingly converging with traditional markets?
Yeah, that's a great question. So there's a couple of things that I think bring people into DeFi. One of them are interest rates that are competitive with what they're earning in an offline world. If your bank is offering you 0.5% and DeFi is offering you 6% for a dollar-like asset, it's a no-brainer. If it's 0.5% versus 1.5%, the frictions of going from the traditional financial system to DeFi and back again are probably excessive. So rates are absolutely a factor. But there's always a silver lining to each side of a coin. So low rates for suppliers of capital translates to low rates for borrowers of capital as well. So I actually think the next wave of users might be attracted to low rates from the other side. It's people who are looking for cheap capital. And in a bull market, which it looks like we're rapidly returning to, I think you're going to see a lot more enthusiasm for new products and new usage from borrowers. So rates do play a factor. The other thing I think that plays a factor in sort of attracting users into DeFi is simply the accessibility of it. In a lot of ways, the user experience of DeFi hasn't evolved that much over the last 2 years. Certain products, I think, have innovated wildly. I think Dharma is a great example of a product that, as a user, it's built on top of DeFi. It offers you DeFi interest rates. And you don't even know as a user necessarily that you're using, in the back end, a DeFi application. It just feels like a convenient wallet. So I think the more applications that launch with a focus on the economics, but not the flows and not the technical interactions, DeFi is going to scale and succeed very rapidly. So I think it's a big opportunity of growth in the next 2 years. And lastly, what attracts people to DeFi is self-custody and control of their own assets and the ability to interact with products that they don't have access to. And that alert is actually improving very rapidly. So in terms of the number and type of products that people are starting to have access to, from complex derivatives to savings accounts to simple trading abilities that they wouldn't otherwise have, that's increasing significantly. And I think that will bring in a new type of user, especially as other assets are exposed to DeFi. We're starting to see great experimentation from projects doing synthetic assets and looking to bring traditional assets into DeFi to allow users to hedge or speculate on the prices of not crypto assets like equities and commodities and currencies. And I think that actually has the potential to bring in a large number of new users as well.
Right. And I'm also excited about DeFi bringing in people when it's doing stuff that traditional finance just isn't able to do. When we have, things like Pull Together or Sablier that you just, it's just really hard to get that sort of product on traditional finance. So maybe that's kind of another avenue.
I'm excited to see people create applications that have never been conceived of. Like Pull Together is a great example. On the bottom, it's Compound, and it's an interest rate empowering an entirely new product that most people have never tried.
Yeah. So speaking of applications built on Compound, it seems like they've all been really focused on that mainstream user. But I remember very early on when you were about to launch or just launching, and we talked, you were like very much focused on like whales, like very experienced traders. So is that kind of the like the next phase of users that you want to bring into Compound, maybe including like other features that are geared towards those like more like power traders?
So I think a different way of framing this is, who do we view as the users of Compound? At this point, we view developers as the users of Compound. And our role is to encourage and facilitate other people in the space building applications that want to access a liquid interest rate, either to earn an interest rate on assets they hold or to be able to borrow assets they don't yet hold. And so for us, I think there's a whole spectrum of different end users that are able to access these markets, from whales to retail to institutions to new financial products to Compound being a building block in entirely new smart contracts. But for us, all of that comes down to encouraging the community to build these products and helping them build these products, as opposed to our team building out these new experiences.
Right. Okay. So you'll just provide the building blocks and let developers decide like where are they targeting their applications, basically. Yeah. Okay. And then I want to talk to obviously your latest big development with governance and comp tokens. Can you kind of explain your bigger vision with this and tell us about how the first like couple of weeks of community-led governance has gone?
Yeah. So our vision for why we're decentralizing the protocol is very simple. We have two goals. The first goal is we want the protocol to live forever. One of the biggest obstacles for the protocol living forever is having a single team that's the administrator of the protocol. There's a risk that, we go rogue or we're kidnapped or, someone fat fingers, a contract or something horrible happens when you have a single entity that is an administrator of the system. It's one of the biggest downsides of most traditional financial institutions and products is, you have one entity that can mess it up for everybody. And so the first priority is removing this centralized entity from being able to mess up the protocol so that, there's nothing stopping it from living forever. And the second is facilitating the community to upgrade the protocol. So when there's only one entity able to make changes, development is slow. Development is limited by the creativity of one entity. When development is open to the entire community, you might see a much faster pace of development and upgradability of the underlying system. So the two goals, one, let it live forever, and two, make it upgradable by people that aren't us. And so the comp token does this. What we've done is we've essentially broken up the admin key of the protocol into 10 million comp tokens. And we're distributing those 10 million comp tokens to the original developers of the protocol, some of the entities that funded the development of the protocol originally. The community is going to be by far the largest holder of the keys over time. And by doing this, we're basically distributing the control of the underlying system. And so, the idea is very quickly already, we've turned on compound governance. Right now, the comp token now runs the protocol. There's still a limited number of stakeholders that are responsible, but you can think of it now as like a 60 entity multi-sig instead of a one entity, admin.
Right.
Changes to the protocol. And we designed the system so that anybody who's a material owner or, voter in the system is able to propose changes to the protocol. So in the first 2 weeks, we've actually seen two proposals created, one by our team to test out the underlying mechanisms of decentralized governance. And the second proposal was created by an application built on top of Compound. I'm actually most excited by the second, which is an application built on top of Compound proposed a change to the protocol. Now, why is this mind-blowing? So throughout history, there's been all of this talk of platforms. It's dangerous to build on top of Twitter or Facebook or Google because they can yank the rug out from underneath you. You can't upgrade, a platform that you're building on. They make the rules. This demonstrated by having an application built on top of Compound propose and implement an upgrade to the protocol that we're flipping the script entirely. And that instead of there being platform risk to build on top of Compound, there's the opposite. There's platform upgradability, which is when you build on top of Compound, you become responsible and able to upgrade the protocol for yourself and for everybody. And that's, I think, one of the most powerful features of decentralized governance that we're looking to demonstrate. And I think is going to change people's minds about what crypto and what DeFi and what Ethereum is capable of, and why it's a safer and better platform to build on than traditional financial markets.
Yeah, definitely does turn kind of management upside down, like traditional corporate management upside down. But it still, doesn't it still pose the risk of these applications taking over the protocol, and still, if it's not centralized around management of the protocol, it can become centralized around an application. Maybe there's one application that figures a way to gain control of a majority of comp tokens and just, you know, changes the rules to rig the protocol in its favor and maybe push out its competitors.
That's certainly a possibility. And it's going to be really interesting to watch this unfold over the next 20 years. We've designed the basic principles of compound governance to allow essentially a very creative governance process to unfold, where there's not clear expectations about how it's going to work yet. It's going to take a lot of time for something like that to occur. And the governance system has a lot of time to react. So, you know, one of the things that we haven't announced yet is exactly how we're going to distribute the majority of tokens to users. But over time, the users of the protocol are going to have more and more and more influence. And it's going to be interesting to watch where influence goes. Do they want to support applications? Do they want to support exchanges? Do they want to support custodians? Do they want to support themselves? And who winds up with control over the protocol and why? I think based on some of the early decisions that were made in terms of how the system is built, it's going to lead to a concept of slow governance, similar and inspired in a lot of ways by Bitcoin, which there's not that many changes and they're not occurring very frequently. But when they do, they wind up receiving majority support, or it becomes extremely contentious. And I think we've started to build some of the basic parameters of the system to lead to what we hope is a slow governance. One that isn't meant to have weekly conference calls and weekly changes and doesn't have lots of rapid fire modifications. But when there's an important enough upgrade, it can be proposed, debated, upgraded, and implemented by the community.
Okay, I guess that ensures that nobody kind of takes over the system, but it also, you know, the downside is it makes it maybe less flexible, or, you know, just like obviously slower to change. But and okay, so you mentioned the distribution of comp tokens to like the broader community, and I know you haven't like disclosed any details, but is there, you know, anything that you can tell us about that timeline? Anything else that you can disclose that you haven't like given much details on it?
Yeah, of course. And we're waiting until the this mechanism is code complete and audited and be able to be reviewed by the community before we announce it. But in a nutshell, every single user of Compound is going to wind up with comp governance tokens to be able to participate in Compound governance. And this is exciting. You know, in terms of, you know, why we're doing this, it's so that there's a widespread distribution of people that are able to participate in the protocol. You know, a lot of systems, they start off where, you know, the users aren't able to participate, or they come super late, or there's some other mechanism of distribution. We want every user to have a say. And every user of Compound is going to have a say. And the governance structure is designed as liquid democracy. So users are able to participate in governance themselves, or, and this goes back to maybe an application winds up having influence, they can delegate their tokens to any other address. And this can be a DAO, this can be another address, it could be a friend, it could be Camila, it could be an application that wants to participate in governance. It's going to allow a very liquid democracy to form, where some people participate and some people elect others to represent them in Compound governance. And it's going to be really exciting. I think it's going to create this, you know, explosion of creativity around how to run a protocol once this goes.
And so, for example, if I own a CDAI, will I get, does that count as being a user? Will I get comp tokens for just owning CDAI?
Yes, that's right. So
nice.
Everyone who has
so.
yes.
Okay.
Yes.
Cool. All right. Okay. And then I also wanted to ask you, there's kind of, you've been asked this before and you've given kind of different types of answers. So will Compound issue a stablecoin? Is that in the plans? Is it being talked about at all within the team?
So we get asked this question a lot, and I don't think we've ever given a different answer, but I'll give the same answer we usually give. So there's a lot of reasons why the community would be excited for Compound to create a stablecoin. It's a system that enables people using collateral valued at market prices to borrow an asset. And there's very little difference between borrowing one of the assets that's already supported and borrowing an asset that doesn't yet exist. It would be very trivial for the protocol to create a stablecoin or synthetic asset. We have no plans as the developers who built the protocol to launch a stablecoin. But as Compound governance takes over, anyone in the community can propose upgrades to the protocol. They can write the code that would upgrade the protocol, show it off to the world, debate the merits of it, and eventually have it integrated into the protocol. So in a future state, I could see the community doing the work, debating how to create it, and creating a stablecoin from Compound. But it's not something that our team that originally built the protocol has thought about at length.
Okay. Okay. Would you like to see that happen?
You know, I'm trying to be as neutral and unbiased as possible. You know, once we start to roll out the Compound governance tokens to our users, I actually don't want to limit or encourage the community in the direction that it wants to go. So, and you're not going to see, you know, myself or the developers that originally built the protocol trying to influence what happens with it. I'm just excited to see the community try whatever they think is best. And, you know, changes won't occur instantly. You're probably going to have to convince the rest of the community this is the right direction for the protocol to go. But anything is possible. All of the power of what used to be a centralized administrator is now in the hands of the comp governance token holders. And the number of comp governance token holders is going to increase to 20,000 as soon as every user winds up holding it. So we're going to see lots of ideas, and it's going to be really exciting. And I couldn't tell you with any degree of certainty whether or not there will be a Compound stablecoin a year from now or 10 years from now.
Okay. And then this is something that I've wondered about, especially with the recent hack with the copied Compound code. So your part of your code is under copyright, and that it's understandable, but it also seems to kind of go against some of the principles of DeFi. To have it be like a completely open financial ecosystem. So just trying to understand why you made that decision to have some of your code be under copyright.
So all of the code to Compound is able to be inspected, audited, reviewed, and researched by the community. So the principle that we're guided by is that anyone can see how Compound works. They can verify that there's no funny business. They can monitor all balances, all transactions. They can see all the things you would never see with a traditional financial product. We, for very specific reasons, don't want the code to be completely free and open source because it enables anyone then to essentially take the code and try to build their own application with it. Launching a system like Compound or any DeFi application requires considerable thought paid to security, towards understanding all of the risks of the system and to being extremely diligent and responsible. And we actually don't want anyone to be able to just take it off the shelf and then say, like, I've launched a Compound-like product. We think that's extremely risky and extremely unsafe. And we saw what happens when you take code that you don't necessarily have an understanding of because you didn't build it yourself, and then you allow users to interact with it. It leads to losses, which, our number one priority is the security of DeFi and the users in it. And we think the standards for launching a DeFi product have to be higher than they are today.
Yeah, I guess the hack kind of proves your point in that way, at least. Okay, and then to wrap up, want to hear kind of your just like big picture for Compound. Where do you hope to see it in a decade or like 20 years from now?
Yeah, I hope that the community winds up really embracing governance and takes it in directions that I haven't thought of. I would love to see the community just get creative. Think about integrating with other blockchains in some ways or whatever way is possible, with Bitcoin, with Cosmos, with Polkadot. I'd love to see the community, take what's been started and just extend the reach of it and try things that we don't even know about yet. Maybe it's a stable coin. Maybe it's new interest rate markets. Maybe it's, connecting it to, an exchange in some fashion. I have no idea. So I don't know what 10 years from now is going to look like. I just hope to be surprised.
Nice. Very cool. Okay, it was great talking, Robert. Thank you so much.
Thanks, Camila, and thanks, Ethereal.
Thanks.
Hi, my name is Hayden Adams, and this talk is called Uniswap V2 and What Comes Next. So for those of you who don't know, the Uniswap protocol is a decentralized trading protocol on Ethereum. The idea is to be able to buy any ERC20 token with any other ERC20 token on Ethereum. And it makes use of automated on-chain liquidity pools and is used as infrastructure for other applications on Ethereum. So part of the idea behind Uniswap, part of the reason that I see it as valuable is that, I imagine a world where everything is tokenized, and I mean literally anything and everything. So we're already starting to see it happen with fiat, options, synthetics, game currencies, governance rights, stocks, retweets, electricity, community points, liquidity pools, rewards points, airline miles. Nope, that's never coming back. But yeah, basically everything other than airline miles we've already seen appear on Uniswap. And no one wants to hold these tokens except investors. So if you're investing in a project, you might want to hold a token. But if you're just using an application, you probably don't want to be holding the token specific to that application. You probably want to denominate in ETH or a stable coin or fiat. So Uniswap uses something called automated liquidity provision. And the idea here is to significantly reduce the barrier of entry to market making. So on a traditional exchange, you have professional market makers, and they're constantly putting up buy orders and sell orders. And participating in professional market making is a highly sophisticated thing. It's very complicated. It's very difficult. Not anyone can do it. You usually need a lot of upfront capital. So it's very costly. So the idea with something like automated liquidity provision and automated market making is that pretty much anyone can do it. And one of the reasons for this is that you pool liquidity from lots of users into a single smart contract. And so you don't need a single person providing the full amount. And then another thing is that it's reduced to a fully passive experience where you just lock it up and then the smart contract manages everything like price updates. And so having anyone be able to create a marketplace for any token is kind of important in this world where there's a million tokens. So we've already started to see that happen on Uniswap, where there's over 130 pools with $5,000 in it, and kind of a network of applications have started to spin up, where there's all these different tokens, and people can kind of abstract them within their applications, where you go to some website and instead of using that protocol's native token, you use ETH, and then in the background it will buy back the whatever token it needs. So Uniswap V1 launched about a year and a half ago, And since then, it's kind of exploded in growth. It's, over the past year, it's done about $1 billion in trading. And so that was kind of a proof of concept for this idea. But since then, after V1 kind of proved itself, the question was, what comes next? And for me, the idea, I was very sure that I could do better. And so we kind of formed a team and we built Uniswap V2. So the main idea for Uniswap V2 is to kind of expand on the features of Uniswap V1 and expand on, sort of provide new utility to the applications that are built on top of it. So the three primary new features are ERC20 pairs. Right now, all pairs on Uniswap are between ETH and a single ERC20 token. In Uniswap V2, you can basically put in any two ERC20 tokens on Ethereum, and you'll have a pair between them. The other thing is that a lot of applications on Ethereum rely on price oracles. It's kind of a meme at this point, but everything needs an oracle, and it tends to be the weak point for a lot of applications, where it's the one thing people point to as a risk to the project, as a point of centralization. And so what some projects have started to do, and I don't recommend it, is build on top of Uniswap V1 as an oracle and just check the rate, because Uniswap has all these different ERC20 tokens in it, and it lets you trade with ETH. You can kind of just check the rate and see, and use that as a price feed. But the problem is that it's very easy to, within a short time period, move the price very rapidly. So you can kind of see if a transaction comes in to check the price, someone can front run that transaction, move the price a huge amount, and then whatever was relying on that price is in trouble. And then the last feature that we introduced is flash swaps, and I'll kind of talk about that a little bit more later. So to expand on ERC20 pairs a bit, as I mentioned, all pairs are all liquidity providers on Uniswap. What you do is you deposit 2 tokens into the protocol, ETH and a single ERC20 token. And that enables trading between those two. But for the liquidity provider, they're kind of forced into this ETH price exposure. Whereas if you look at other trading platforms, the most popular trading pairs tend to be denominated in US dollars or fiat. So Tether, other stable coins, USDC. And so with Uniswap V2, you can now, liquidity providers now no longer need to take on ETH exposure, although personally I like ETH exposure, but liquidity providers might not want to. And so they can, put in any 2 tokens into the liquidity pool. Also, before, when someone wanted to convert any token to any other token, let's say USDC to DAI, it would have to go USDC to ETH on the USDC to ETH pair, and then ETH to DAI on the ETH to DAI pair. So you'd have to pay fees on both, and you'd have to pay, there would be price slippage on both. So with Uniswap V2, having direct pairs allows you to have more efficient trading prices between things that have a direct pair. This also means routing becomes a lot more important. So in Uniswap V1, it basically just looked like the second scenario where you pass one token, it tunnels through ETH, and it spits out the other one. Here now you have 3 different options. You put in 1 token, it trades it directly if there's a pair. You put in 1 token, it converts through another intermediary token. This is ETH, but technically you can use any token. Or you could even follow any custom route where you could hop through 5 different pools as long as some route could be found. Yeah, so price oracles, there's some really interesting stuff here. So when one of the risks to using Uniswap as a price feed is what I mentioned in the past earlier, which is that it's kind of trivial to be for it to be front run. So when you check the price at a given instant, it's very cheap to kind of set for someone else to kind of move that price. And so what we wanted to do is make sure that transactions from within a block are not counted, and you're basically only relying on price that kind of lasts across two different blocks. So every transaction on Uniswap can sort of see the price from the end of the previous block, and front running that price would kind of require making a transaction in a previous block, which means that it can get, which means you're opening yourself up to arbitrage. The other kind of thing here is that even if it does require making a front run across multiple blocks, that could still be, manipulatable. So the other thing we want to do here is introduce, a history of like a concept of time, right? How long has this price been here? So being able to average across a long period of time is very valuable, and lets you kind of make a much more resistant price feed. And so this is what the design looks like. Every block on Uniswap that comes in, before any transactions occur, it checks the starting price. And it says, how long has this been the price? Well, it's been the price since the end of the previous block. And so you have this amount of time that's elapsed and this price. You multiply that, and then you kind of add them up into the single price accumulator. And so what you end up getting is this single storage value, price cumulative, that every single second adds on the price. And it kind of goes on forever. And then what you can do is you can check the price at one moment, then you can check the price, say, an hour later, and then you can simply subtract them and divide by the amount of time that's elapsed. And what you can do is you can get a very efficient time-weighted average price across any period of time doing this. And the manipulation resistance of this is a lot higher than the manipulation resistance if you're, say, just checking the price. Something else that's kind of nice is that the manipulation resistance scales directly with the amount of liquidity that's in Uniswap. So if you're working on a project and you care about having a manipulation resistant price feed for 2 ERC20 tokens on Ethereum, all you need to do is deposit liquidity into that contract, and then you'll have these price accumulators that get created, and then you can set up your own Oracle smart contract, and that Oracle smart contract can use these price accumulators to create these time-weighted averages. And on top of that, you can start doing sort of more advanced filtering techniques. You can do different types of exponential moving averages. You can weight in different ways. So it's not so much providing an oracle directly as much as it's providing infrastructure for other people to build oracles on top of. And this lets you do all sorts of things. Because it's just 2 checks to get the TWAP across any period of time. You could even say set up a smart contract that has some sort of that settles at the 1 month average a year in the future, and you have a guarantee that you'll be able to get that as long as there's liquidity on Uniswap for that period. And you can actually guarantee liquidity for that period by locking up liquidity tokens in that smart contract. Another interesting new feature is flash swaps. So the idea here is basically that there are transactions that can occur that have a high upfront cost, but a very low net cost or even a negative net cost. And what I mean by that is say you see an opportunity to sell 1 ETH for 200 DAI on Uniswap, and then you could sell that 200 DAI for 1.1 ETH on another trading platform. That has a very low net cost. You actually make money on the transaction, but the upfront cost, you need to have an ETH to start to initiate. So the idea here is to kind of remove the upfront cost as long as the net cost is low. And so anyone who wants on Uniswap v2 can withdraw as much as they want of any token across any pair, use those, do anything they want with it, and then as long as by the end of the transaction they pay for them or return them. And so this lowers the upfront capital requirements and makes integrations a lot easier. So the reason it makes integrations a lot easier is because it kind of removes unnecessary constraints on the order of operations when you're making when you're doing integrations. An interesting example, a lot of people talk about this concept of combining a lending protocol with a swapping protocol like Uniswap to create a margin trading platform, sort of externally. So the way that works is you lock up ETH in a system like Maker or Compound. You would borrow something like DAI against it. You could swap that for ETH on Uniswap. You could lock that ETH back in the lending protocol. You could withdraw the DAI again. You swap it back, and you can kind of loop through the two repeatedly to leverage up. But that is very from a coding perspective, from a integration perspective, that's kind of a looping through multiple times is very inefficient. And so the way it would work with flash swaps is essentially you would start out by taking out all the DAI you were ever planning, or all the DAI or all the ETH you were ever planning on taking out of Uniswap at the very beginning of the transaction. then you deposit it all as collateral, and then you take out all the DAI or ETH you were planning on using to pay for it, and you put that all back in Uniswap. And that becomes a much more efficient transaction. And and Uniswap has a guarantee, or the Uniswap liquidity providers have a guarantee that they'll be paid back by the end of the transaction, or the transaction will revert. And so this is kind of a cool thing that probably isn't possible outside of a blockchain like Ethereum. So all these different projects are planning on building on top of Uniswap v2. But where do we go next from here? I think I think of Uniswap v2 as this utility upgrade to Uniswap. So it expands on what's already there, right? It already has sort of trading across any token, but it has now expanded on having more options for liquidity providers, more types of pairs. It's better for integrations. It adds on these price features. But I think for it to kind of really achieve the vision of Uniswap, and what the vision here is to be like the best place to convert between any token on Ethereum. To kind of really reach this vision, I think the next step is to kind of improve on the efficiency of the mechanism itself, expand on sort of the capital efficiency, the execution efficiency, and add more optionality for liquidity providers. And so after Uniswap v2, our kind of development team is really immediately going to start working on a Uniswap. Well, first off, Uniswap v2 launch very, very soon. I would say, yeah, very, very, very soon. Expect to hear more details by the end of the week. But after that, we're going to be working on a Uniswap v3. And the idea of Uniswap v3, as I mentioned, is to kind of improve on the slippage and the capital efficiency, provide better ways for liquidity providers to modify their exposure, and to and there's a whole bunch more. I don't want to get too into depth on it. I just kind of wanted to hint at it. But I don't want to kind of take away from the v2 stuff yet. But expect to hear more about this in coming months as well. And then when I look at Uniswap in the long term, right now it's Uniswap v1 is fully automated, but it's not able to kind of improve itself naturally. It kind of relies on a centralized development team that sort of built it. And Uniswap v2 is built by a development team. It still will run fully autonomously, fully decentralized. But how does it improve? The way that it improves is community input, community contribution. So I definitely at the moment Uniswap generates about $7 million per year in liquidity provider fees, based on the past few months volume. And I think that having sort of a portion of that going to incentivizing contribution and growth of the protocol itself is an area that I'm very interested in exploring moving forward. But it's not anything that exists at the moment. So before I short talk, I'm actually wanted to demo the updated interface for Uniswap v2. So this is so the same way that Uniswap v1 has a open source interface, we're going to be releasing an open source interface for Uniswap v2 that allows you to access all the features of v2. So this is the new interface. Just like v1, you can from swapping, you can kind of put in any token, you can get out any token, but in the background, actually, it's doing a lot more. Instead of just checking the ETH to DAI pair, it's actually checking all possible, or it's checking across multiple possible routes, because you might have a DAI to USDC pair and an ETH to USDC pair, and so this could be going ETH to USDC to DAI, for example. In this specific instance, I think it's just going ETH to DAI, but it makes use of some more advanced routing. Then we can there's also the the ability for anyone to spin up a new pool for any pair. So you can just go to create pair. It used to be that this would only allow ETH, and it still defaults to ETH. But you can actually use use this drop down. You can select a different token as your base. So for example, I could select MKR here, and I could select DAI here, and then add liquidity to it. I can just join the pool from here. And so it supports any arbitrary Ethereum addresses. And then of course you can, once you've added liquidity, we've kind of improved on the UX of it, where you can see all your positions. You can kind of go into it. You can go to remove, and you can sort of withdraw any percent. So yeah, that's Uniswap v2. We're expected to be out very, very soon. Yeah, if you want to follow me, you can follow me on Twitter at Hayden Z Adams. If you want to follow the project, you can follow at Uniswap Protocol. We have the community tends to mostly be based around Discord, our Discord server, which you can find on our website. Happy to kind of answer any follow-up questions in our Discord if people have any. Definitely would like to thank Ethereal for hosting me. Yeah, that's my talk.
We are live. Wow, welcome everyone to the ETH is Money panel, the thing we've all been waiting for. The best panel on Ethereal. Well, no, I don't mean to offend anyone, but all right, so I'm Camila Russo. I'll be moderating the panel. I am the author of The Infinite Machine, a book on the history of Ethereum, and the founder of The Defiant, a content platform focusing on decentralized finance. And I will let our speakers introduce themselves briefly because we have a lot to get to. I guess starting with Eric and then going like clockwise.
You muted, Eric?
Yeah, if you can all introduce yourselves.
I think Eric's having mute troubles.
Oh no. All right. Okay. So maybe Anthony, you go, and then hopefully Eric will have figured it out when we're done.
Oh no, Anthony's muted too.
Oh my God, what's going on? All right, Ryan.
Hey, can you hear me?
Yes.
Can everyone hear me? Okay, perfect. All right. So I'm Ryan Sean Adams. I am a crypto investor. I am the founder and writer at the Bankless program, and I am slowly breaking up with my Wells Fargo account.
Can you hear me before I start?
Yes.
Okay, cool. I'm David Hoffman. I'm the COO at Realty Platform, where we tokenize US real estate and put them on the Ethereum blockchain for DeFi to leverage. And then also, as you can tell, me and Ryan also run a podcast together called Bankless.
All right. Okay. So Eric and Anthony, are you able to? No, you're not. Okay. What do we do? Should we? So do we wait, or should we do this panel with just Ryan and David?
Well, we can start, Cami, if you want.
Okay, let's do that. All right. Okay. So
Eric, Anthony, sorry to
start.
cut you off. Eric and Anthony, make sure your microphone is selected with the gear icon. If you open that up and select the input, there should be the right input there. Sorry, Cami.
I guess you guys can hear me now.
Yes.
Okay, that was weird. Yeah, that was it, David. I don't know what happened there. Anyway, I guess, yeah, quick intro, co-founder of ETHub, product marketing manager at Set Protocol. And yeah, I think Eric's should be fixed as well now.
Eric? I guess like the same like gear thing should be ticked off, but all right. So anyways, Eric, hopefully you can join us soon. But let's get started. So I wanted to first start with getting everyone on the same page with the generally accepted definition for money before we can establish whether ETH is or isn't money. So money is defined as something generally accepted as a medium of exchange, a measure of value, or a means of payment. So I think everyone here will, agree that ETH is money using that basic definition. Like we've all used ETH to buy stuff, even if it's gas to use an Ethereum application. We've all used it. It works well. But I think to bring this conversation forward, I think the discussion should be around how good is ETH at being money. And so I wanted to discuss the other attributes which define money as being the best way to solve the coincidence of wants problem. Just have it be the best tool to get someone who wants to sell something, get somebody else to buy it from him. And so those properties are, it should be fungible, durable, portable, recognizable, and stable. Okay, so and just to get the conversation going fluidly, we were saying, we'll start with Anthony and then go clockwise with each question. But I think from those values, it's pretty clear that ETH is fungible, right? I mean, every ETH is equal, and I think that's a property that's made even clearer with digital assets. Do you guys agree?
Yeah, so I'll start. I think you outlined the points very well there. These were the same points that I had in an article that I wrote about 2 years ago before the ETH is money kind of meme was, born, essentially. I think I wanted to also set the record straight that when we say ETH is money, we're not saying it's only money. I think a lot of people get hung up on that, and they think that we're saying that, we're just putting ETH into this bucket and saying, okay, it's only money, it can only be that, it's not anything else. But it's definitely not that. ETH is money, and ETH is a lot of other things as well, of course. But I think I wanted to focus on the one characteristic of money of being stable. I think that's one of the most important, if not the most important, of being good money, as you were talking about. Like, is ETH good money? And it's not great money. Like, I personally would rather not spend my ETH to buy something if I could buy it with like USD because it's stable. My ETH, I'm expecting to go up. There might be tax related kind of things that happen there as well. So yeah, but I have used ETH as money for lots of different things before. There are things that are priced in ETH. I mean, all the ICOs were priced in ETH. You could only buy into them, most of them with ETH, right? And same with like things like God's Unchained cards or other NFTs. Most of the time they're priced in ETH. So I use ETH as money to do that sort of stuff. But yeah, if we're talking about if ETH is good money today, it's not compared to something like a stable coin, right? Just simply because it does not have that stability, and I think the tax stuff is not talked about enough. Where incurring taxable events just for spending something that is supposed to be an investment vehicle, but you're using it as money is another big, I guess, point there as well. But yeah, I'm curious to hear Ryan's thoughts here too.
Yeah, so I think those are great points, Anthony. I guess I would say, Cami, as you said, like ETH does check the box as a store of value, medium of exchange, and unit of account within the Ethereum economy. But there are also other monies within the Ethereum economy that are better from a stability perspective. I talk often about like, I don't ever want to spend my ETH, right? Because I think the price of ETH is going to go up. In the same reason I don't want to spend my Bitcoin, but I will spend a stable coin that's derived from ETH, like a DAI, for instance. And here's like, I think when we talk about ETH as money, one of the attributes we're actually talking about is ETH, the asset. So Ether, the asset that sort of is the reserve asset of Ethereum that has a monetary premium, which means it has a value as either a store of value or a medium of exchange or unit of account. And right now, if you look at the Ethereum economy, Ether, the asset, serves best as a trustless store of value within the Ethereum economy. Why is it the best trustless store of value? Or we might say, why is it the best collateral on Ethereum? Why is it the best asset to back something like a DAI or synthetics? Even if you're trying to make an S&P index on Ethereum. Well, the reason it's the best is because it is the most trustless on Ethereum. So all of the other assets on Ethereum have some level of additional trust that's required either from an issuance perspective or from a settlement perspective. So Anthony was talking about USDC, right? That's better from a stability perspective, but essentially USDC is just an IOU for some dollars in a US bank account, right? So what am I trusting when I'm using USDC? Well, I'm trusting the US banking system. I'm trusting Coinbase. I'm trusting the Cedric consortium. So it's not, if you're trying to build a decentralized banking system and a decentralized money system, then ETH is really the best asset for you to build on top of because it is the most trustless asset inside of the Ethereum economy. And then you add to that, and I'd be interested in hearing David's thoughts on this. You add to that, the reason why holding ETH is so valuable and so interesting is because ETH is scarce and it's getting more and more scarce over time. It has these incredible in-game scarcity mechanisms that make it something that you want to hold because it's going to increase in value. I don't know, David, if you want to riff a little bit on the scarcity aspect of ETH, but to me, when we say ETH is money, what we're really talking about is ETH is a reserve asset of Ethereum, and it has a monetary premium. So it's valued as a store of value, as a collateral, as a trustless reserve asset for Ethereum.
Right. Okay. So before David answers that, I wanted to address this question. which is, so ETH is better at being collateral for other assets like DAI, for example, that are more stable and better suited to be actual money because of the stability side of it. But does that make Ether money, or just, it makes it good collateral? It makes it a store of value, which doesn't necessarily mean it's money. Like maybe it's more like gold. Like gold used to back the US dollar, and it wasn't considered money when it was backing the dollar. It was used as a store of value and collateral. So if we're saying that ETH is better as that, then maybe we're saying ETH isn't really good at being money after all. David, what do you think? Oh, I think you're muted.
Hey, David, you're muted.
Still muted. Okay. Anyone want to go for that? Well, Dave figures is out.
Yeah, so I'll take a shot at it, Cami. So I think when we say ETH is money, what we're, like money is, I think, better thought of as sort of a spectrum, right? It's almost like an adjective. Is that David coming back on?
Okay, I got it. So
there he is.
Okay.
I don't know what's going on, but I just changed the microphone to my local computer microphone. So whatever. Guess don't need to be a podcaster today. So the what I was saying earlier is with money is just really poorly defined. What money is has like changed a lot throughout history. And so when we talk about like this is money or this is not money, like we actually don't really have a good like anchor point to really compare that to. Money, like the current version of the dollar came in 1972 or 73. So it's very, very recent. And so like if you go out on the street and ask somebody what's money, they're going to pull out $1 and tell you that's money. But that's only been money for like the last 30 years. And so if I think the most reductionist of a definition of what money is money is liquidity. It's liquidity distilled inside of some sort of token, some sort of symbol, and gold or dollars are just like the carriers of this symbol, of this. It's a representation of liquidity. And so when we talk about ETH as money or Bitcoin as money or this new crypto asset is money, what we really need to talk about is like, when you sell it, can you sell it for anything that you want? Because money is supposed to get you whatever you want. It's equal amount of its worth for some other item. And so when it comes to on Ethereum, if Ether can do anything that any other asset can, then ETH is money, right? And if Ether can do whatever like a paper dollar can and more, then ETH is money. And so like if Ether is being collateral and it's also extremely liquid for making also for payments, then ETH is being really good money. And one thing I don't think we've really touched on with the whole ETH is money conversation is like humans are only 1/2 of the users of Ethereum, of crypto networks, right? Like robots now are users and transactors of money, and Ether is really, really good money for robots. And so like this whole entire new paradigm of like contracts that can operate on their own needs something like Ether, which has the strongest amount of settlement assurances of any asset in the world. And so Ether for robots is really, really good money. And because robots are using Ether as money, it makes Ether better money for humans too.
I mean, it isn't great money for robots when it breaks down liquidation systems because it's so volatile. You know, we still have the stability problem there.
I would say that the robot was acting poorly, not Ether in that case.
Maybe. Okay, so I think, yeah, like the stability, I think we've kind of discussed that it is an issue with Ether. I think we've certainly established that Ether makes great collateral. Maybe it's on a spectrum of being great money, where DAI is at like being very good money. ETH would maybe fall farther behind because of the problem of stability. Eric, Anthony, I don't know, do you want to add to that?
I don't know. Can you guys hear me?
Yep.
Yes.
Yes.
Oh, hey. All right. I was just here as an observer, checking. Yeah, I wanted to just watch you guys the whole time. So just for reference, you can't use a microphone mic on this thing. It causes problems.
Mm-hmm.
Anyways, yeah. So I mean, the stability aspect, I think people get caught up in thinking stability is a requirement of money. It's not really true. Like, I think we're seeing the emergence of a new money. We've seen emergences of new money throughout history, right? I mean, kind of back in the day, money is used for goods and services, and like trying to buy these goods and services. Before we kind of established a fiat money system, you know, we had bartering. So someone would say, hey, I'm going to trade you my cow for your corn. Prices of those were not stable, right? But they were used as money per se. Then we went into this commodity money concept where gold was backing it. And, you know, gold has its volatility as well. You know, people day trade gold. It goes through, you know, 5-10% pumps here and there and dumps. So I agree that, is the volatility ideal for ETH as money right now? No, but you know, I think as time goes on, it's proving to be more and more stable as well. I mean, geez, ETH's been stuck at what, 100 to 200 for 2-3 years now. So theoretically, it actually is pretty stable if you look at it that way. But you know, volatility is, you know, I think eventually throughout time something you'll gain as a principle of this money, but it's not a necessity per se.
Yeah, and can I just add something to that, like building on Eric's point for a second?
Yeah.
So David was talking about kind of the killer feature of ETH is that it's really good for money robots, right? And then Eric was talking about like stability is not necessarily needed. The cool thing about Ethereum is because it's programmable, you can take a stability money robot, right, like a maker, and then you can combine that with the trustless store of value of ETH. And then you can create something like DAI, which is 87% backed by completely trustless store of value. So when we say ETH is not money, but DAI is not money, well, DAI is actually ETH, right? Because without ETH, it wouldn't really be backed by anything. And if it was backed by more trusted collateral sources like USDC or, you know, a WBTC, something like that, then it would no longer be a trustless money asset. So to me, it's like absolutely fundamental that at the base layer of Ethereum, you have this completely trustless, you know, reserve asset, a gold-like asset that might be highly volatile, but when you combine that with a money robot, and we've only just scratched the surface. I mean, we've only seen DAI. I bet we'll see tons of different stability robots that are built on top of ETH in the future. Well, then you can create like this programmable, trustless, stable version of ETH that is a better money. And that to me is like the power of the system.
Right. Yeah. I think it's pretty clear that ETH has so far been great at providing the building blocks to create an actually good and usable money. It's unclear still, like, I think, whether that's enough to call it money itself. You know, the fact that it's backing something that can be used as money means that it actually is money. But moving on from the stability aspect, I actually think there's another one of the features that I mentioned starting out the conversation that's sometimes overlooked, but that can also pose a problem for saying that ETH is money, which is that money needs to be recognizable. So that means that the authenticity and quantity of the goods should be readily ascertainable to the users so that they can easily agree to the terms of an exchange. And so I think that that's true for Ether inside of the Ethereum ecosystem and network. Like, we all agree on the price of Ether, and Ether is used to exchange a number of things that we all mentioned, from gas to NFTs to ICOs to different tokens. But what about, we're living in this small Ethereum bubble. What about for how recognizable is Ether for people outside of the Ethereum network? Like we want Ether to be kind of this global currency, but if it's only used in this like very niche and insular ways, how good is ETH at being money actually?
Okay, I'd love to start. Yeah, so recently we saw Dharma sending out DAI via Twitter, and so no one really needed to interact with any amount of Ether in order to collect DAI via Twitter, and the entire Ethereum blockchain was totally obfuscated. And the fact that Ether is backing DAI is already obfuscated away. And so, like when Dharma is sending DAI throughout Twitter, there's already 2 levels of obfuscation away. But because inherent to blockchain protocols is the verification of all transactions, like we don't need to make that rise to the surface. DAI and sending DAI is using Ether in this verifiable way because the money robots are doing that for you. And so you can just, swipe to send DAI, and then you're using Ether as a store of value, but in its stable form via Twitter. And so I think that whole aspect of verification and using Ether and for people of all over the world to use Ether as money, I hope that a decent proportion of the world's population don't ever understand what Ether is. Like that would be a good thing if they can just use DAI and see that there is a balance in their account that goes up when they get paid. And then when they buy something, that account balance goes down in a way that is expected and dependable. And if that's underpinned by Ether, that's great, but they don't need to know that. And because of that level of obfuscation, like that Ether is still down beneath the whole system. It's still the collateral, the store of value, and then the stability is layered on top. And then the Twitter UI is also layered on top. And so I think that's how this is all going to unfold.
Right, with better UX UI, making it easier for everyone outside of Ethereum to also, at least indirectly, use ETH. Anthony, do you want to add to that? I see you nodding.
Yeah, you guys can hear me, right?
Yep.
Yeah, cool. All right, so yeah, you mentioned that, Camilla, that I guess ETH is like insular to the Ethereum economy. So it's used as money within the Ethereum economy, but it's not used as money outside of it. And I've drawn the parallels before to in-game currencies. So video games that have their own currency systems, and one of the most popular ones is from World of Warcraft with their in-game gold system, which it's actually been studied for the economics behind it, because it's a real online world where people are transacting, they're saving, there's inflation because there's just an unlimited supply of the gold. People were actually trading it for real US dollars, trading it back and forth. So that money, the gold, was very good inside of World of Warcraft, and you could get into it by using USD as well, by using real USD. It's similar to with ETH. ETH is extremely good money, I think, within Ethereum. Even without its stability, it's still good money within Ethereum. It can still act the same, just minus the stability. It's the same thing as like DAI or USDC, just minus the stability in terms of like transacting with the what it's accepted by, what merchants will take. Merchants are still going to take ETH. They could take ETH and just quickly change it over to DAI or something via Uniswap, or just do it automatically via a payment processor. So I don't think ETH is like recognizable or good money outside the Ethereum network for sure. No one's really accepting it for goods and services. I mean, we accept it on the ETH Hub shop, but who knows about the ETH Hub shop besides Ethereum people, right? Like my mom's not going to use ETH as money, so all those sorts of things. So, yeah, that point is definitely true, I think. But I think as we go on, like to David's point, we'll have ETH as that base asset backing these these monies that people will interact with without even knowing that it's backed by ETH. So if people one day will interact with DAI and use DAI, people probably they already do in maybe the countries like in South America where DAI is being pushed as this stability hedge. Maybe they have no idea about ETH and they don't know that ETH is backing it, and they're just using DAI because they're like, oh, okay, this is equal to $1 and they're using it for their needs. So I think that's the path that we're kind of like walking down, and I don't think that takes away from ETH's moneyness at all.
Yeah,
I think we're on track, but not there yet.
Yeah, I just want to add one quick point to add on top of David's a little bit. And to understand money supply, people often think that money supply is measured just with cash. There's actually many layers to the money supply. So like, I don't want to go too into the weeds here, but like M0, M1, M2, and all the way up to, I think it goes to like M7 or something like that. But at the base of this kind of like layer is cash. And as you go up, you get into savings accounts, you get into time deposits. Eventually you get all the way up to things like treasury bills and stuff like that. And that's an aggregate how the money supply is measured. So I think that point plays well into what you guys are talking about, in that, at the base can be ETH, but we can build all of these other things through DeFi on top of it, which is actually an aggregate, a part of the money supply.
Can I just add one thing? So I think it's super important to realize how early we are, right? So right now we talk about how, Anthony's mom, wouldn't use ETH, right? My mom wouldn't either, just to be clear, right? But I think the Ethereum economy and the crypto economy is growing so fast. So right now there are about 50 million people or so that own crypto, and most of the people that own crypto are using it for speculation of one sort or another. They're betting on the price of Bitcoin, or they're betting on the price of Ethereum. But like that number, was 10 million just a few short years ago. When we look at the DeFi space, actually Anthony tweeted this out last week. There are about 150,000 DeFi users right now. So 150,000 people like us who are actually using DAI to go bankless, to spend it as payment using lending protocols. I mean, that's the population of a small city. But if you look at the growth rate of DeFi and you fast forward to a year from now, if it sustains its same growth rate, then there'll be 1 million people using DAI. And if you fast forward 2 years from now at the same growth rate, then there's going to be 10 million people using DeFi and DAI. That's only 2021. So this stuff is growing so fast. I think that the larger point is, when you look at like Gen Z, most of us are probably like millennials, Gen X, etc. But if you look at Gen Z, I mean, they're growing up and they're using these digital gaming assets like Anthony was talking about. Like, that's so normal for them. So what I think could happen is actually the Ethereum economy could grow to incorporate more of the real world. So it's like an emerging nation state almost, with a burgeoning currency, right? That only 150,000 people are using, but 2 years from now it's 10 million, and then maybe 5 years from now it's 100 million, and then it's 1 billion before you know it, and
then
that's
the world.
Exactly. I mean, that's kind of how it grows, and we're on that trajectory right now, which is why it's such an exciting time to be in crypto, in Ethereum, and in the DeFi community.
Yeah, so we're kind of the settlers in this frontier of this new nation state of DeFi and Ethereum.
Yeah.
So yeah, the idea is